Welcome, folks, to today's deep dive into valuation. We're unpacking a lot here, from the philosophical underpinnings and the myths of valuation to how bias and market perceptions shape our assessments of assets.
I'm really looking forward to this discussion, especially about how even the models we trust can be so subjective.
Absolutely. You know, every asset, whether it's financial or real, is assigned a value. But what's fascinating is how similar the underlying principles of valuation are, even when the data or the information needed differs from, say, real estate to publicly traded stocks.
Yeah, got it. So are we saying that while different assets require different models, the basic ideas remain the same?
Right, exactly. It's like you see the big picture in valuation, understanding the cash flows expected from any asset, and ensuring that the price we pay is a reflection of those cash flows rather than simply being swayed by, market sentiment.
And that ties in nicely with the Oscar Wilde quote we encountered, "Knows the price of everything, but the value of nothing." It really challenges the notion of just accepting prices without digging into the underlying cash flows.
Yep, spot on. And it's also interesting how some market players, like those who subscribe to the bigger fool theory, seem to ignore these fundamentals. They might chase a stock just because someone else is willing to pay more.
But that approach, while potentially profitable in the short run, seems like a risky game in the long run, doesn't it?
Exactly. It's a dangerous game. The essence of sound investing should be that you never pay more than what an asset is fundamentally worth. And yet, perceptions and biases run wild.
Speaking of bias, the input really highlights how valuation models, even if they're quantitative, are not immune from subjective judgments, right?
Yes, yep. Even if you build a model with all those numbers, the process is colored by biases, be it from analysts' public positions or even the firm's own self-valuation in takeovers. For instance, equity research can slip into cheerleading, especially during those irrational exuberance periods.
Right on. I mean, it almost feels like analysts might sometimes let external pressures tarnish the neutrality of their valuations, especially when their firms are involved in broader investment banking activities.
Absolutely, and that's why minimizing bias before you start is so important, even though it's easier said than done. You try not to have a stake in whether a firm is under or overvalued, and you withhold strong opinions until after all the analysis.
Totally. This, in a way, also shapes the debate about market efficiency. On one hand, having lots of biased opinions could fuel inefficiencies, but on the other hand, some even argue that market efficiency depends on those very investors.
Exactly. It's kind of a paradox. While efficient market theorists might say the market price is the best estimate of value, those who challenge that idea, the skeptics, keep the market moving by finding under or overvalued assets. It's like, if nobody was trying to correct the mispricings, then the market would never adjust.
Yeah, oh, definitely. But then there's the contention that a sound valuation should evolve. It's not something timeless. I find that intriguing, because if valuations were static, we'd never update our models with new firm-specific or market-wide info.
Exactly. You might have a model that gives you a value today, but tomorrow, with fresh information like an earnings report or changes in interest rates, that valuation has to be updated. That's why precision in valuation is tricky.
I see what you mean. And speaking of precision, there was that myth in the input saying that a good valuation provides a precise estimate. It really debunks that notion, right?
Yeah, indeed. Even the best valuation only gives you an estimate with a margin of error because you're making assumptions about cash flows and discount rates. As they say, you're always prone to error to some degree. It's all part of the process.
That makes sense. It's refreshing to see a realistic view that even detailed analyses come with uncertainty.
For sure. And another interesting point is the idea of parsimony. You don't want a model so complex that it becomes a black box where input errors proliferate. The fewer well-chosen inputs you use, the better the chance you'll avoid compounding errors.
Absolutely. Now, on a slightly challenging note, some might argue that a complex quantitative model should, in theory, yield better precision. How do you see that?
Well, That's a fair challenge. I mean, in theory, more detail should help. But in reality, as you add more variables, you also multiply the potential for error. There's a trade-off. It's like if you're building a house, more detail might look impressive, but if your foundation isn't solid, you're in trouble.
Yeah, that analogy really paints it clearly. Right, and we can't forget that ultimately it's the analyst, not the model, who values the asset.
Precisely. It's the human element that fills in the gaps and debates the assumptions.
Moving into the practical side, the input also breaks down the role of valuation in portfolio management, acquisition analysis, and even corporate finance, doesn't it?
Yup. In portfolio management, you've got different types of investors: fundamental analysts, franchise buyers, technical chartists, and even market timers, each approaching valuations with their own perspective and based on their investment philosophies.
Interesting. Can you give an example with, say, a fundamental analyst?
Sure. A fundamental analyst bases their stock picks on the assumption that there is a true value related to the firm's financials. They use models like discounted cash flow or multiples like PE ratios to decide whether the stock is under or overvalued. It's a long-term strategy that banks on the idea that the market will eventually correct mispricings.
Right, I get that. And then there are franchise buyers like Warren Buffett, who focus intensely on businesses they understand well, and then use valuation to gauge if they're getting a bargain, correct?
Exactly. Buffett's approach highlights the need to really grasp the business model and then invest only when the company looks undervalued from that perspective. And there's a neat interplay. By taking a large stake, they can sometimes influence management to create additional value.
Yeah, that's pretty compelling. It's also fascinating how, even for those who believe that markets are pretty efficient, valuation still has a role, right? Like, it's used to understand what assumptions about growth and risk are baked into the market price.
Absolutely. Even efficient market proponents use valuation as a diagnostic tool. It helps them understand if, say, a stock's price is reflecting high growth expectations, or if there's some over-optimism or pessimism lurking.
Exactly. Now, when we look at acquisition analysis, the input makes it clear that valuation has to account for things like synergy and management changes. That seems particularly tricky, given how subjective synergy can be.
Definitely. In acquisition scenarios, you're not just valuing the firm in isolation, but also assessing how the combined entity might deliver extra value. And bias can sneak in here too. Target firms can overestimate their worth, and bidding firms might be swayed by the strategic narrative they want to push.
Right, that potential bias is critical to watch. And then there's corporate finance, where valuation underpins decisions about capital projects, financing, and even dividend policy. It's almost like business strategy and valuation are two sides of the same coin, correct?
Exactly. Corporate decisions on which projects to fund or how to structure debt and equity are all made with the goal of maximizing firm value. So valuation isn't just an academic exercise. It directly influences strategy and ultimately the firm's bottom line.
Really important indeed. So to wrap it up, while valuation models offer a framework to approach the value of an asset, the process itself is laced with subjectivity, bias, and constant uncertainty because of ever-changing information.
Precisely. It's a reminder that while we rely on structured models, at the end of the day, sound investment decisions are rooted in understanding both the numbers and the context behind them.
Yep, so true. Before we sign off, can we quickly unpack one of those questions from the input? Like the one about why a stock priced at $25 might be valued at $15 using a particular model.
Sure. There are a few possibilities. It could be that the market is overvaluing the stock due to buzz or sentiment. There might have been errors or overly optimistic inputs in the model, or even just market inefficiency. Essentially, it boils down to differences in perception versus fundamental cash flow expectations.
That makes a lot of sense. And that, as we've discussed, ties back to the overarching theme. Valuations are insightful but imperfect. And as soon as new information arrives, everything gets reassessed.
Exactly. It's a dynamic process that requires humility and constant vigilance. Thanks for the great exchange today.
Absolutely. Thanks for the insightful discussion.
Let's kick things off by diving into the world of valuation. It's like truly the backbone of financial analysis, right?
Absolutely. It's fascinating how we have these three main approaches: discounted cash flow, relative valuation, and contingent claim valuation. Yep.
Yeah, exactly. And the discounted cash flow, or DCF, approach really lays the foundation. It's all about discounting expected future cash flows at a rate that reflects their risk, like, calculating the present value of what's to come. It's the bedrock for understanding the other methods.
Right, right. And it's interesting to note that while DCF is so fundamental, in practice, most valuations end up being relative. Analysts often rely on comparisons, like using multiples such as price earnings or price book. It's almost like every valuation ends up referencing what the market is doing with similar assets.
Yeah, and it's really important to remember that while relative valuation is quick and relies on market quotes, it can sometimes be skewed if the market is off, Whereas DCF takes a deeper look at, the fundamentals of the firm. It's a bit like comparing an apple to an apple rather than apples to oranges.
Speaking of fundamentals, I love how DCF brings in both equity valuation and firm valuation perspectives. I mean, if you discount cash flows to equity at the cost of equity, you get an estimate for equity value. And if you discount cash flows to the firm at the WACC, you end up with the whole firm's value. That alignment is so crucial.
Absolutely. And what's neat is that if you properly match the cash flows with the appropriate discount rate, the two approaches yield consistent valuations. But mixing them up, like using the cost of capital for equity cash flows or vice versa, can lead to significant errors.
Yeah, it's a classic pitfall. In fact, there's a neat illustration showing that using the wrong discount rate can overstate the equity value by around 175, or conversely understate the firm value by a couple of $100s. That really highlights the importance of proper matching.
For sure. And aside from DCF, the relative valuation method really grabs my attention too. It's so pragmatic, using multiples like the PE ratio, price to book, or even enterprise value-based measures like EV/EBITDA. It's simple yet powerful.
Yep.
But it's not without its pitfalls.
Definitely. One challenge with relative valuation is that you're often basing your analysis on the assumption that the comparable firms are priced correctly by the market. If the market is mispricing everything, say the entire sector is overvalued, then your valuation could be off. Isn't that right?
Exactly, that's a key critique. It's a double-edged sword. And it gets even trickier when you're trying to decide which comparables to include. I mean, if you cherry-pick firms, the average multiple can swing quite a bit. There's that example where removing the two highest or two lowest PE ratios change the average dramatically.
Right, that example really emphasizes the subjectivity involved in selecting comparables. Now, switching gears a bit, I'm super intrigued by the contingent claim valuation approach. It's like a whole different ballgame, using option pricing models to capture the extra value of option-like features in assets.
Oh yeah, that's such a revolutionary development. It's almost like we acknowledge that some assets have value beyond just predictable cash flows. For instance, consider an undeveloped oil reserve. If oil prices spike, the value jumps significantly, which can be captured through an option pricing method.
Exactly. It's like seeing a patent or a resource as an option that pays off in specific scenarios. But here's a little critique. Don't you think that applying option pricing models to, say, patents or real assets introduces more estimation challenges? After all, the inputs aren't as readily observable as in traded financial options.
That's a valid challenge. When you're valuing something as a real option, you have to estimate things like the underlying assets variance or the appropriate strike price. And these, well, they can be a bit fuzzy compared to traded stocks. However, many argue that despite these challenges, it's better than ignoring the optionality altogether.
Indeed, it is a trade-off. And while option pricing models have their limitations, especially with long-term non-traded assets, the idea of capturing contingent benefits that DCF might undervalue is compelling.
Absolutely. And then there's also the discussion of asset-based valuation models, which some analysts add as a fourth approach. This method involves valuing individual assets, whether through liquidation, replacement costs, or even book values adjusted appropriately.
True, but it does remind me of another point. Asset-based methods are, in some cases, not alternatives to the other models, but rather supplementary. They often require using DCF or even relative pricing to estimate values like replacement costs. They're more like a complementary perspective.
Exactly right. And if we think about the overall landscape, each approach, DCF, relative, contingent claim, and even asset-based, brings something unique to the table. Their usefulness often depends on the nature of the asset being valued.
Yeah, like for stable firms with predictable cash flows, DCF is very robust. But for firms with a lot of unutilized assets or promising patents, the traditional DCF might underestimate value, hence the need for contingent claim or supplementary asset-based methods.
Precisely. And then there's the matter of circumstances where DCF itself can hit some stumbling blocks. For instance, if you're looking at a distressed firm or a cyclical firm during recessions, the estimation becomes a lot trickier.
Totally agree. I mean, when earnings are volatile or negative, predicting future cash flows becomes a nightmare. And if a firm is restructuring, with assets being sold off or new management strategies in motion, then historical data doesn't necessarily provide a reliable picture.
Yeah, it's like trying to forecast a storm when the weather patterns are completely off. But that's where the flexibility of these approaches comes in. Adjustments can be made. For instance, looking externally for the value of underutilized assets, or using option pricing to value intangible assets like patents.
Right, and even with periodic promotional anomalies, like in cyclical firms, analysts might smooth out the cash flows or use scenario analysis to capture the ups and downs more effectively. It's all about adapting the model.
Exactly. And that brings us to another key point: the importance of testing whether the cash flows being discounted belong to equity or the firm. The rule of thumb is, if the cash flows are after interest and principal payments, they're for equity. Otherwise, they're for the firm. This simple test can really help avoid mismatches in discounting.
Yes, that's such a critical detail. Misapplying discount rates can either inflate or deflate the valuation significantly, as seen in those error examples. It's almost like mixing apples with oranges. Results just don't match up.
Right, and it's really essential for analysts to be explicit about their assumptions. Whether it's the growth rate, the discount rate, or the period over which cash flows are expected, all these inputs can swing the result dramatically.
And here's a thought. When using relative valuation, the assumptions about comparable firms are equally crucial. I mean, if your set of comparables is biased, or if there's market-wide mispricing, then the average multiple might not be as meaningful. How do you see that playing out in real-world scenarios?
Oh, that's a great question. In practice, analysts need to be very careful. They might exclude outliers or adjust multiples based on differences in growth and risk profiles. It's really a delicate balancing act. Sometimes, even a small misjudgment in selecting comparables can lead to a significant valuation error.
Totally, and I'd even say there's a sort of art mixed with the science here. You compare, you adjust, and sometimes you debate which method is more reliable. Speaking of which, how would you decide between a total cash flow model versus an excess cash flow model?
Well, it's like comparing a full picture versus focusing only on the value created beyond a required return. With a total cash flow model, you discount all the generated cash flows, and with the excess cash flow approach, you add the present value of those returns in excess of the cost of capital to the invested capital. Both should lead to the same outcome if your assumptions are consistent.
Exactly.
It's like two paths leading to the same destination.
I love that analogy. But let me challenge something here. While they theoretically yield the same values, don't you think that the excess cash flow model might sometimes offer clearer insights into how much value a firm is really creating?
Yeah, I see where you're coming from. When you focus on excess returns, it really hammers home the point that it's the earnings above a required threshold that actually create value, not earnings on their own. That focus can indeed offer even sharper insights in some cases.
Exactly. It's almost like revealing the hidden bonus part of a company's performance that might be masked in aggregate cash flows. It helps to understand that not every dollar earned is a dollar of value if it simply meets the baseline requirement.
Definitely. And this conversation really underlines that while each approach, be it DCF, relative valuation, or contingent claim, is powerful, their effectiveness depends on applying the right assumptions and the correct data inputs.
Right. And it drives home the necessity for analysts to be flexible and context-driven. A one-size-fits-all method rarely works, especially when you're dealing with everything from stable, mature firms to high-growth tech startups with lots of uncertainties.
Precisely. And even the method of financing the firm, like whether you use debt or equity, plays a crucial role in the valuation. For instance, the cost of capital approach versus the adjusted present value, APV approach, shows how debt benefits, like tax deductibility, can be treated separately. It's all interconnected.
That's an excellent point. The APV method, in particular, isolates the effects of debt financing, making it easier to see the tax shield benefits versus the risks of bankruptcy. It's a nice complement to the conventional discounting methods.
Exactly. And at the end of the day, all these valuation approaches are like different lenses, each providing a unique view on what an asset is really worth. And it's our job to know which lens to choose, depending on the situation.
Absolutely. Valuation is both a rigorous quantitative exercise and, dare I say, an art form. Every method has its place, and understanding their nuances is key to making informed financial decisions.
Let's dive into the complexities of financial statements, starting with asset measurement and valuation. Essentially, these statements are the backbone for answering how valuable a firm's assets are, how they're financed, how profitable they are, and what risk is embedded in them. Would you agree that the first step is understanding what constitutes an asset?
Absolutely. It's like the foundation of the analysis. Assets can be tangible, like fixed assets, land, buildings, plant, equipment, or intangible like patents, trademarks, and even goodwill. And the concept of historical cost is key here, isn't it?
Exactly. Book value is basically the historical cost, adjusted for improvements and depreciation. Now, accountants have three core principles when valuing assets: an adherence to book value, skepticism towards market or estimated value, and a preference for conservative estimates by underestimating rather than overestimating value.
Yeah.
This approach, while conservative, sometimes hides the true economic potential of a firm, don't you think?
I do, and it often creates challenges when comparing the reported book value to the market value, especially with growth assets or internally generated intangibles like brand names or research, right?
Exactly. Now, moving to liabilities and equity, things get interesting. The statements separate financing into debt and equity. An underlying principle is that liabilities are measured at book value, similar to assets. And this means they rely heavily on historical cost, which may sometimes be at odds with current market conditions. It's almost like reading a historical record, but trying to forecast the future.
Right, and the rules are pretty strict. For example, only obligations that are unavoidable and already incurred are recorded as liabilities, and often this develops a rather conservative picture of a firm's financial obligations. And then there's the categorization between current liabilities, long-term debt, and other long-term liabilities.
Yes, and when you consider equity, accountants rely on the original proceeds from issuing stock plus earnings over time minus dividends to arrive at a book value of equity. It's interesting how firms sometimes can have negative book equity if they carry large losses or massive buybacks, even though market value can be soaring.
Yeah. That difference between book value and market value comes into sharp focus when you look at examples like Boeing versus Home Depot. Boeing might show significantly different asset and liability profiles due to its extensive fixed assets, customer financing, and even how it treats R&D expenses, compared to Home Depot's focus on current assets and a different approach to inventory valuation, like FIFO.
Right, exactly. And speaking of inventory, accounting gives us three primary methods: FIFO, LIFO, and weighted average. In periods of inflation, FIFO shows lower cost of goods sold and higher net income, while LIFO does the opposite. It's like choosing how you want your financial recipe to turn out. It's like seasoning based on market conditions.
And then we get into investments and marketable securities, where the classification, whether held to maturity, available for sale, or for trading, determines if the asset is pegged at market value or historical cost. This flexibility, while useful, can again create significant discrepancies between a firm's balance sheet valuation and its perceived market value.
Right. Switching gears to earnings and profitability. The income statement is our tool for gauging a firm's operating performance from ongoing activities. It's based on accrual accounting, where revenues and expenses are recorded in the period they're incurred, not just when cash changes hands.
Yeah, that's one of the things I actually challenge sometimes. Accrual accounting can, in certain industries, hide the timing risks of when the cash actually comes in. But I get that it provides a clearer matching of revenue and expenses to reflect true operational performance.
Right, it's a trade-off. Also, a key point is the way expenses are split into operating, financing, and capital expenses. This classification deeply influences profitability analysis. For instance, advertising expenses, which are significant for companies like Coca-Cola, are treated as operating expenses, even though they're essentially investments, much like capital expenditures for building brand equity. Would you say that's misclassified sometimes?
I do think there's room for debate. For example, many argue that advertising should be capitalized, similar to R&D, because it has future benefits. However, accountants keep it as a current period expense to avoid subjective asset valuation on the balance sheet. It's a pretty conservative approach, but it tends to understate the value of brands.
Exactly. When we look at ratios, things get even more instructive. Profitability ratios like return on assets, ROA, and return on invested capital, ROC, help separate operational efficiency from financing effects. And then the return on equity, ROE, calculates what shareholders are really earning. But again, it's based on that historical book value metric.
Absolutely, and it's interesting to decompose the ROC into the operating margin and capital turnover ratio. It shows you whether a firm is generating high profits on its sales or just leveraging high sales from its capital base. Boeing and Home Depot, for instance, in 1998, demonstrated vastly different ROC and ROE numbers, reflecting not just performance but also capital structure differences.
Yeah, I like how financial statements also try to capture risk. The primary focus is on default risk. Can the firm meet its fixed obligations? Ratios like the interest coverage ratio and fixed charges coverage ratio give us insights there. For instance, Home Depot's interest coverage ratio was extremely high compared to Boeing, suggesting lower default risk on that front.
Right, but then when you switch to a cash flow basis, like comparing cash flows to capital expenditures, sometimes the conclusions can flip. Boeing might look riskier from an operating income standpoint in one year, but its cash flow ratios can paint a different picture. I think it's a nuanced view that reflects both short-term and long-term perspectives.
Exactly. Let's not forget the liquidity measures. The current ratio and quick ratio are almost the heartbeat of working capital analysis. They tell you if a firm can cover its short-term obligations with assets that can convert quickly to cash. It's like making sure you have enough cash in your wallet before heading out on an adventure.
Great analogy. And in that context, analyzing working capital, like net working capital or non-cash working capital, provides a granular view of a company's operational efficiency. A firm like Coca-Cola, which we'll touch on in a bit, often has high levels of current assets, which need careful scrutiny against those liabilities.
Yeah, speaking about Coca-Cola, their balance sheet provides a rich field for questions. For instance, which assets are valued closer to market? Typically cash and marketable securities, because their value is less subject to estimation error. Meanwhile, fixed assets are measured at historical cost minus depreciation, which tells us less about their current market value.
Right, and if you think about it, Coca-Cola's net fixed assets could be a shadow of the original cost, since you have depreciation over time, and we have no clear indication of asset age. Also, there's a curious note that Coca-Cola has a lot more investment in current assets than fixed assets, likely because much of its manufacturing may have been moved out with the bottling divestiture back in the 1980s.
Yes. Then, on the liability side, Coca-Cola's statement clearly distinguishes between short-term borrowings and long-term debt. Analysts can calculate interest-bearing debt by summing those which reflect the firm's borrowing. In contrast, equity elements like share capital and retained earnings tell us how much capital the firm originally raised versus what's been earned over time.
Right. And it's fascinating how Coca-Cola's retained earnings far exceed its original paid-in capital. That tells a story of accumulating profits, which then, ideally, propel market value far beyond the book value. Speaking of which, the huge gap between Coca-Cola's market value of equity and its book value is typical, given the valuation of intangibles like brand name, which simply aren't captured on the balance sheet.
Exactly. That brings us back to intangibles. The brand value, arguably the most important asset for a company like Coca-Cola, is not directly reflected on the balance sheet. Instead, it shows up only in the residual goodwill that might appear after acquisitions. Adjusting the balance sheet to reflect true brand value would require a different approach, like capitalizing certain spending, even if it's typically recognized as an expense.
Yeah, right. And that debate on capitalization is also seen with advertising and R&D. For example, if you consider advertising expenses as capital expenditures, you'd have to spread these over the life of the benefits they generate, much like R&D is sometimes treated under IFRS guidelines. But current US accounting rules adhere strictly to expensing these items, which can lead to undervaluation on the balance sheet.
Exactly. Then, when we move on to profitability analysis, the income statement is the key. For Coca-Cola, examining revenues, cost of goods sold, and operating expenses gives us the operating income before interest and taxes. It's interesting to see, for example, differences across years, like 1997 versus 1998, and understand the impact of expense changes or revenue fluctuations on operating income.
Yes, and then the effective tax rate comes into play. By comparing income tax expense to pre-tax income, you can deduce changes in effective tax rates, which might reflect adjustments in tax regulations or shifts in reported income due to different expense treatments. It gives a rounded picture of net profitability.
Right. When we get to return ratios like ROA, ROC, and ROE, they really help quantify performance relative to assets and invested capital. For example, the Home Depot historically shows a much higher return on invested capital compared to Boeing, which can be linked back to their different strategies and asset compositions, and has obviously an impact on how investors see these companies.
I always find it intriguing that these ratios, while useful, are built on book values, which can be significantly different from market realities. It's a reminder that while these metrics are informative, they also require careful interpretation, right? And that's why sometimes even a company with solid operating income can appear risky if its debt ratios are high.
Speaking of debt ratios, let's break that down. The debt-equity ratio, or debt plus equity, helps us understand how leveraged a firm is. For instance, in Boeing versus Home Depot for 1998, Boeing's ratios indicate much higher leverage. This can be both good and bad. Good if the returns exceed the cost of debt, but dangerous if not.
Right, and some analysts take it a step further by using market values, particularly for the equity portion, to capture the dynamic nature of firms' financing structures. Still, it's a contentious point because market values are volatile.
Before we wrap up, let's touch briefly on additional questions from phenomena like those observed with Coca-Cola, and even a firm like Seesaw Toys in the later examples. These questions delve into working capital management, such as calculating net working capital, current and quick ratios, and assessing the riskiness from a liquidity perspective. It's crucial to consolidate that analysis for a full assessment of risk and performance.
And for Seesaw Toys, where you see a scenario involving share buybacks, the adjustments to book equity post-buyback directly influence return on equity calculations. It's a clear illustration of how corporate actions can dramatically modify financial ratios, emphasizing the importance of both beginning and average values.
Absolutely. Ultimately, when discussing financial statements, we must appreciate that they serve both as historical documents and as tools for forward-looking analysis. The conservative, sometimes static view they provide is useful weight, yet analysts frequently need to adjust for intangibles, operating lease misclassifications, and different depreciation methods to get a fuller picture. It's like looking at a map that only shows roads but omits the terrain details.
That's a great analogy. In practice, investors dig deeper, adjusting net income for non-recurring expenses, restating inventory valuations using, say, the LIFO reserve, and even reconciling differences in accounting standards between IFRS and GAAP. These adjustments help bridge the gap between reported figures and economic reality.
Exactly. And speaking of accounting standards, the shift towards IFRS has reduced some of the differences, but issues remain, especially in areas like revenue recognition, asset depreciation, and treatment of research and development. It highlights how even standardized statements need a layer of careful interpretation depending on the jurisdiction.
Yeah, I do sometimes challenge the notion that accounting conventions, with all their conservatism, adequately capture the underlying risks, particularly the broader equity risk. After all, default risk is just one aspect, while the volatility of returns around expected values matters a lot to equity investors.
Right, there's definitely a valid critique there. In conclusion, the financial statements are rich, multifaceted documents that, when read with an analytical eye, illuminate a company's asset base, financing structure, profitability, and risk profile. Our discussion today highlights both the strengths and limitations of relying solely on indicated book values, urging us to consider market adjustments and forward-looking estimates for a complete picture.
Well said. It's all about understanding the numbers in context and knowing where the inherent biases of historical cost accounting might mislead. Thanks for this engaging and deep dive into the mechanics of financial statements.
Right, thanks. Welcome to the podcast, everyone. Let's jump right into an in-depth discussion of risk and how it's measured in finance. Specifically, the various models and frameworks used in valuation. We'll explore statistical definitions, diversification, and then models like CAPM, APM, multi-factor models, and even proxy models.
Sounds great. So, we're basically comparing how risk is defined in general language to the more technical financial definition, where risk amounts deviations of actual returns from expected returns, right?
Yeah, exactly. In finance, risk isn't just about bad outcomes. It actually includes upside variability too. For instance, when we say risk, we're talking about variations in returns, measured statistically by variance or standard deviation. And these variations can capture both negative outcomes and those unexpected but positive jumps.
I like how that dual perspective, danger and opportunity, mirrors the Chinese symbols for risk. Danger and opportunity, all in one package.
Totally. It's sort of like risk has the potential to hurt you, but also to give you huge rewards, which is why investors balance between higher expected return and the danger inherent in variability. And that leads us into the whole notion of decomposing risk.
Right, the idea of breaking risk into diversifiable, firm-specific parts and non-diversifiable market risk. How critical is that differentiation?
Oh, it's absolutely crucial. Think of it like this. Imagine your portfolio as a big bowl of assorted fruits. If one fruit goes bad, it might not ruin the whole bowl if you're diversified.
Exactly.
Firm-specific risk can be largely eliminated by diversification, leaving only what we call market risk, which is the risk everyone faces.
But doesn't that assume that investors, especially the marginal investor, are actually diversified?
Yes, that's the core assumption in these models. Right, so in models like the KPM, the marginal investor is assumed to hold a well-diversified portfolio. This means that only the risk that adds to the overall market risk, is really priced. And market risk is captured by beta.
Beta is such a neat, simple way to quantify how much an asset moves relative to the market. But what about situations where beta might not capture all the risk aspects?
Good point. That's exactly where alternative models come in. The KPM, for example, is elegant due to its simplicity. Expected return, risk-free rate, plus beta X, market return minus risk-free rate. But critics say it sometimes oversimplifies because markets are more complex than just one source of risk.
So then we have the arbitrage pricing model, the APM, which allows for multiple sources of market risk. It basically says that several macroeconomic factors can influence returns.
Right, exactly. Yes, the APM lets us decompose risk into several factors, each with its own beta, so we can assess how sensitive an asset is to changes in, say, inflation, industrial production,
Correct.
or even interest rate shifts. But sometimes, those factors are more statistical than economically intuitive.
And that is where multi-factor models step in, right? They try to replace the unnamed statistical factors with identifiable economic variables.
Absolutely. Right, like using industrial production, changes in default premium, and term structure shifts. These models give us a more economic interpretation, but they come with challenges like factor instability. It's not
Indeed.
always straightforward to pin them down over time.
I also find it interesting that some argue even more alternative return distributions are needed because of fat tails and skewness.
Exactly. See, the traditional mean variance approach presumes that returns follow a normal distribution, a symmetric bell curve. But, as noted by Mandelbrot, stock prices often exhibit fat tails, meaning extreme outcomes occur more frequently.
True.
This introduces power law distributions, where the standard deviation might no longer capture risk properly.
Yeah, and then there's the argument about jump processes. Prices don't just move in a smooth curve, they can jump unexpectedly due to market events. So, models incorporating Poisson processes have been considered.
Right, you can imagine it like trying to predict the weather in a very chaotic climate. Normal models say it's mild most days with some variability, but jump models account for sudden storms, the big jumps in stock prices.
Absolutely. But then, we've also seen the rise of proxy models, like the FAMA French approach, that use firm-specific variables, such as market capitalization and price-to-book ratios. These seem to explain historical return differences better than TAPM sometimes.
That's exactly the case. Exactly. FAMA and French showed that small cap and high book-to-market stocks tend to earn higher average returns. They argue these factors serve as risk proxies, even if they're more a statistical artifact than a pure economic measure. But it does raise questions about causality versus mere correlation.
I actually find that point a bit challenging. If these proxies are merely historical and might be products of data mining, can we really rely on them for future predictions?
That's an excellent critique. Proxy models have their limitations: data mining, noisy estimates, and the risk that today's winning proxies might vanish tomorrow. It really underscores the importance of integrating economic intuition with statistical rigor.
Switching gears slightly, what about default risk models? They seem to address a different kind of risk altogether.
Right. Default risk focuses on investments with promised cash flows, like bonds. Here, the danger is in not receiving your expected payments.
Exactly.
Bond ratings by agencies such as Standard & Poor's and Moody's play a huge role, as they essentially signal the default risk.
I appreciate how the models incorporate financial ratios like EBITDA, interest expenses, ROIC, and debt ratios to estimate a firm's capacity to pay its obligations. Right. These ratios give a quantitative measure of default risk. A firm with high stable cash flows relative to debt is seen as less risky. For sure.
And the link becomes even clearer when you see that a higher default risk translates directly into a higher interest rate on a bond through what we call the default spread.
Yeah, exactly.
The spread essentially compensates investors for the higher risk of default.
It's remarkable how offering models for both equity and default risk creates a cohesive framework for valuing assets. But then, some alternative views argue for even more advanced approaches.
True. Think about models like regression or proxy models that directly tie observable variables, such as liquidity or momentum, back to returns. They bypass some of the abstract assumptions made in classical models. Yet, as we discussed, they come with their own challenges, like potential overfitting or misidentification of true risk factors.
Right, and while these models can explain historical returns well, the predictive power for future returns might not be as strong, especially if market conditions change radically.
Absolutely. And that's why Despite all the alternative models, be it CAPM, APM, multi-factor models, or even jump and proxy models, the CAPM still holds a central place. Its simplicity and intuitive appeal, combined with a reasonable performance in many markets, make it a go-to.
I see. So even if it's not perfect, the KAPM's balance between simplicity and practical utility helps it survive despite its limitations.
Exactly. It's a matter of trade-offs. More complex models might offer improved theoretical representation, but sometimes that complexity doesn't translate into drastically better predictions in practice.
Right.
In many real-world valuation scenarios, sticking with KPM or a modified version of it often makes the most sense.
Speaking of modifications, what about melded models that incorporate, say, a small cap premium into the KAPM for under-the-radar stocks?
Oh yes, those are really interesting. Analysts often adjust KAPM by adding extra premiums based on market capitalization or price-to-book ratios. This sort of hybrid approach tries to capture nuances that a one-size-fits-all model like KAPM might miss. And it helps tailor the model to different segments like small companies or illiquid stocks.
Now, what about the vast array of questions and problems that often follow these discussions in textbooks? They really tie the theoretical back to the practical, don't they?
Definitely. Those problems force us to apply our understanding of diversifiable versus market risk, estimate portfolio variances, compute betas, and even adjust for default spreads. They embody the challenge of going from theory to real-world data.
Exactly.
They push you to think, are historical variances really good predictors for the future, or can things change?
And that is the eternal question for investors. How much should you rely on historical averages and variances, knowing that market conditions, volatility regimes, and even investor behavior can shift?
Right. It's a delicate balancing act. Ultimately, understanding these risk models, whether through KAPM, multi-factor approaches, or default risk measures, and their underlying assumptions lets investors make more informed decisions.
Yeah, absolutely.
And while no model is perfect, knowing their strengths and weaknesses is key to effective valuation and risk management. Welcome to this session. Let's dive into some deep insights on option pricing theory, where we explore how the value of an option is derived from the underlying asset and the unique cash flow characteristics that challenge the standard present value framework.
Yeah, absolutely. So to kick it off, what sets options apart from, say, regular assets? How do their cash flows differ?
Great question. Options are unique because they derive their value from other assets, and their cash flows only materialize if specific events occur. So, unlike a typical asset where you discount expected cash flows, options need special attention since they come with the right, but not the obligation, to buy or sell an underlying asset at a fixed price by a certain expiration date.
Right. That makes sense. And we basically have call options, which let you buy, and put options, which allow you to sell at predetermined prices, correct?
Exactly. A call option gives you the right to buy an asset at the strike price, aiming to profit when the market price exceeds that strike, while a put option does the reverse, giving you the right to sell when the market price falls below the strike. It's like having insurance, but for upside or downside moves.
Yeah, I find the payoff diagrams really fascinating. They show how the net payoff is determined. Like for a call, if the asset's price is below the strike, you're essentially losing what you paid. But beyond that, you gain the difference, minus that initial cost.
You got it. These diagrams visually capture the risk and reward profile. For instance, a call option's payoff remains negative below the strike price and turns positive. Essentially, the difference between the asset's price and the strike once you're above it. For puts, it's the opposite. It's like a mirror image.
Exactly. Now, aside from these basic mechanics, what are the main factors or determinants that drive the value of an option?
There are 6 key variables. First, the current price of the underlying asset obviously matters. Second, the variance or volatility of the asset's price is crucial. And counterintuitively, higher volatility increases the option's value since your potential for significant moves is greater. Third, expected dividends come into play. They reduce call values, but raise put values because dividends lower the underlying asset's price. Fourth is the strike price itself. Fifth, it's the time remaining until expiration. More time means more potential for advantageous moves. And lastly, the riskless interest rate factors in because of the present value calculation of the strike price when you exercise.
Yes, right. That lineup is very comprehensive. It reminds me of the idea of replicating portfolios, where you create a portfolio of the underlying asset and risk-free borrowing or lending to mimic an option's payoff.
Spot on. The replicating portfolio method is the backbone of both the binomial model and the Black-Scholes model. You essentially determine how many units of the asset you need, what's called the option delta, and how much you have to borrow so that the portfolio mimics the option's cash flows exactly.
Absolutely. Talking about the binomial model, can you break down how it works in practice?
Sure. The binomial model treats the asset price as making one of two moves, up or down, in each small time period. For each of these nodes, you calculate the option's potential payoff and then work backwards iteratively to today's value, ensuring that arbitrage opportunities don't exist. Essentially, you're replicating the option's cash flows at every node using a combination of the underlying asset and risk-free bonds.
And this process, iteratively moving backward, is kind of like peeling back layers until you get to the current time?
Exactly. It's like working from the future backwards. At every stage, you build a mini replicating portfolio, and by the time you reach time zero, you have the current value of the option. It's very methodical, yet intuitive.
Now, shifting gears to the Black-Scholes model, which seems to be the go-to for valuing European options, what are its core underpinnings?
The Black-Scholes model, developed by Black and Scholes, essentially refines the replicating portfolio idea for a continuous price process. It assumes that prices change in small, continuous increments. The value for a call is given by S multiplied by N D1 minus K times the exponential discount factor, E RT multiplied by N D2. Here, D1 and D2 are functions of the current asset price, strike, risk-free rate, time to expiration, and specifically the volatility of the asset. It's elegant because it boils down a complex pricing problem into a formula that relies on a few well-defined inputs.
Yes, and it really revolutionized how we think about option pricing. I remember that one of the intriguing aspects is how the probabilities from cumulative normal distribution, ND1 and ND2, play into it. They not only help in calculating the call's value, but also indicate the likelihood that the option will finish in the money, right?
Right you are. ND2 approximates the chance that you'll indeed see a payoff, like predicting that the underlying is above the strike for a call or below for a put. And ND1 represents the hedge ratio, or delta, indicating how many shares you'd need to replicate the option. It's like having a cheat sheet for both the probability and the replication strategy.
Exactly. I also find it interesting how the model adjusts for dividends, especially when dealing with dividend-paying stocks. How does that work?
Good point. Dividends are a bit of a twist because they effectively reduce the asset's price when paid. For short-term options, you adjust the stock price by subtracting the present value of expected dividends during the option's life. For long-term options, you might use a dividend yield to adjust the model. The modifications ensure that the expected drop due to the dividend is factored in, which in turn lowers call option values while boosting put option values.
Yeah, it's a clever adjustment. Now, one area that often stirs debate is the concept of implied volatility. What's the idea behind it?
So implied volatility is essentially the volatility input that, when plugged into the Black-Scholes formula, makes the theoretical price of the option equal to the market price. Because historical volatility might differ from what the market expects, you can back out the implied volatility from market prices. It's a neat feedback mechanism. If the measured volatility is lower than what the market price suggests, then the market is implying that higher volatility is expected.
That's so insightful. But some critics argue that the Black-Scholes model has limitations, particularly regarding American options and the possibility of early exercise, right?
Yes, that's a valid critique. Black-Scholes works best for European options, which can only be exercised at expiration. American options can be exercised early, often because of dividends or deep-in-the-money scenarios. To handle this, a pseudo-American valuation is often used, where you calculate option values at each ex-dividend date and select the maximum one. Alternatively, the binomial model is better suited because it can capture these early exercise opportunities by considering cash flows at each node.
Right, That makes me wonder about compound options and even rainbow options, which introduce multiple layers of underlying uncertainties. How do they fit into this framework?
Compound options are options on options, meaning their value derives not from an asset directly, but from another option. Their valuation usually requires more complex techniques, often involving a bivariate normal distribution. Rainbow options, on the other hand, deal with multiple sources of uncertainty, say, two different underlying assets. These options can be more complicated to value, since the payoff depends on the joint movement of both assets. In both cases, the basic tenets of replicating portfolios and risk-neutral valuation remain, but the mathematics becomes more intricate.
Exactly, I see how the complexity ramps up. Speaking of complexity, how does the jump diffusion model come into play when price changes are not always continuous?
Great point. The jump diffusion model acknowledges that asset prices sometimes experience abrupt, significant moves, jumps, rather than smooth transitions. Merton's model is a classic example where jumps are superimposed on a continuous process. This allows us to capture the rare, high-impact events. But, honestly, the challenge is accurately estimating the jump parameters, like the frequency and average size of the jumps, which often means the model's practical use is limited despite its realism.
Yeah, that's a fair critique. Now let's circle back to replicating portfolios. In the binomial framework, you mentioned that at each step, we create a mini portfolio composed of some shares and borrowing amount. Could you break down that process a bit more, maybe with an example?
Certainly. Consider a simple binomial tree where the stock price, S, can either go up to SU or down to SED. To replicate a call option's payoff, you calculate delta as the difference in call values over the difference in stock prices. The ORS, SU, CD, ORS, SU, SD. Then, you solve for the borrowing amount needed, so that the combined value of D shares minus the borrowed amount matches the call payoff at each node. In one of the illustrations, for instance, borrowing $8 and buying one share replicated the call when the stock hit $70, leading to a payoff that exactly matched the call's value.
Right, that's quite intuitive. I also noticed that when transitioning from the continuous Black-Scholes model to a discrete binomial tree, you can actually derive the up and down factors from the volatility and time period. How does that work?
Yes, that involves using exponential functions of volatility times the square root of the time step. Essentially, U large xp sdt plus r s2 2 dt and d large xp sdt plus r s2 2 dt. This conversion ensures that the discrete model approximates the continuous process as the time periods get shorter. It's like bridging the gap between continuous math and the practical step-by-step decision-making process.
And finally, regarding put options, there's this neat derivation through put-call parity. Can you elaborate on that?
Sure thing. Put-call parity states that the value of a call minus the value of a put equals the current asset price minus the present value of the strike price, or C, P sur S, key, RT. This fundamental relationship ensures that arbitrage opportunities are eliminated. So by knowing, say, the call's value, you can immediately derive the corresponding put's price. It's a cornerstone of options pricing that ties everything together.
Yes, absolutely. I have to say the range of topics we've explored is quite impressive, from basic definitions to advanced models like jump diffusion and compound options. Yet it also shows the limitations of each model and where real-world complexities like early exercise and dilution come into play.
Right, and that's exactly the beauty and challenge of option pricing. While models like Black-Scholes and the binomial provide a solid framework, each comes with assumptions that sometimes diverge from reality. For example, early exercise issues in American options, and the impact of dilution when exercising warrants require additional adjustments or even iterative estimation methods.
Yeah, I agree. Before we wrap up, how do these theoretical models translate to practical applications? I mean, especially with the practice problems and tables, like the ones for Microsoft or Merck options listed, how do practitioners leverage these insights?
In practice, these models are used extensively to price not only traditional options, but also real options in capital budgeting and corporate finance. Analysts input market data like underlying prices, volatility estimates, interest rates, and dividend expectations to calibrate the models. They also use the replicating portfolio approach to create hedging strategies. The exercises, like replicating specific calls or using put-call parity for puts, help ensure that any mispricing and hence arbitrage is minimized. It's a rigorous process that blends theory with real-world data.
Absolutely, that's very practical. I have one more thought. While these models are mathematically robust, do you think there's a risk that over-reliance on them might lead investors to overlook market nuances not captured by the model inputs?
That's a fair challenge. The models assume efficiency and certain statistical regularities, but market conditions can deviate, especially in times of stress or when unforeseen events trigger jump processes. So, while these models provide an excellent baseline, it's critical to supplement model outputs with qualitative insights and sometimes stress testing. It's definitely a balance between model precision and market intuition.
Well, this has been a fascinating exploration of option pricing theory, from the basics of call and put options to the advanced intricacies of compound and rainbow options. It really shows how layered and dynamic this field is.
Indeed, the journey through theoretical frameworks like Black-Scholes, the binomial model, and even jump diffusion models reveals the underlying mechanics that form the backbone of modern finance. And with all the practical examples and problems, like those on Microsoft, or the real-world application for Avatec Corporation's warrants, we see theory in action.
I think our discussion today really highlights both the power and the limitations of these models. It's a reminder that while the mathematics can guide us, the market always has its own mind.
Well said. And that interplay is exactly what makes the field so exciting and at times so unpredictable. Thanks for the engaging conversation. It's been quite the deep dive into option pricing theory.
Thank you as well. This conversation has been both enlightening and, refreshingly detailed. Looking forward to our next chat on the nuances of financial modeling.
Welcome, everyone. Today we're diving deep into the concept of market efficiency and its implications for investment and valuation models. It's fascinating how efficient markets are defined as those where the market price is an unbiased estimate of true value, even though deviations exist, but they're random, right?
Right, so we're saying deviations can be above or below true value, but if they're random, then no predictable pattern is obtainable. Am I getting that right?
Exactly. And that's one of the core pillars here. If errors are unbiased, then no investor can consistently exploit them using any systematic investment strategy. This view, for instance, underlies the idea that you can't simply beat the market by picking stocks based solely on, say, low PE ratios or historical price patterns.
Yeah, no. But isn't it interesting how, despite this reasoning, we see a lot of evidence suggesting that certain anomalies, like the small firm effect or low PE premium, seem to offer excess returns?
Absolutely. That's where the debate heats up. On one hand, if the market were perfectly efficient, the price would always reflect all available information, be it past prices in a weak form scenario or even insider information in a strong form efficiency. But on the other hand, numerous studies point out that small firms with low price earnings or price-book value ratios have historically generated higher returns than what the market would predict.
Yeah. So then, does that mean there's a disconnect with the idea of efficiency? Or is it more that these anomalies are simply risk premiums not captured by traditional models like the CAPM?
That's a great question. Some argue that these excess returns may in fact compensate for additional, perhaps unmodeled risks, like estimation risk for small firms or liquidity constraints. For instance, one explanation is that small firm stocks are harder to trade, so higher transaction costs and less available information add an inherent risk that's not captured in beta.
I see. So it's not that the market is inefficient per se, but that maybe our risk models are incomplete. But I've also seen arguments that the very act of exploiting these inefficiencies would cause them to disappear over time.
Exactly right. And that's why the necessary condition for market efficiency is the self-correcting nature of markets. Once profit-seeking investors start exploiting an inefficiency, they trade on it until it vanishes. It's like if stocks with low PE ratios start getting bought up, the prices adjust and the premium shrinks.
Interesting, yes. So how do we actually test these ideas in a rigorous way? I recall there's talk of event studies and portfolio studies as the two primary methods.
Right. Event studies, for instance, dive into how market prices react around information events, like earnings announcements or merger announcements. They track the abnormal returns around these events to see whether the reaction is immediate, gradual, or even overcorrects. For example, if a merger announcement causes a positive drift in price post-event, that might indicate a slow learning market.
And portfolio studies involve grouping stocks based on some observable characteristics, right? Like classifying by price-earnings ratios or market capitalization, and then comparing their returns over time.
Exactly. They create portfolios of stocks with distinctive characteristics, say, firms with the lowest PE ratios in one portfolio and the highest in another, and then test if, statistically, the returns differ in a way that's not just random noise. And tested over multiple periods, these approaches help determine if anomalies are consistent or just flukes.
Now, one thing that always caught my attention was the idea of the momentum effect in short-term returns versus the reversal effect over longer periods. How does that fit in with efficient market theory?
Great point. In shorter time frames, such as weeks or months, you sometimes see momentum. Stocks that have been rising continue to rise, and vice versa. But over a multi-year horizon, often there's a reversal effect. One explanation is that investors overreact to news in the short run, a behavioral bias, and eventually correct their mistakes. So, while price trends may persist briefly, over the long term, prices tend to revert closer to their intrinsic values, which is more consistent with efficiency once you allow for human factors.
Speaking of human factors, what about behavioral finance? It's got a lot of critical chatter around investor irrationality, herding, and all that. How does that challenge the efficient market hypothesis?
You're touching upon a very contentious point. Behavioral finance, especially with roots in studies like Shiller's irrational exuberance, suggests that investors often exhibit predictable irrational behaviors. For example, there's evidence from experimental studies where even in simplified trading environments, bubbles form and prices momentarily exceed fundamental values. These observations imply that psychological factors can drive markets away from efficiency, at least temporarily.
Yeah, that's intriguing. I sometimes wonder, though, isn't it possible that once these irrationalities are observed, other market participants jump in and the market self-corrects much as you described earlier?
Absolutely, and that's a key point. Even if investors behave irrationally at times, profit-seeking arbitrageurs eventually spot and exploit the mispricing, pushing prices back in line. It's a cycle where, in aggregate, markets tend to remain efficient over the long term, even if there are intermittent periods of inefficiency.
Indeed. One thing caught my eye, a discussion about the effects of insider trading and analyst recommendations. It appears that while insiders might have an edge, their benefit tends to vanish once the information becomes widely available. Is that what the evidence shows?
Exactly. Early studies showed that insider buys and sells had a noticeable impact on stock prices, but once everyone had access to that data, the potential for arbitrage reduced significantly. Similarly, analyst recommendations tend to cause immediate price adjustments. the market reacts, and any further drift is usually minimal. This again reinforces the idea that once information is public, the market is quick to absorb it and correct mispricing.
So, if I understand correctly, the consensus is that while isolated studies can demonstrate anomalies like the January effect or small firm premiums, in practice, these patterns are too difficult to consistently exploit due to transaction costs, execution challenges, and the inherent unpredictability of the short term.
Yes, exactly. Consider the January effect. While returns in January tend to be higher, especially for small stocks, the cost of trading frequently, or the risk that these patterns don't hold every year, dampens the potential for excess profits. Moreover, if many investors start chasing these anomalies, they too get arbitraged away as the anomalies disappear.
I'd like to challenge a bit, though. It seems to me that many of these studies, while statistically significant over long periods, may not be practically exploitable for most investors. The models seem to assume perfect execution with negligible transaction costs. Isn't that a fair critique?
That's a very valid point. In theory, if executing the strategy incurs even modest costs or the market is highly competitive, then the potential excess returns are eroded. So, while studies reveal these inefficiencies, converting them into real-world profits is a whole different ballgame.
On the topic of execution, the text also highlights testing pitfalls like self-selection bias in samples, or using the same data set to both develop and test an investment strategy. I find it fascinating how much care is needed to avoid these cardinal sins in research.
Absolutely. Researchers need to be extremely cautious to ensure they're not using anecdotal evidence or overfitting models. For example, if you test a strategy on the exact same period from which you derived it, you end up with results that are, well, predictably over-optimized. This is a well-known pitfall that can lead to incorrect claims about market efficiency or inefficiency.
Yeah, and then there's the matter of survival bias, studying only firms that have survived over a long period, which can overly inflate the apparent success of certain investment strategies. It really adds a layer of complexity to interpreting these findings.
Right. And survival bias can make a strategy look effective in hindsight, even if it wouldn't work in real time. It reminds us that the robustness of an investment theory must be examined from multiple angles, including the test's sensitivity to different risk adjustments and market conditions.
Before we wrap up, let's consider market efficiency from the perspective of money managers. The evidence seems mixed. Many studies, like Jensen's early one, indicate that actively managed funds rarely outperform the market in the long run.
Exactly. The data on mutual fund performance, for instance, shows that only a small fraction of money managers consistently beat the market. Even if some active managers may have brief, hot hands, once transaction costs and other practical issues are factored in, the margin for excess returns tends to vanish. It really underscores the advantage of passive investment strategies in efficient markets.
Indeed. So, if I were to sum it all up, the market efficiency hypothesis suggests that while anomalies exist, they're often too subtle or too costly to exploit consistently, especially when you take into account real-world trading frictions. Would you agree?
Absolutely. The market is, in many ways, self-correcting. Even when inefficiencies arise, they tend to be exploited quickly. What it really shows is that perfect efficiency may be a theoretical ideal, but even the real, messy markets we see still operate in a very competitive and self-adjusting manner.
It's like, despite the allure of arbitrage opportunities hinted at in academic studies, the practical constraints like, transaction costs, risk control, and market impact make consistent market outperformance extremely challenging, correct?
Exactly. And that is why, as much as these findings are intellectually stimulating, they call for a healthy dose of humility. Even the best investors understand that beating the market consistently requires not just an edge in information, but also the ability to execute at very low costs, something that's hard to achieve in practice.
Yeah, absolutely. Before we go, any final thoughts on how these academic findings might influence the average investor's strategy?
Sure. For most investors, a strategy that minimizes transaction costs, like indexing or low turnover portfolios, might be the best approach. The research on efficiency tells us that active strategies, while potentially alluring in theory, often don't pay off when you consider all the execution barriers. It's all about finding that balance between theoretical models and practical realities.
Well, that was a fascinating deep dive into market efficiency, testing methods, and the empirical evidence surrounding market anomalies. Thanks for sharing your insights.
Anytime. It's been great unpacking these complex topics together. Remember, whether markets are efficient or not, it makes us all appreciate the intricate dance between theory and practice in finance.
Right. Thanks for tuning in, and until next time, keep questioning and exploring the fascinating world of finance.
Welcome, everyone. Let's dive into the world of riskless rates and risk premiums, where we cover everything from determining a true risk-free asset to estimating equity risk premiums using historical data and market-implied methods.
Yeah, absolutely. Right, so what exactly do we mean by a riskless rate in these models? It's basically the benchmark, what investors expect from a secure government-issued security that's free of default and reinvestment risk, right?
Exactly. The idea is that the risk-free rate should be anchored on instruments such as government zero-coupon bonds. You see, because there's no reinvestment risk, if you have a zero-coupon bond that fully matches the cash flow horizon, say 5 years, then that's the cleanest measure.
Yep, but here's a twist. Most people default to, like, treasury bills. However, a 6-month T-bill isn't risk-free, at least for longer-term cash flows, right?
Right, because a 6-month T-bill carries reinvestment risk if you're discounting cash flows over a 5-year span. You don't know what rates you'll get in the future. It's like expecting a steady river flow, but instead you get rapids every few months.
Absolutely. So, in practice, if you're valuing something over, say, 5 or 10 years, you'd align the duration of the government bond with the cash flows. That's where long-term government bonds come in, correct?
Correct. It's almost like matching your shoes to your suit. You need consistency. Also, consistency matters not only in duration, but in currency terms. If cash flows are in US dollars, then you use a US Treasury bond rate.
Consistency is key. Now, moving on to the risk premium, the extra return demanded by equity investors over this risk-free rate, how is that typically measured?
Well, the traditional approach is to examine historical data, stocks versus default-free bonds. The idea is the premium you get over long horizons, say, using historical returns from 1928 to 2010, can be computed as an arithmetic or geometric average.
Exactly, though each method has its nuances. Right, the arithmetic average tends to overstate the premium because it doesn't account for volatility and negative serial correlation in returns, whereas the geometric average might be lower by reflecting compounding effects over time.
Yeah, and that's why some argue for using the geometric average, like 4.31% for US stocks over Treasury bonds over a long period, as a benchmark. But then you also have models like KPM, where the expected return equals the risk-free rate plus beta times the market risk premium.
Totally. And speaking of betas and models, multi-factor models extend this idea by adding more risk premiums, one for each market risk factor, right?
Exactly. With multi-factor models, you're not just stuck with beta relative to the market portfolio. Instead, you have betas for macroeconomic factors like inflation, interest rate risk, or even commodities, making the estimation richer.
Sense. Now, one interesting aspect is the application in emerging markets, where historical data might be volatile or even sparse. How do we measure risk premiums there?
Good question. In those cases, you either have to use a build-up approach or currency conversion methods. For instance, if you're in a country like India or Indonesia, you might start with a default-free rate in a mature market and then add a country premium, which accounts for extra risk specific to that market.
Right, because emerging market risk, the country risk premium, is very much a real phenomenon. I've also heard about approaches using credit default swap spreads against local currency bonds. That's a dynamic measure, isn't it?
Absolutely. CDS spreads provide near real-time updates on default risk. For example, if Brazil's CDS is trading at 0.75% over US Treasury, while its government bond yield is 8.25%, you back out the risk-free rate in the local currency. It's like peeling an onion, each layer representing a different risk factor.
Yeah, exactly. But wait, some critics argue that using default spreads from the bonds might inadvertently double count risk if the risk premium is also adjusted. How do you see that?
Right, and that's a valid critique. If you take a bond's yield, which already incorporates the default spread, and then add an equity risk premium adjustment for additional country risk, you might overstate the premium. It's a delicate balance. You need to ensure you're not stacking premiums on top of each other.
Yeah, makes sense. Now, aside from historical premiums, another approach mentioned is the market-implied equity premium, where you derive the premium from present value models of dividends and cash flows. Can you explain that?
Sure. Essentially, you use a dividend discount model or any cash flow model where you isolate the required return that makes the model's valuation equal to the current market price. Subtracting the risk-free rate then yields the implied premium. For example, if the S&P 500 index is at 900 with a dividend yield of 2% and expected growth of 7%, then solving for the required return yields about 9%. That extra 3% is the implied premium.
Yeah, pretty neat, huh? It really is. And what's interesting is that historical and implied premiums often differ. Market sentiment and economic conditions, like inflation spikes, can influence the implied premium more dynamically.
Absolutely. Take the 1970s. Implied premiums spiked with rising inflation, whereas historical averages, which smooth out fluctuations, might not catch that momentary spike as clearly.
Right, because historical data lags current market conditions. There's also that point about mean reversion. Implied premiums tend to drift back towards historical averages over longer periods, don't they?
Yes, and that leads to strategic decisions when valuing companies. For instance, analysts might average implied premiums over a decade to counteract short-term market oscillations.
Delving into equity risk, the content also touches on how risk should only be compensated if it's non-diversifiable. They talk about separating firm-specific risk from market risk, correct?
Exactly. Only the market risk, the risk that affects a large group or the whole market, should get rewarded. The idea is that if you can diversify away a firm's unique risk, why should you pay extra for it?
Yeah, that's a cornerstone of diversified portfolio theory. And when we consider country risk, there's even more nuance. There's debate over whether country risk is diversifiable, right?
Right. Even if globally diversified investors might, in theory, eliminate country risk, in practice, many investors have a home bias. So country risk premiums are often added because non-US markets might carry additional risks that are not easily diversified.
Absolutely, makes sense. Some models even introduce a lambda factor to adjust for a company's specific exposure to country risk versus general market risk. Can you elaborate?
Sure. Basically, instead of assuming every company in a risky country absorbs the full country premium, you assign a lambda, say 0.50, to capture that a firm like Petrobras, which earns many dollars from global oil sales, is less exposed to local country risk than a purely domestic firm.
Yeah, that's a really targeted approach. It's interesting to see how these adjustments can change the cost of equity. For example, depending on whether you add a flat country premium or multiply it by beta, you could end up with noticeably different estimates, right?
Exactly. And that's why methodological clarity is so important. If you simply add a default spread from, say, a Brazilian bond, overestimating risk is easy if you then also adjust beta. Meticulous matching of inputs, like using the same treasury bond rate and carefully selecting the risk measure, is key.
Yeah, definitely. Let's also not forget about the calculation pitfalls. The conversation noted standard errors in historical risk premium estimates, right? Shorter timeframes can produce high standard errors, making them unreliable.
Absolutely. The standard error diminishes only with a long time period. For example, using only a 10-year period may give you a standard error nearly as high as the estimated premium, which could throw off your entire valuation if not carefully adjusted.
From historical data. Speaking of adjustments, another technique mentioned is converting risk-free rates from one currency to another using expected inflation differences. For instance, if the US risk-free rate is 4%, but an emerging market like Indonesia might have expected inflation of 11%, you can convert that to an Indonesian risk-free rate. How does that work?
Right, the conversion essentially multiplies the US rate by a ratio of the expected inflation factors. So if you have 1.04 multiplied by the inflation ratio, you'd end up with a risk-free rate in the local currency. This keeps the valuation consistent across currencies, which is super crucial in today's global markets.
Definitely matters. And in some cases, if you can't determine a proper risk-free rate in a particular currency because of a lack of instruments, you might have to switch and do the valuation in a more stable currency, right?
Exactly. It's not ideal, but sometimes necessary. For example, if a Nigerian company doesn't have local currency bonds or reliable forward contracts, you might value it in dollars or euros and then adjust using anticipated exchange rate movements.
Right on. Coming back to equity risk premiums overall, the debate between using historical versus implied premiums seems quite central. How do you decide which one to use?
It really depends on your market view and valuation mission. If you trust current market pricing, then the current implied premium might be best. On the other hand, if you believe in mean reversion and think markets overreact, a historical or averaged implied premium might be preferable.
Yeah, and that decision has huge implications on cost of equity estimates. I also read that during different economic cycles, there could be significant divergence. For instance, during the dot-com bubble or the 2008 crisis, the implied premiums went into extremes compared to historical norms.
Right, and those extremes are usually short-lived. Hence, many practitioners, like equity analysts and valuation experts, prefer to average over a longer horizon to smooth out these shocks, which usually helps in achieving a market-neutral stance.
Absolutely, averaging can cut through the noise. It seems then that in a world where risk measurement is so nuanced, the core challenge remains keeping all inputs consistent and avoiding pitfalls like double counting risk. That's the crux of it, isn't it?
Exactly. It's like a balancing act. You have to align risk-free rates with cash flow currencies, carefully match historical data with current market measures, and be very cautious about not overcompensating for country-specific risks. When done right, the model becomes a powerful tool for both portfolio management and corporate valuation.
Right, that balance is absolutely critical. This discussion really highlights how integrated these components are in financial modeling. From riskless rates to country risk premiums, each factor, even with a bit of estimation error, collectively influences our investment decisions.
Yes, and it's a reminder that even small oversights, like neglecting reinvestment risk or misestimating the historical period, can lead to significant or double counts in risk pricing. It calls for a rigorous and methodical approach in every step.
Definitely, every little detail counts. I love how this ties back to the broader perspective. Whether we're considering matured markets like the US or emerging ones with high volatility, the underlying principles remain the same, though the inputs differ. Correct?
Exactly. The framework is robust. It's just the parameters that require adjustment. Keep your risk-free rate, cash flow estimations, and country risk premiums consistent with the asset's characteristics, and you'll always have a reliable valuation model.
Indeed, that consistency really does tie it all together. All right, this has been a thrilling journey through riskless rates and risk premiums. It's fascinating how finance, with all its technical details and inherent uncertainties, still boils down to understanding risk properly.
Exactly, and we've seen that while numbers and models provide structure, it's the judgment in setting the parameters that ultimately drive your valuation. Thanks for this engaging conversation.
Absolutely, thank you.
Welcome everyone. Today we're diving into the details about estimating risk parameters and the cost of financing for firms. We're looking at everything from cost of equity to regression betas, bottom-up betas, and even the intricacies of cost of debt.
Absolutely, it's a lot to unpack. Risk estimations, beta adjustments, leveraging, operating leases. It's like peeling an onion, layer by layer.
Right. So, let's start with the foundation, the cost of equity. Fundamentally, what investors require from an equity investment includes compensation for market risk, measured by beta, plus a riskless rate and risk premium. It's essentially stated as expected return Riskless rate plus beta times risk premium.
Yep, and that equation is at the heart of the KPM. But things get interesting when we actually have to estimate beta, doesn't it?
Exactly. And there are a few approaches. The traditional method is regression-based beta, where we regress stock returns on market returns using data from a chosen time period, return interval, and market index. However, this method often leads to high standard errors, meaning the beta estimates can be pretty noisy. That volatility can really distort the picture of risk.
Right, and especially when the index is dominated by one or a few stocks, like Nokia's case on the Helsinki index. The beta might show low error, but could be misleading if it's really just regressing a stock against itself.
Yes, indeed. That's why there's an alternative, bottom-up beta estimation. Instead of relying solely on historical price regressions, this method breaks down a firm into its business segments, estimates unlevered betas for each, and then recombines them using value weights. It's like constructing a detailed mosaic of the firm's underlying risk.
I love how this method allows adjustments for changing business mix and financial leverage, especially when a company undergoes restructurings or acquisitions. It provides a forward-looking view of risk, not just a backward glance.
Exactly. Take Boeing, for example. Historically, regression might have given them a beta around 0.56 over a certain period, but following major acquisitions and an increase in leverage, their bottom-up beta calculation provided a much truer estimate, closer to 0.96 or so. It really underscores the importance of reflecting current operations.
That's a pretty significant difference. But don't you think that sometimes the adjustments used by rating services to push betas towards one, like Bloomberg's adjusted beta formula, can appear a bit arbitrary?
I agree. While empirical evidence shows that betas tend to revert to 1 over time, the fixed weights of, say, 0.67 and 0.33 can mask firm-specific risks. In a way, it sacrifices precision for uniformity. It's a balancing act.
Right. And then we also have the fundamental beta approach, where we consider the determinants of beta, the type of business, operating leverage, and financial leverage. This helps explain why cyclical firms typically have higher betas compared to non-cyclical ones.
Exactly. Cyclical firms in, say, automobiles will have higher betas because their product demand is so discretionary. And the operating leverage part, firms with high fixed costs show more variability in operating income, boosting beta. It's like when you have a lot invested in fixed costs, even a small change in sales can cause a big swing in earnings.
And speaking of financial leverage, increasing a firm's debt-to-equity ratio directly amplifies the equity beta. For instance, Boeing's beta rises as debt increases through acquisitions.
Yes, precisely. And that concept is formalized in the relationship between levered and unlevered betas. The formula shows that as debt increases, so does equity risk, because the firm's fixed interest obligations magnify the sensitivity of equity returns to market movements.
Now, moving over to cost of debt, it's fascinating how the cost isn't merely the interest rate. The default risk, reflected by spreads and tax advantages, are key to that calculation.
For sure. The after-tax cost of debt is given by pre-tax cost multiplied by 1 tax rate. So, for a firm with a debt rating, if it's, say, an AA rating, you might add about 1% over the riskless rate. But if no rating exists, then analysts have to estimate a synthetic rating based on financial ratios such as interest coverage.
Right. And that's where tables like the ones matching interest coverage ratios to ratings come in handy. They simplify the process even if they are not perfect. And then there's the adjustment for operating leases, capitalizing them to reflect all fixed commitments as debt.
Absolutely. Operating leases can be seen as off-balance sheet debt, and converting them into their present value is essential for getting an accurate debt ratio. For example, Boeing's leases needed to be capitalized, effectively increasing its total debt.
That's a crucial point because the weights of debt and equity in cost of capital calculations have to be based on market values, not book values. Market value ratios reflect current market sentiment and risk, whereas book values can be outdated.
Right. For instance, Boeing's market value debt ratio was significantly lower than the book value ratio, which impacts the computed cost of capital. When combining cost of equity, after-tax cost of debt, and so on, you have to weight them appropriately.
Speaking of cost of capital, the final goal is to combine all financing components, debt, equity, and even hybrid securities like preferred stock, into a weighted average cost of capital, WACC. The formula, as we know, is KE, equity total, plus KD, debt total, plus KPS, preferred total.
Exactly. And the cost of capital gives firms and investors a benchmark for what return they must achieve to satisfy all capital contributors. For instance, with Boeing, estimates around December 2000 showed a cost of capital near 9.5%, balancing both its equity and debt costs.
And then you have real-world examples like Embraer, where country risk factors come into play. In emerging markets, we sometimes have to adjust the risk premium to account for country-specific risks, using something called lambda.
Yes, lambda measures a company's exposure to country risk based on revenue breakdowns or through regressions on country bonds. For Embraer, for example, the cost of equity would differ depending on whether you include the country risk premium or not. The estimates can really swing the final numbers.
It's interesting how even tiny adjustments, like whether to include all of the country default spread in the cost of debt or only part of it, can affect a firm's estimated cost. It shows the sensitivity of these models to input assumptions.
Definitely. And then there's the debate on small firm premiums. Empirical data sometimes shows that smaller companies earn higher returns than what CAPM suggests, so some analysts add a small firm premium, often around 4%, though that comes with its own challenges.
I actually find that point a bit contentious. While historical data might validate a small firm premium, it's important not to double count risk factors that are already embedded in the beta. It requires a delicate balance. Would you say that's fair?
Absolutely fair. It's a proper critique. If you add too many adjustments, you run the risk of overestimating costs, especially if some of those risks will dissipate as the company grows.
So, just to tie it all together, we start by computing the riskless rate and market risk premium, then measure beta, whether regression-based or bottom-up, and adjust for operating and financial leverage. This gives us the cost of equity. In parallel, we determine the cost of debt by estimating default spreads, adjusting for tax benefits, and even capitalizing operating leases. Finally, using market values, we blend these into a weighted average cost of capital.
Exactly, and that weighted average cost of capital is a critical benchmark in discounted cash flow valuations. It reflects what a company must earn on its investments to satisfy both shareholders and debt holders. It serves as a hurdle rate.
And these methodologies are not just limited to public companies. They extend to private firms, divisions, even companies with complex capital structures. That flexibility is what makes the bottom-up beta method especially attractive.
Exactly. And even then, practitioners have to make judgment calls, choosing estimation periods, deciding on the appropriate market index, and reconciling differences between historical and implied risk premiums. It's as much an art as it is a science, requiring both quantitative rigor and qualitative insights.
I love that perspective. It really highlights why finance professionals debate these methods so passionately. One misstep in assumptions could lead to significantly different valuation outcomes, especially in strategic decisions like acquisitions or divestitures.
Indeed. And while our discussion so far has covered regression betas, fundamental determinants, debt cost, and WACC calculations, the practical applications extend to case problems. Consider the illustrative problems in the literature where one must estimate a firm's beta after a leveraged buyout, or calculate how operating changes affect the beta post-divestiture. These real-world exercises remind us that these models must be tailored to each situation.
It's a fascinating field, balancing historical data, market perceptions, and firm-specific nuances. Our discussion today definitely brings out the need for careful judgment in these estimations.
Absolutely. Thanks for the great conversation. Whether you're a student, an analyst, or just curious about finance, understanding these concepts is essential for accurately assessing a firm's risk and financing costs.
And thanks for the insightful breakdown. It always amazes me how a deep dive into betas and cost structures can reveal so much about a company's financial health and strategic direction.
Indeed, we hope our listeners found this conversation engaging and helpful in navigating this complex but fascinating area of corporate finance. Until next time. Welcome to the podcast. Let's dive into the intricacies of measuring earnings. So, the discussion starts with the idea that reported accounting earnings often differ significantly from what we would call true earnings. And that's something investors have to adjust for.
Right.
It's fascinating, isn't it?
Absolutely. The point is that operating earnings like EBIT or net income need these adjustments because the accounting statements don't always capture the economic reality. We see that in how operating lease expenses, R&D, and other items are classified.
Exactly. And it's like the accounting approach treats operating capital and even financing expenses differently. But when you're valuing a firm, you really need to reclassify some of those items, like treating research and development as a capital expense instead of just an operating one. That's a huge deal when you consider the effect on asset valuation.
Right. And speaking of that, the adjustments cover multiple areas. For instance, operating lease expenses that are recorded as operating costs should actually be financial expenses. So by converting those leases into an equivalent debt measure, you get a more accurate view of a firm's leverage. Wouldn't you say that's a more realistic picture?
Definitely. It's like when you convert an operating lease to debt, you're factoring in the idea that a company could be more leveraged than its balance sheet suggests. This process involves discounting future lease commitments at the firm's borrowing rate. And then there's the whole idea of adjusted operating income, adding back lease expenses, then subtracting depreciations, or even using an imputed interest approach. It really changes the numbers.
And then, taking a closer look at R&D expenses, this is another area where traditional accounting misclassifies expenses. Instead of treating R&D as purely an expense, analysts propose capitalizing these costs. So, for a firm like Amgen, you collect historical R&D data, assume an amortizable life, and then reclassify those costs into research assets. That really impacts both operating income and net income.
Exactly. For example, Amgen's illustration showed that you add back the current year's R&D cost to operating earnings and subtract the corresponding amortization, which is determined by the historical R&D stream. If not adjusted, the operating income underrepresents the true earning power of the company by lumping capital investments into one-time expenses. And the adjusted book value of equity grows by the value of this research asset.
Yeah, and it's like, isn't it interesting how this reclassification can also shift key ratios? For example, after adjustments, the return on capital and return on equity drop when you incorporate the capitalized research asset, even when the raw earnings seem high. It's almost counterintuitive at first.
It really is. When you see something like Stellar Computers with a reported high return on capital, once you add the billion-dollar research asset and adjust for current R&D versus its amortization, the return on capital can actually lower, making the profitability more realistic relative to its asset base. That's a critical insight for financial analysis.
So, in essence, these adjustments are trying to bridge the philosophical gap between accounting earnings and the true economic performance of a business. But then, there's also the matter of extraordinary items, right?
Exactly right. There are so many nuanced issues in earnings reports. Companies often manage earnings by reclassifying one-time charges or shifting recurring expenses around. For instance, items like restructuring charges, inventory write-offs, even adjustments like other net become a catch-all that can hide the real operational performance. And it means analysts really have to dig beneath the surface.
Indeed, the text gives us a checklist. If earnings growth greatly outstrips revenue growth, or if you see frequent one-time or non-recurring charges, then there might be a sign of earnings management. And, well, sometimes firms use reserves or adjust for acquisitions to present smoother earnings. It's like peeling an onion.
Yeah, exactly, an onion layered with adjustments. And then there's the debate around marketing or SG&A expenses. Some argue that a portion of advertising or SG&A might be better treated as capital expenses because their benefits span multiple years. though the consensus seems to lean towards keeping them as operating expenses, especially with examples like Amazon, where the customer's loyalty
True.
isn't guaranteed to be long-term. And analysts are still debating that.
I agree. It's like a respectful tug of war. On one hand, some technology firms can justify capitalizing a bit of the SG&A when it significantly builds brand values. On the other hand, you have the counter-argument that the benefits are too uncertain, especially in highly competitive sectors. It's a critical judgment call.
Absolutely. And then the conversation moves on to earnings management more broadly. Firms like Microsoft and Intel set early examples in the 90s, managing to beat analyst estimates quarter after quarter, sometimes through quite aggressive accounting techniques. They would even lower analyst expectations tactfully to meet these targets. That's a strategic part of the game.
And even the phenomenon of whispered earnings estimates was introduced into the market, right? When you beat consensus analyst estimates, but then fall short of these internal, unofficial expectations, the market can react badly. It shows that transparency, or the lack thereof, is a big issue in earnings reports. It really puts the spotlight on earnings management techniques.
Yeah, exactly. And then we dig into how these adjustments affect valuation. You know, when valuing a firm using free cash flows, you'd ideally want your base earnings to reflect the true economic earning power. So you adjust out one-time items, reclassify expenses, even adjust for non-operating reserves. This entire process is essential in determining an accurate firm value. Not doing so can lead to significant mispricing.
Absolutely. Now let's consider the further illustrations, like how Apple's trailing 12-month numbers compared to annual reports. They found that revenues were like 40% higher in the trailing 12-month view. That should really be a wake-up call for analysts using only annual numbers.
Yes, that's a good point. It shows the importance of updating earnings numbers. Relying solely on outdated annual info can be dangerous, especially for fast-changing firms. This is why quarterly updates are so critical. But not every firm files quarterly reports. It's like for markets that only have annual filings, you may have to rely on unofficial data.
Right, and that brings more estimation error into the mix. Plus, items like options outstanding might not update quarterly, so you're working with a patchwork of historical and current data. It requires a lot of judgment.
Definitely. And circling back to operating leases, take the example of the gap. In the calculation, they discounted future lease commitments to derive a present value equivalent to debt. It reminds me, it's like you're uncovering hidden debt that might not be on the balance sheet at first glance. And that's an eye-opener for anyone trying to assess a company's true risk.
For sure. In fact, the gap's adjusted operating income increased by adding back lease expenses and then subtracting depreciation on the leased asset. Alternatively, using the imputed interest cost on the lease debt value gave a slightly different but related number. It highlights that multiple approaches exist, each with their nuances.
Yeah, exactly. And speaking of nuances, the adjustments for acquisition-related items also come into play. For example, goodwill amortization and in-process R&D write-offs can really skew earnings. Analysts often need to look at earnings before these non-cash charges to get a clearer picture. It's one of those non-operational items that can distort the trend.
It really does. And then there's adjusting for investments and cross-holdings. The method there is to separate out the contribution of marketable securities or minority interests so that the operating asset value isn't muddled with non-core profits or losses. It's all about isolating true operational performance from accidental windfalls.
Now, one of the more interesting parts of the conversation is the checklist toward the end about warning signs in earnings reports. You know, things like earnings growth that far outstrips revenue growth, frequent one-time charges, or wildly fluctuating operating expenses. Those can be red flags that the reported earnings might be managing to hide operational weaknesses.
Right, like if a firm consistently beats analyst estimates by a few cents, there's a chance that it's managing earnings through timing adjustments. And then you have accounting rule changes for depreciation or inventory that might hint at manipulation. It's a multi-layered red flag system.
Absolutely. And the examples provided like the case of Xerox with its mix of restructuring charges, inventory, and other unusual items, show how such manipulations require deep scrutiny. Analysts then have to make adjustments, adding back or normalizing these one-off items to come up with a better view of sustainable earnings.
Right.
It really puts an onus on the analyst to peel away those extra layers.
Now, what's also interesting is that even though these adjustments are necessary, they rely on a lot of estimation and assumptions. For instance, the amortizable lives for R&D or SG&A benefits require judgment calls that can vary widely between industries.
Yeah.
One firm's 5-year life might be another's 10-year life.
Exactly, and that's where the art meets the science in financial analysis. These estimates have profound effects on metrics like return on capital, and if you're comparing firms across sectors, you really need to be cautious. It's like trying to compare apples and oranges sometimes, right?
Yeah, definitely, and the question problems at the end of the chapter really drive this home. Take Dara Foods, for instance. They have operating leases that aren't reflected as debt on the balance sheet, but once you capitalize them, the debt-to-equity ratio changes noticeably. That can alter how you value or assess the risk of the firm.
Right. And then there's problems like adjusting operating income given the reclassification of those leases, or even the exercise of capitalizing R&D for firms like Ziff Software. The examples provided give a step-by-step illustration, from collecting historical R&D expenses, applying a linear amortization, and finally, computing the value of the research asset and the adjustment to earnings.
Yeah.
It really shows all the moving parts in valuation.
And let's not forget the illustration for capitalizing recruitment and training expenses for consulting firms like Cyber Health Consulting. Even training costs, when spread over the expected employment duration, can convert into a human capital asset. It's such a twist on traditional balance sheet thinking.
I agree. It truly underlines that, while accounting statements are the starting point, the real insight comes from these thoughtful adjustments. They help remove the distortions caused by aggressive earnings management, whether it's shifting costs between periods or categorizing recurring expenses as one-off.
Definitely.
Otherwise, you could end up overestimating sustainable performance.
Now, I have a question for you. Some might critique the process of capitalizing R&D as overly subjective. For instance, estimating an amortizable life can be quite uncertain. Don't you think that introduces a lot of estimation risk that might mislead instead of clarify?
That's a good point. And I'd say it absolutely does introduce estimation risk. However, the alternative, treating all R&D as a one-time expense, is arguably even more misleading because it underfunds the real, continuing value the research effort creates over time. So while the capitalization method isn't perfect, it's probably a better reflection of economic reality. It's about finding the lesser of two distortions.
That makes sense. And what's interesting is that these adjustments, although grounded in rigorous analysis, still require a healthy dose of professional judgment. That's why the warnings and earnings reports carry such weight. It's not just the numbers, but the way they're managed and manipulated over time that we need to be cautious of. Wouldn't you agree?
Mm-hmm. Absolutely, and that's why investors and analysts keep a close eye on any changes in expense classifications, shifts in accounting policies, or any sudden spikes in one-off charges. They could be indicative of underlying issues, not just benign adjustments. And that underscores the importance of understanding both the accounting side and the financial perspective.
Indeed. So, to wrap up, the key takeaway is that while accounting reports provide the raw data, it's our job to adjust, reclassify, and refine these numbers for valuation. Whether it's capitalizing R&D, converting operating leases to debt, or normalizing one-time charges, each adjustment draws us closer to the real economic performance of a firm. And that, in turn, helps in making more informed investment decisions.
Right. It's all about bridging the gap between reported figures and true earnings. Recognizing that things like earnings management, misclassification of expenses, and outdated annual data can seriously skew the picture. Analysts who master these adjustments are in a much better position to assess risk and value accurately. And that's what makes this field both challenging and fascinating.
Totally. And as we saw with the examples, Whether it's Apple's trailing 12-month data showing a 40% revenue increase over the latest annual report, or Xerox's multiple one-time charges, these stories remind us that financial statements need more than face value reading. They need a critical, adjusted perspective. It's like putting on a pair of glasses that clear up the fog.
Well said. And as a final thought, the checklist provided for earnings reports is invaluable. It helps flag when the numbers might be overly manipulated or when repeated patterns suggest something deeper at play, such as constantly reclassified expenses or overly aggressive earnings management. It's a roadmap for cautious and informed analysis.
I really enjoyed this deep dive into adjusting earnings. It's remarkable how many layers there are to truly understanding a firm's performance, and it's a challenge that keeps us on our toes as analysts. Every adjustment tells a story.
Indeed it does. Thanks for joining in on this discussion. It's been quite an exploration, from capitalizing R&D and operating lease adjustments to managing extraordinary items and spotting warning signs in earnings reports.
Right.
And for anyone listening, remember, the numbers might be there, but it's how you interpret them that counts.
That's a wrap for our detailed chat on earnings measurement. Until next time, keep questioning and stay curious about the numbers behind every financial statement. See you soon.
Yeah. Welcome, everyone. Today we're diving into the nuances of deriving firm value, from earnings to actual cash flows, where after-tax, pre-debt, and post-reinvestment figures are the star players.
Absolutely. It's quite an intricate dance between the numbers, isn't it?
Right. So let's start with the basic idea. The value of an asset essentially comes from its ability to generate cash flows. You first estimate the earnings generated on existing assets, then adjust for taxes and reinvestment needs. Each step is vital, and it's almost like layering a cake. Each layer supports the next.
Yeah, that analogy really works, and it's interesting how this process forces us to differentiate between earnings and free cash flows. The cash flows we ultimately discount are after reinvestments and taxes are taken into account.
Exactly. Now, one of the biggest puzzles here is the tax effect. We hear terms like effective tax rate versus marginal tax rate. The effective tax rate is what you see on the income statement, computed simply as taxes due divided by taxable income. But then there's the marginal tax rate, which is what a firm actually pays on its last dollar of income. And this can be quite higher, often around 35% to 40% in many cases in the US.
That's a key point. Using the effective tax rate throughout can be misleading because it might understate the true tax burden over the long run, especially when tax credits or deferred losses are in play.
Absolutely. For instance, when firms like Convoy Inc. are analyzed, you might see one valuation approach using a 20% effective tax rate. But then if you switch to a 40% marginal rate, the free cash flows, and thus the firm value, drop significantly. It's like you're turning one dial versus another, and the effects over time really add up.
Yep. And there's even a blended approach discussed. Using a low effective rate for the near term, then escalating to the marginal rate for terminal value calculations seems to balance the immediate tax benefits with the reality that deferred taxes eventually catch up.
Exactly. It's a realistic view. In early years, the effective tax rate may be lower, thanks to things like accelerated depreciation or tax credits, but as new investments tighten, the tax rate converges toward the marginal rate. Pretty intuitive when you think about it. None of those tax benefits are permanent.
And speaking of tax benefits, net operating losses, or NOLs, add another twist. Firms that post losses, especially in their early years like Tesla did, can carry those losses forward to shelter future taxable income. But you really have to be cautious about assuming all these benefits are guaranteed.
Exactly. Tesla's example shows that while early losses can produce a zero tax rate in the near term, when the firm's income turns positive, the NOLs gradually get exhausted. And this forces the tax rate upward toward the statutory levels, another layer of complexity in forecasting cash flows.
That's a pretty critical distinction. Overestimating the persistence of NOL benefits can lead to an overvaluation if you assume too much sheltered earnings in the future.
right? And then we move into the realm of reinvestment needs. This is broken down into net capital expenditures and investment in non-cash working capital. Now, net capital expenditures are basically capital spending minus depreciation. But, when you factor in things like capitalized R&D and acquisitions, it gets a bit messy.
Uh-huh. And the idea is that capital spending can be lumpy. A big investment one year, then a quieter year the next. It's not steady. So, smoothing these expenditures, maybe by averaging over several years, can provide a more realistic estimate.
Yes, it's like smoothing out a bumpy road. For example, the Cisco Systems illustration shows how you adjust the net capex by adding R&D expenses while subtracting the amortization of the research asset to get a truer picture of reinvestment.
And that adjustment is crucial. I mean, respectfully, sometimes I wonder if all analysts really appreciate how much R&D expensing affects both the cash flow and the apparent profits. It's a subtle but huge impact.
I totally agree. When you capitalize R&D, you're actually shifting when the expense hits the income statement. So, while the cash flow doesn't change, the tax benefit is immediate if you expense, your reported earnings look very different. And that, in turn, affects how we evaluate growth and reinvestment performance.
Right, and then there's the investment in working capital. This involves non-cash items like inventory, receivables, and payables. The trick is to exclude cash and marketable securities because those are, in essence, earning a fair return elsewhere.
Exactly. So, non-cash working capital is calculated by taking current assets minus cash equivalents and then subtracting non-debt current liabilities, focusing on the operating side. For instance, the Marks and Spencer example clearly shows that non-cash working capital is significantly higher than simple working capital, giving us a truer measure of cash tied up in operations.
Yep. And as we project forward, tying working capital to revenue growth can help smooth out the volatility. Some firms might see abrupt spikes in working capital changes, which, if taken at face value, would distort the free cash flow estimates.
Exactly. In the gap illustration, for instance, different methods using year-over-year changes versus historical averages or industry benchmarks yield vastly different working capital investment figures. It really shows that assumptions matter a lot.
Yeah, and here's a little challenge. When you have negative working capital, like at times seen in firms like Amazon, you have both benefits, since you essentially finance yourself with supplier credit and risks. Suppliers may not extend credit indefinitely, and it can affect credit ratings.
True, supplier credit might seem like free money, but any disruption or increase in lost cash discounts can drive up financing costs indirectly. It's a fine line to walk.
Now, what really caught my eye were the sample problems at the end. They force you to apply these ideas, valuing a firm like Genflex using different tax rate assumptions, or estimating free cash flow for a tech firm with R&D and 2 acquisitions. That, I think, is where the rubber meets the road.
Absolutely. It's a practical test of all these concepts. Problem 1, for instance, highlights the importance of choosing between effective and marginal tax rates. The firm's valuation swings depending on whether you assume a constant effective rate, switch immediately to the marginal, or blend the two.
Yes, exactly. And problem 2 further complicates things by having to incorporate R&D with a short amortizable life plus acquisitions, both cash-based and stock-based. It's a clear reminder that adjustments to operating income, capex, and reinvestment aren't isolated. They interlock together.
Right, and let's not forget problem 3 with Lewis Clark that adds in operating leases along with the usual mix of capex, depreciation, and working capital changes. It really demonstrates that every single cash flow item needs careful scrutiny.
Exactly. Each piece, the tax rate, the reinvestment in capital and working capital, affects the free cash flows and thus the overall valuation. And then problem 4, with Ford's balance sheet, gets into the nitty-gritty of net versus non-cash working capital. It's almost like a forensic deep dive into the numbers.
Yes, that level of detail is crucial when you want to project future changes accurately. For instance, knowing whether non-cash working capital as a percentage of revenues will hold steady or adjust toward an industry average is no trivial matter.
Truly. And then, in problem 6, with Newell Stores, we see even the possibility of negative working capital. It's a fascinating demonstration of how, under certain assumptions, even a negative working capital position can lead to extra free cash flows. But it also warns of the pitfalls of assuming that condition will persist over long periods.
Right. What works well in the short run may not be sustainable long term. And as we refine our forecasts, balancing stability with growth expectations becomes more art than science.
Exactly. Every adjustment reflects a judgment call. I'd argue that while some analysts may lean too heavily on historical effective rates or crude averages, adjusting dynamically with the marginal rates and smoothing techniques makes a far more realistic projection.
Absolutely. And I'd even challenge the notion of using a single steady percentage for working capital indefinitely. Markets evolve, and sometimes a firm's operational efficiency improves, meaning that percentage could decrease over time.
Yeah, agreed. That's a good point. If a firm streamlines its supply chain or negotiates better credit terms, its working capital requirements could indeed drop, which would boost its free cash flows.
Right. It's exactly that sensitivity that makes this analysis so powerful. Every factor, tax nuances, reinvestment decisions, and working capital management contributes to a clearer picture of a firm's underlying health and growth potential.
And ultimately, that's what valuation is all about. Understanding the real cash-generating power of a business. It's like peeling back the layers to see what's truly going on beneath the headline numbers.
Exactly. And even though the math can be intricate, like adjusting for R&D capitalization or accounting for acquisitions, the big picture remains clear. Use after-tax, after reinvestment cash flows to determine a firm's value.
Yep. It's fascinating how such seemingly small differences, effective versus marginal tax rates, for instance, can, over time, yield a drastically different valuation outcome. That's why being meticulous about every assumption is key.
Absolutely. Every one of these considerations reinforces that valuation isn't just a plug-and-play exercise. It's about understanding the story behind the numbers, ensuring that every assumption, from tax effects to working capital changes, resonates with the firm's economic reality.
Well said. This deep dive really highlights the complexity behind those cash flow numbers and why a careful, nuanced approach is critical for solid valuation.
Exactly. To our listeners, remember, the devil is in the details. Evaluating tax effects, reinvestment, and working capital can make or break the accuracy of your valuation models. Thanks for joining in on this insightful discussion.
Thank you all for tuning in. We hope this discussion sheds light on just how artful and rigorous the process of valuation can be. Until next time, keep crunching those numbers and questioning every assumption.
Welcome to our discussion on growth estimation in firm valuation, a real deep dive into how we calculate and predict growth rates. Let's jump right into the fascinating mix of quantitative methods and qualitative insights involved.
Absolutely, it's a rich topic. There's so much to unpack, from arithmetic and geometric averages to time series models and fundamentals.
Right. One of the keystones is that a firm's value is driven by the present value of its future cash flows. And to forecast these, we need growth rates. There are three main ways: using historical growth, analyst forecasts, or direct fundamental estimates.
And each approach has its quirks. It's interesting how historical growth, though appealing, might not be really reliable for high-growth firms, especially when earnings are volatile or even negative.
Exactly. When you look at past earnings growth, you can measure it as an arithmetic average or true compounding via the geometric mean. For firms with erratic performance, the geometric average tends to show a less inflated and arguably more realistic growth rate.
Yeah, that's a key point. And then there's the challenge with negative earnings. For instance, when a firm like Tesla reports negative operating earnings, the usual percentage change calculations can result in nonsensical numbers unless you modify the formula.
Right. You've got to use techniques like taking the absolute value of the denominator or choosing the higher of the two earnings. It prevents those jumps into 196% growth error that doesn't represent real progress.
Correct. I also find it intriguing that aside from historical data, we have to look at time series models such as ARIMA or even SARIMA when forecasting periodic earnings. Though, as always, the further out you predict, the less reliable those forecasts become.
True. Time series models can get sophisticated, adjusting for seasonality, for example, but they shine best with plentiful quarterly data. Even then, their performance declines over longer horizons, which matters in valuation exercises.
Yes, and analysts sometimes outperform them in the short term. Speaking of analysts, their forecasts bring in a separate layer of information. They consider recent firm-specific news, economic trends, competitor moves, and sometimes even private information. But, they're not always spot on for long-term growth estimates.
Exactly. Studies tell us that while analysts are great at 1 or 2 quarter forecasts, their long-term predictions often align closely with what historical fundamentals suggest. Plus, the quality of those forecasts varies with the number of analysts and their consensus agreement.
Right on. Now, coming to fundamentals, a solid method is to tie growth directly to what a firm does, like using the retention ratio and return on equity to predict growth in earnings per share. It's pretty elegant. Growth equals retention times the ROE.
Yes, and that idea extends to net income, where you incorporate the broader equity reinvestment rate, which includes acquisitions and other investments beyond pure retained earnings. It's a more comprehensive view.
It really captures the essence of reinvestment. And then there's the relationship with operating income. For that, we combine the reinvestment rate with the return on capital. That gives us expected growth in operating income. But you have to be cautious. Capital expenditures, working capital, and even things like operating leases must be treated carefully.
Absolutely. The math might say, for instance, expected EBIT growth equals the reinvestment rate multiplied by the return on capital. And sometimes, if ROIC changes, you add a corrective term. It's like saying, if your efficiency improves, you get extra growth on existing assets.
Right. I found it fascinating how, for a firm like Cisco, historical explosive growth in the 90s was impossible to sustain. Their reinvestment drivers, like acquisitions, simply can't scale linearly forever.
Yeah, exactly. When Cisco grew through acquiring companies, that was phenomenal in 1 decade. But if you extrapolate that growth, you'd expect absurd figures, like operating income in the billions. Reality, however, caught up, and as a result, the growth slowed dramatically in later years. It's like trying to double a small firm versus an established giant.
Yeah, makes perfect sense. Another interesting angle is the use of marginal versus average returns on capital. Average ROIC mixes older investments with new ones, while marginal ROIC focuses strictly on the new investments. That can signal the true potential for future earnings growth.
Right, and if you see a jump in the marginal ROE, even if the average ROE is low, it can indicate that a firm is becoming more efficient with its fresh investments. There's often a lag, so the average might not tell the full story.
Absolutely. Then we come into the nuances of qualitative factors: management quality, marketing strength, competitive dynamics. Although these are subjective, they ultimately boil down to impacting the quantitative inputs we just discussed.
Exactly. For instance, a top-notch management team might justify a higher ROE forecast, and strong branding could mean better operating margins. In this way, storytelling and numbers converge to give us a complete picture.
Yeah, and it helps avoid overenthusiasm, like prophesying 100% growth just based on buzzwords. True, valuation mistakes often happen when qualitative hype drives excessive growth assumptions without a firm quantitative basis.
And that's why grounding growth estimates in fundamentals, like linking investment rates, sales to capital ratios, and even transitioning from negative to positive margins, is so critical. It ensures that even bold forecasts can be validated through numbers.
One area that really catches my eye is the treatment of negative reinvestment rates. When depreciation exceeds capital expenditures, you might see a negative rate, which could either be a temporary blip or signal a deliberate downsizing strategy.
Yes, and how you handle that in projections is important. For temporary fluctuations, you might smooth the data by taking historical averages. But if a firm is purposefully liquidating, then you have to forecast declining earnings accordingly.
Right, it has real implications for valuation. And speaking of bridging numbers and strategy, the model for expected growth in net income using the equity reinvestment rate is particularly neat. It ties together cash flows, capital expenditures, changes in working capital, and even financing moves like debt.
Exactly. It's like a recipe. Reinvestment multiplied by the return on whatever capital is put to work. It's a clear framework that shows how strategic decisions affect growth outcomes, both on the income statement and on a per-share basis.
Very systematic. Now let's talk about long-term growth in revenues and operating income, especially for startups like Tesla Motors and LinkedIn. Their revenue models shift as they move from rapid, high percentage growth to more sustainable, moderated rates as they mature.
Yes, it's fascinating how for a smaller firm, even a 100% growth rate can be plausible initially, but as revenues scale, you realistically see a tapering toward the economy's growth rate, maybe in the range of 5% or 6% eventually. And then you have to connect that with operating margins to see sustainable profits.
Absolutely, it's a balancing act. And that's where the sales to capital ratios come in, understanding how much capital is required to support growth. If a firm has a low sales to capital ratio, it has to reinvest more heavily, which could strain cash flows.
Right, and it all ties back to working in reverse from market share targets. For example, if you expect a firm to eventually capture a given percentage of a market, you can back out the necessary revenue growth rate, and then check if the investment assumptions hold high returns.
That's critical. Now, one critique I'd throw out is that while these theoretical frameworks are robust, in practice, the estimates can be quite volatile, especially when dealing with industries undergoing rapid change. Would you agree?
I agree completely, and that's where sensitivity analysis really matters. One must consider different scenarios, conservative, moderate, and aggressive, to ensure that the valuation holds under multiple assumptions. It's like stress testing your growth forecast.
Yeah, exactly, that's essential. And these frameworks also suggest a caution. Relying solely on past growth or analysts' forecasts without adjusting for, say, structural market changes or technological disruptions might lead to over-optimistic valuations.
Right. Seasonality, competitive dynamics, and even regulatory shifts can distort historical trends. That's why a fundamental analysis based on reinvestment and returns, basically the economics of growth, is the safest strategy.
Absolutely, numbers have to back up the narrative. To summarize a bit, we have three major pillars: historical growth, analyst estimates, and fundamental models. Combining these with adjustments for qualitative aspects provides a holistic growth projection framework.
Exactly. And when you anchor fundamentals like the retention ratio, ROE, reinvestment rate, and return on capital, with a critical eye on qualitative drives, you can derive growth expectations that are both credible and, importantly, sustainable over time.
Very balanced. We even see sample problems showing how to calculate these metrics, whether it's estimating average growth rates for earnings per share using arithmetic, geometric, and linear models, or projecting operating income growth in companies with negative margins. Practical examples like these really illustrate the methodology.
True, these examples, like using Cisco's historical data or projecting margins for Tesla and LinkedIn, reveal the complexity behind seemingly simple numbers. They remind us that growth estimates are not just about math, but also about understanding business dynamics.
Absolutely, it's the interplay of art and science. So to wrap it up, it all comes down to a disciplined approach, ensuring that qualitative insights, market conditions, and rigorous quantitative analysis all feed into your growth estimations.
Yes, and by doing so, we put ourselves in a stronger position to value firms accurately, forecast earnings reliably, and ultimately make better investment decisions. It's been a detailed ride through quite a complex landscape, but one that's essential for sound valuation.
Indeed. Thanks for diving deep into this topic. It shows that while growth estimation can be intricate, understanding these elements helps in arriving at realistic projections.
Thanks for the thoughtful questions and insights. Remember, whether you're looking at historical trends, analyst predictions, or firm fundamentals, staying critical and analytical is key to successful valuation. Until next time. Welcome to our podcast. Today we're delving deep into methods for bringing closure to firm valuation. We're talking about terminal value, both from a going concern perspective and via liquidation approaches.
Absolutely. It's a lot to unpack, especially how stable growth factors into the picture.
Right. So let's kick things off by framing the big picture. When valuing a firm, you can't project cash flows forever, so we typically stop at some point and then either assume the firm continues forever at a stable growth rate or shuts down completely and sells its assets.
Exactly. For the going concern approach, isn't it that as companies grow, they eventually slow down and settle to a growth rate roughly at or below the economy's growth, what we call the stable growth rate?
Exactly. As firms mature, high growth becomes harder to sustain. They eventually grow at a rate comparable to or lower than the overall economy, and this stable growth rate, if maintained in perpetuity, lets you estimate the terminal value using formulas like terminal value, CHIT, cash flow in T+1 divided by discount rate minus stable growth.
Right. And we also have the alternative, which is the liquidation approach, where we assume that the firm will eventually wind down, correct?
Yes, spot on. In the liquidation approach, you might value the firm's assets based on their book value, possibly adjusted for inflation, or even look at the earnings power of those assets. For example, if an asset is expected to generate consistent after-tax cash flows, you discount those back to get a liquidation value.
That method gives us an entirely different perspective on terminal value. And isn't it interesting how these approaches intertwine with the idea of reinvestment rates and excess returns?
Exactly. Take the stable growth model. The focus here is on ensuring that the firm reinvests just enough in order to sustain its stable growth rate indefinitely. For instance, if you use the perpetual growth model, the reinvestment rate is derived from dividing the stable growth rate by the return on capital. It's like saying, hey, to sustain a 3% growth, your earnings reinvestment level has to be just right.
And that's why those small changes in the stable growth rate can so dramatically affect the terminal value, especially when the growth rate nears the discount rate used in the model.
Right, it's almost like walking a razor's edge. A tiny tweak can swing the numbers significantly. One rule of thumb is that the stable growth rate shouldn't exceed the riskless rate, which, considering inflation, ties back to the overall economic growth.
Yeah, that connection is key. So, if we're valuing companies, we need to think about how long they can manage high growth, right? And that's where the concept of a competitive advantage period, or CAP, comes into play.
Yes, exactly. CAP is about the period during which a company earns excess returns, that extra punch above the cost of capital. You often see examples where small, nimble firms maintain high growth because they have fresh competitive advantages. But over time, competitors, or simply market saturation, force those excess returns to dissipate.
And for firms like Procter & Gamble, the example often notes a short high growth period, then a maturation phase into stable growth.
That's correct. P&G is a great example. They might enjoy high growth from excess returns tied to strong brands for a few years, say 5, and then drop to stable growth with a lower return on equity. It's almost like their reinvestment rate also drops as they pay out more dividends.
That makes sense. But then there's always this debate about whether, say, high growth firms might continue to sustain some excess returns even into stable growth, albeit at lower levels. Don't you think that's a bit optimistic sometimes?
I actually hear that critique a lot. While it can seem optimistic, it's also realistic. Think about a firm with a robust brand. It might still capture a little extra margin, even as competition increases. However, the consensus in a conservative valuation model is to gradually let excess returns fade, ensuring that in stable growth, the return converges closer to the cost of capital.
Now, if we shift to the liquidation side, the idea is to estimate what's left if the business were to be knocked up and sold off. That involves either using a multiple of operating income or, say, adjusting the asset's book value for inflation.
Yes, and one great point mentioned is that liquidation values can be approached two ways, either simply by the book value adjusted by an inflation multiplier based on asset life, or by the discounted cash flows the asset could earn post-liquidation. Each method has its limitations, like not fully capturing earning potential if you lean too
absolutely.
heavily on historical book value. And to bring this full circle, we also have a multiple approach for terminal value, where you might apply a revenue or earnings multiple to, say, the firm's final forecast year. But that introduces a blend of relative and intrinsic valuation, which usually isn't consistent with a pure discounted cash flow approach.
Right, because if you're taking market multiples, you're referencing external comparables, an approach that already assumes market sentiment. It's a bit like mixing apples with oranges in a theoretical sense.
Exactly. It may be easier to manipulate too, which is why proponents of the stable growth model argue that, provided you adhere to key rules, like ensuring the growth rate is less than the discount rate and that reinvestment levels match the growth assumptions, the intrinsic valuation will be more robust.
Indeed, that consistency is crucial. Now, switching gears a little, what about the survival issue? The idea that not every firm will survive to deliver that terminal value. How do we address that?
That's a really important nuance. Essentially, for well-established asset-rich firms, you can assume survival because their cash flows already incorporate typical risks. But when you're looking at younger or riskier firms, you might need to adjust the value further. One method is to calculate an adjusted value by weighting the DCF output with the probability of distress, plus a distressed sale value if failure occurs.
That approach factors in real-world survival odds, right? Right. It's like saying, look, if there's a 20% chance the firm fails, then we need to weigh the optimistic DCF by 80% and add in the distressed outcome for the remaining 20%.
Spot on. This method highlights that it isn't the failure itself that diminishes value, but rather that a distressed sale usually means selling assets at a discount relative to their fair value under continued operations.
And isn't it interesting that one way to estimate the probability of distress is using tools like bond ratings or statistical methods like probits?
Yes, absolutely, although relying on bond ratings only works if the firm is rated. Probabilistic models can be more insightful, albeit more complex, as they require historical data on firms that failed versus those that survived.
That seems like a good approach despite the inherent difficulties in prediction. With so many methods and assumptions, stable growth, liquidation, competitive advantage periods, it seems like a lot of room for judgment. How do you manage those subjective factors?
It really comes down to careful analysis of firm-specific factors, its size, market dynamics, competitive advantages, and even industry averages for things like betas and reinvestment rates. For example, analysts use different models for P&G versus Amgen, depending on their growth patterns. That's why some models even introduce transition phases in 2-stage, 3-stage, or even end-stage models to gradually shift from high growth to stable growth attributes.
Yeah, those different staging models really help in capturing a more realistic progression. And as those characteristics change, you allow variables like the cost of equity, beta, and return on capital to change accordingly. It's almost like watching a firm mature in real time.
Exactly. It's like a financial coming-of-age story. High-growth firms usually exhibit a higher cost of equity and more volatile returns initially. Then as they stabilize, these numbers drop closer to market averages. Even the reinvestment ratios adjust. For instance, P&G might drop from a 50% payout in high growth to a 75% payout in stable growth.
Right, that really puts into perspective how the valuation mirrors the life cycle of the company. One thing that I sometimes challenge is the assumption that as soon as a firm moves to stable growth, the excess returns vanish or drop sharply. Isn't it possible that some margins persist, even if at lower levels?
That's a good point, and it's one of the subtler debates. Some models allow for lingering excess returns through reduced reinvestment rates, while still assuming that, in a competitive market, such advantages will erode eventually. But if you assume continuous excess returns indefinitely, that's not sustainable. I lean towards the gradual fade model, ensuring consistency with the firm's competitive landscape.
I see, so it's about balancing realism with mathematical neatness. Absolutely. And as we wrap up our discussion, one of the biggest takeaways is that terminal value, whether through a stable growth model or liquidation approach, accounts for the majority of firm value. This is rational since the real returns often come from the eventual sale or long-term growth beyond the forecast period.
Right. The bulk of a stock's value is price appreciation over time, rather than just the earlier cash flows. Criticism often points at the manipulability of terminal value, but such criticism overlooks that it's a natural part of forecasting infinite lives. Plus, as long as you stick to the fundamental principles, like matching growth rates to economic realities and ensuring proper reinvestment levels, the estimates remain sound.
That's key. And before we let this conversation conclude, it's worth mentioning the practical problems that often follow in textbooks. They challenge you to estimate terminal values using multiples, reinvestment rates, and even to compute adjustments for survival probabilities for companies like Ulysses Inc., Genoa Pasta, and even Latin Beats Corporation.
Exactly. Those questions tie theory to practice. They force you to consider everything from adjusted asset liquidation to building a model where, depending on the firm's stage and risk profile, you might allow for a distress discount. It really illustrates the art and science of valuation.
Agreed. So, whether you're using a stable growth model or a liquidation approach, the common thread is that assumptions must be internally consistent, be it in terms of reinvestment, beta adjustments, or matching growth rates with economic realities.
Absolutely. As challenging as these models can be, they provide a structured framework to understand value creation over time. Thanks for taking this deep dive with me. It's been an engaging discussion full of nuanced insights.
And thanks to you, always a pleasure to navigate these complexities. Until next time, keep questioning and crunching those numbers.
Welcome to our podcast, diving into something that's at the heart of equity valuation, the dividend discount model, or DDM. It's essentially a way to value stocks using expected future dividends, right?
Yeah, exactly. It's all about the notion that the only cash flow you really get from owning stock is dividends. Pretty straightforward when you think about it.
Right, so the general model starts by summing up the expected dividends into infinity and discounting them back at the cost of equity. You know, it's like saying the value per share is the present value of every future dividend you'll receive.
Absolutely. And that cost of equity is key. It's like the discount rate that, well, accounts for risk. But here's a thought. Isn't it interesting how the same intuition carries forward even in more complex models?
Oh, for sure. Take the Gordon growth model, for instance. It simplifies that infinite series into a neat equation. Value equals next period's expected dividend divided by the difference between the cost of equity and the perpetual growth rate. It's like a stable growth firm's blueprint.
Yeah, but you have to be really careful with that model. It's super sensitive to, the growth rate assumptions. As the growth rate gets close to the cost of equity, the denominator shrinks and the value skyrockets, or even becomes negative if it exceeds the cost.
Exactly. And that's why, when you apply the Gordon model, you're basically limited to firms with reasonable, sustainable growth, usually not more than the overall growth rate of the economy. It's like comparing an ant to an elephant if you go too high on growth.
Right, and then there are models that build on this idea to handle firms that don't have a constant growth rate, like the two-stage dividend discount model.
Yes, the two-stage model. It splits the growth into an extraordinary high growth period, followed by a stable perpetual growth phase. This is especially useful for companies that are in, say, innovation mode for a while and then settle into maturity. It's like having two chapters in a story, one high-powered opening and then a stable conclusion.
I like that analogy. A story with an exciting beginning and then a more predictable ending, right? But one of the challenges, as I've noted, is defining how long that high-growth chapter lasts.
Right you are. That period is tricky because stretching it out too long can really bump up the value. And if you shorten it too much, well, you might end up underestimating growth potential. It's almost like trying to gauge how long the fireworks show will last at a concert.
Interesting point. And what about the models that incorporate a gradual transition rather than a sudden drop, a sort of soft landing model?
Ah, you're talking about the H model. Instead of an abrupt change in the growth rate, it assumes that growth declines linearly from an initial high rate to the stable rate over 2 H periods. It's like watching your company's growth slowly settle into a steady pace. It pretty much smooths out the transition.
Yeah, it's a more realistic depiction for companies that don't just jump overnight from exciting to stable, right? But then the assumption of a constant dividend payout throughout both phases might be a bit rigid.
Exactly. Most firms tend to change their payout ratio as they mature. And that's why we sometimes turn to the three-stage dividend discount model. It's the most flexible because it allows for an initial high growth stage, a transitional phase where the growth rate declines gradually, and finally a stable growth phase where everything settles in.
So the three-stage model essentially layers the complexity to, accommodate changes not just in growth, but in payout policy and even risk as measured by beta, right?
Correct. Think of it as a model that evolves with the firm. The high growth phase might have a lower payout ratio and higher beta. Then, as the company matures, the payout ratio increases and the beta drops to a more stable level. It's like the company's journey from a startup mindset to that of a blue chip giant.
Yeah, it makes sense. I've seen illustrations where they value companies like Procter & Gamble using that model. They estimate different future dividends based on various growth assumptions and then discount them accordingly, right?
Absolutely. For example, in a typical case, P&G might have had a high growth phase projected for around 5 years, followed by a transitional period where growth declines to a stable, lower rate. And then you calculate a terminal value based on that final growth rate. It's all about matching the model's assumptions with the firm's reality.
That's fascinating. But sometimes I do wonder, isn't the model, despite all these intricate nuances, still seen as contrarian? I mean, some critics argue it's too conservative, or even that it mainly picks stocks with low PE ratios and high dividend yields.
Yeah, that's a common critique. Because the DDM heavily weights near-term dividends, it tends to flag companies that, already have high dividend yields relative to their stock price. So it might be overlapping with what investors already screen for with low PE ratios.
Right, and I've read that while over long periods, undervalued stocks flagged by DDM have earned excess returns, there can be short-term volatility. In some years, the model underperforms the market. That's a key caveat people keep in mind.
Indeed. It's really a tool best suited for long-term, tax-advantaged investments rather than for someone looking for quick wins. And speaking of real-world applications, there are some great illustrations of these models, like the consolidated Edison example for stable growth and total SA for a commodity company.
Sure, consolidated Edison fits well because it's a regulated monopoly with steady dividends, making the Gordon growth model applicable. Total SA's case, on the other hand, needed averaging over a few years due to volatile commodities earnings. It's like these models require you to really know the business fundamentals.
Totally. And then you have more dynamic cases, like Coca-Cola or Vodafone, where you might also adjust for stock buybacks. The models can be tweaked to consider augmented dividend payout ratios, which factor in not just the cash dividends, but also the buybacks. That way, you don't underestimate the cash return to shareholders.
Right, because if you just look at dividends without buybacks, you're missing a big part of the picture for modern companies. It's interesting. Coca-Cola, for example, showed a higher augmented payout ratio compared to the conventional one. That really affects the expected growth rate estimates and ultimately the value you derive.
Exactly. The augmented payout ratio is calculated by adding both dividends and stock buybacks and then dividing by net income. And while buybacks can be volatile year to year, using an aggregate over a few years smooths the fluctuations out. It's like taking an average painting rather than judging each brush stroke.
I see your point, but don't you think that all these adjustments and the assumptions about changing betas, payout ratios, and growth rates make the model somewhat fragile? I mean, small errors in inputs can lead to widely different valuations.
That's a fair critique. The DDM, especially in its multi-stage forms, is very sensitive to assumptions. The risk is that if your estimates for growth rate or cost of equity are off, the value swings dramatically. But then again, that sensitivity can be a strength if it signals when a market is overpriced relative to fundamentals, which is especially useful for a contrarian investor.
Right, it's like a warning light. If the model outputs a very low value compared to the market price, it might be telling you something about overpricing or unsustainable growth assumptions.
Exactly. And beyond individual stocks, some even use the DDM to value entire markets or sectors by aggregating dividends across all companies. For instance, comparing the estimated value of an index based on its dividend yield against its market level can offer insights into whether the market is overvalued or undervalued overall.
That's quite interesting. I saw an example where an index using a dividend yield of 5% and a stable growth assumption came out undervalued or overvalued depending on whether buybacks were included. It really shows how the methodology matters.
Yep. And then there are also tests and empirical studies, like those that group stocks into quintiles based on how undervalued or overvalued they are by the DDM. They often show, over long periods, that the undervalued portfolios beat the overvalued ones by significant margins on a risk-adjusted basis.
However, as you mentioned, these results aren't without exceptions. There are years where the model underperforms. So, wouldn't you say that while the DDM is a solid framework, it's best used in conjunction with other valuation methods?
Absolutely. It's one tool in your valuation toolbox. Critics argue it might miss unutilized assets like brand value or intellectual property, which can be significant. So, in practice, combining it with other metrics, like PE ratios or free cash flow analysis, can provide a fuller picture.
True, it's all about measuring what matters while keeping the inherent assumptions in check. And speaking of assumptions, do you recall the discussion points on the Q&A in the material? There were short problems addressing things like non-dividend paying stocks and adjusting payout ratios.
Oh yes, those questions drive home the point that even companies paying no dividends, but perhaps engaging in heavy buybacks or accumulating cash, can be valued by tweaking the DDM approach. It's not like the model breaks down completely if a firm isn't paying a dividend today.
Right, so by adjusting the payout ratio or projecting future dividends when growth eventually kicks in, you can still extract a meaningful valuation. And then there are the multiple stage models to handle companies with very dynamic life cycles, like aggressive growth followed by a transition phase.
Exactly. The three-stage model, for instance, is particularly valuable for companies that start with explosive growth, ease into a transitional period as competitive advantages wane, and then enter a stable, more mature stage. It's a lot more flexible, even if it requires more detailed inputs.
Yeah, the trade-off is between complexity and flexibility. More stages mean you can tailor it more precisely, but it also means more assumptions and potential error. I appreciate that the material really emphasizes matching the model to the firm's characteristics.
Certainly, whether it's the simple Gordon growth model for a mature utility like Consolidated Edison or the more intricate three-stage model for a consumer giant like Coca-Cola, the key is consistency. Your inputs, growth rates, payout ratios, cost of equity need to reflect the firm's actual operations and strategic outlook.
And let's not forget the critique concerning taxes on dividends versus capital gains. While the DDM itself is elegant in theory, in practical taxable environments, high dividend yields can sometimes lead to tax disadvantages that modestly erode the expected returns.
Right, and that's why some investors prefer a comprehensive perspective that includes stock buybacks and even unrecognized assets. It really highlights the importance of understanding the context behind the numbers.
A great reminder that no model is perfect on its own. But when applied with care and combined with other analyses, the dividend discount model can be a powerful framework for understanding how investors value companies based on the cash flows they expect to receive.
Absolutely. It's a framework that forces you to think about fundamentals, growth sustainability, and risk, all of which are critical when making long-term investment decisions. And even though small changes in assumptions can lead to big valuation swings, that sensitivity also highlights potential mispricings in the market.
Well, this has been an enlightening discussion. It really shows that while the dividend discount model has its limitations, its adaptability and strong theoretical foundation make it an indispensable tool in equity valuation.
Definitely. And for anyone looking into valuation, the key takeaway is to understand the underlying assumptions and adjust them to the realities of the firm. Thanks for joining me today on this deep dive into the DDM.
Thanks for having me. It's been great unpacking all these layers, from basic dividend discounting to complex multi-stage models. Until next time, keep questioning those assumptions.
Let's dive into free cash flow to equity discount models. It's a fascinating way to value equity by looking at what really remains after all financial obligations and reinvestment
Absolutely.
needs.
So, from what I gather, FCFE goes beyond the dividend discount model, right? Instead of only focusing on dividends, it captures net cash available after meeting debt payments, capital expenditures, and working capital.
Exactly. While the dividend discount model assumes that only dividends, or sometimes buybacks, count, the FCFE model uses an expanded view, starting with net income and subtracting net capex minus depreciation, changes in non-cash working capital, and then adjusting for net debt issues.
Right, that's the key. And interestingly, this approach really exposes how much a firm can actually return to shareholders, even when, say, dividends are kept sticky or are lower than what could be paid.
Yes, exactly. It highlights, for instance, that many firms deliberately pay out less than their free cash flow, building up cash or reinvesting for future projects. It's like deducing the true payout capacity versus the actual dividend policy.
And that leads us into the reasons behind why firms might not pay out all available cash. You've got stability concerns. Dividends are sticky, as managers are hesitant to cut dividends even when cash flows drop.
Right, managers worry about the signal sent to the market. So even if FCFE is high, dividends may not rise for fear of future cuts. And then there are tax factors and future investment needs that also play a role.
I noticed the models also adjust the expected growth rate differently because FCFE growth excludes growth from the accumulation of cash and marketable securities. Instead, it only reflects growth in income from operating assets.
Exactly. It's like replacing the dividends retention ratio with an equity reinvestment rate, emphasizing that reinvestment goes solely into operating assets. So, non-cash return on equity is really what matters here.
So if you think about it, when, for instance, a stable growth firm has capital expenditures almost matching depreciation, it implies little reinvestment. This then suggests that its FCFE and dividends might be similar.
Yes. And in that case, the FCFE discount model and the dividend discount model give nearly the same equity value. But when dividends are, say, unsustainably high or low relative to FCFE, that's when discrepancies arise.
True. One of the neat illustrations was with Coca-Cola, where using the FCFE model actually suggested that the stock was undervalued compared to its market price. But I did notice a point someone might challenge. Isn't it a bit risky to assume that all free cash flow gets paid out?
Good point, and it's a respectful critique. The FCFE model inherently assumes that all available cash beyond reinvestment needs is distributed to stockholders. But in reality, if cash surpluses are, say, left idle or invested in projects with NPV 0, then it might mirror the dividend discount assumptions.
Exactly, that nuance matters. And then we have more advanced models like the constant growth, two-stage, and even three-stage FCFE models that account for phases of growth. They really come into play when a firm isn't in a steady state, right?
Absolutely. For instance, companies like Nestlé or Tsingtao breweries, where growth initially is high and then transitions into a stable phase, require a two-stage or three-stage model. The terminal value in these models factors in the persistence of stable FCFE growth.
Speaking of which, there's an important relationship. The expected growth rate in FCFE is computed as the equity reinvestment rate times the non-cash return on equity. So, if net capital expenditures are high compared to depreciation, that means reinvestment is heavy, lowering immediate FCFE.
Exactly. And that's why high-growth firms often have negative FCFE in the short term, because they're funding aggressive investments. But eventually, as reinvestment declines relative to earnings, cash flows turn positive.
Right, and that dilution effect is factored into today's value, correct? Yes, the negative FCFE can essentially dilute equity if it forces the firm to issue new shares. So the FCFE model naturally captures this impact in the discounting exercise.
Definitely. And when comparing models, if dividends exceed FCFE, perhaps due to unsustainable dividend policies, the valuation from a dividend discount model might overvalue the firm. Conversely, if dividends are below FCFE because excess cash is trapped, the DDM can undervalue the equity.
That's a crucial insight. It's also interesting how the models deal with debt. When a firm finances part of its investments with debt, it effectively reduces the reinvestment burden on equity. But of course, higher leverage increases the cost of equity due to a higher beta.
Right. It's a double-edged sword. Increasing debt releases cash that can be paid out as dividends, but it simultaneously hikes the risk premium. So, the net effect on equity value depends on the balance between increased cash flows and the increased cost of capital.
Yep, that trade-off is always tricky. Now, what about those real-life illustrations in the material? You mentioned Disney and Volkswagen, and then there was that detailed case study with Nestlé.
Oh yes, those illustrations do a great job. Take Disney's case from 2001, for example. The full computation of FCFE over a period shows how adjustments for net debt, capital expenditures, depreciation, and changes in working capital sum up to the free cash flow figure. It really demonstrates that although aggregate FCFE might be identical under the detailed or the shortcut approach, the timing can differ, making the shorter version smoother.
That's so insightful. And then with Volkswagen, they illustrate that for a company in stable growth, reinvestment requirements captured via the equity reinvestment rate tell you what fraction of net income really becomes distributable cash.
Yes. Like if a firm needs to reinvest 1/3 of its earnings, then only about 2/3 become FCFE. It's a neat way to illustrate the implicit assumption behind paying out dividends, or not.
Very practical. And then there are the more complex multi-stage models. The 2-stage for firms with initial high growth, followed by stable growth, and the 3-stage model used generally for companies that transition gradually. They incorporate varying beta estimates and reinvestment rates across stages.
Right, like in the Nestlé example or Tsingtao breweries, where you see cash flow projections change as the firm moves from one growth phase to another. It's almost an art form to forecast those adjustments accurately.
Absolutely, and the sensitivity to reinvestment assumptions can make a huge difference in the terminal value calculation. Speaking of terminal values, it's interesting how even slight differences in assumed stable growth rates, or the reinvestment balancing, such as capital expenditures versus depreciation, can cause valuation swings by tens of percents.
Totally. For example, in Nestlé's case, if you assume no reinvestment in stable growth, the equity per share value shoots up by about 22%. That clearly underlines the importance of sound assumptions when forecasting long-run growth
That's a
and
compelling
reinvestment.
point indeed. Now, one thing I'm curious about, how do we reconcile the differences between the dividend discount model and the FCFE model when advising investors?
Great question. Generally, if a firm's dividend payout is sustainable and mirrors its FCFE, both models converge on a similar value. But in cases where there's a significant discrepancy, like if dividends are too high or too low compared to FCFE, the FCFE model is more reliable. It reflects actual cash availability and potential dilution if dividends exceed FCFE.
That's an important distinction. And then there's the matter of corporate control. In firms where changes in dividend policy are possible through takeovers, the FCFE value might be more indicative of intrinsic value.
Exactly. The FCFE model can capture the so-called control premium, since it shows the value that could be unlocked by ensuring that excess cash gets paid out rather than being misallocated.
Right, that's often why acquirers are willing to pay a premium. The material even goes into a Q&A section, posing problems that test these very concepts, like comparing dividends versus FCFE and determining when a firm might have a higher valuation under one model or the other.
Yes, those questions really put theory into practice. For instance, they ask whether a firm that pays out more dividends than its FCFE would see a decline in value due to financing the excess with debt or equity dilution. It's a practical reminder that models need to harmonize with real-world financing actions.
That connection is essential. And then there's the challenge of using the right beta in valuation. A firm might have a higher beta during its high growth phase, say 1.45, but it might drop to 1.10 in a stable phase. Using a uniform beta without adjustments would misstate the cost of equity in different periods.
Absolutely, and that's why the models allow beta to adjust across stages. It acknowledges that as firms mature, their risk profile changes. A one-size-fits-all beta simply wouldn't capture that transition accurately.
Exactly right. So, to wrap things up, using FCFE models gives us a more comprehensive view of a firm's potential to return cash to shareholders, provided we make careful assumptions about reinvestment, growth, and financing.
Precisely. It ensures that we're evaluating both the cash flows available to shareholders and the sustainability of dividend policies within the broader context of capital structure. It's a robust framework to compare intrinsic value against market prices, whether in takeover situations or routine investment analysis.
Well said. Overall, the sophistication of FCFE discount models really helps us understand not just what a firm is paying out today, but what it truly can afford to pay out tomorrow. Thanks for the deep dive. It's been really enlightening.
My pleasure. Till next time, keep questioning those cash flows and happy valuing. Let's dive right into it. We've been looking at firm valuation from two angles. One using the weighted average cost of capital, and the other employing the adjusted present value approach. You know, it's really about valuing the entire firm by discounting its free cash flows before focusing solely on equity cash flows.
Yeah, absolutely. Right, and what's particularly neat is how the FCFF approach measures cash flows for all claim holders, equity, debt, and preferred shareholders alike. It strips out the distortions that arise when looking at FCFE alone.
Exactly. It's like thinking about the firm as a whole ecosystem. You start with EBIT, adjust for taxes, add back depreciation, and then subtract capital expenditures and changes in working capital. That gives us an unlevered view, before debt comes into play.
And then the model shifts, because if the firm has debt, the free cash flow to equity ends up being less than the free cash flow to the firm, since debt repayments, interest, and preferred dividends are subtracted out. It's kind of like subtracting your fixed expenses to see what's really available for yourself.
True. And then when things move into stable growth, we wrap it into that neat formula. Expected FCFF next year divided by WACC minus the growth rate. But remember, there are several caveats that need to be met here.
Right, like ensuring the growth rate stays below the economy's growth rate and that reinvestment is consistent with achieving that growth. Yes, those conditions are vital. Otherwise, the model can really get thrown off. I mean, if you assume the wrong reinvestment rate relative to capital expenditures, you could overinflate or deflate your free cash flows. It's pretty sensitive.
And speaking of sensitivity, the models also demonstrate that factors like operating leases and R&D capitalization can seriously affect valuations. Look at how Target's operating leases were capitalized to produce a more consistent view of debt levels.
Exactly, it's almost like rewriting the company's balance sheet to reflect the true economic debt, right? Absolutely. It highlights that if you don't treat leases as debt, you might overestimate operating income and understate risk. It's very interesting how the same shortcut adjustments can lead to different inputs for computing the cost of capital.
Yes, and that's where the cost of capital approach really shines. By discounting free cash flows at the WACC, you're effectively bundling in the benefits, the tax shields from interest, and the risks from increased leverage. Although, later on, the discussion shows that circular reasoning can creep in when market values are used both to compute and then forecast debt and equity proportions.
I've seen that issue too. On that note, let's talk about the adjusted present value, or APV, approach. It takes a different tact by valuing the unlevered firm first, then adding in the tax benefits and subtracting any bankruptcy costs. It's very modular.
Right, it's like solving a puzzle piece by piece. Exactly. It lets you consider the benefits and costs of debt separately. For example, you quantify the tax shield as simply the tax rate times the debt, and then you have to assess the expected cost of bankruptcy by estimating default probabilities and multiplying them by estimated bankruptcy costs.
Yeah, and that step really depends on assumptions that can vary widely. True, and therein lies one of the big challenges with APV. Many practitioners tend to ignore bankruptcy costs, which may simplify the calculations, but can lead to an overstatement of firm value at
Exactly.
higher debt levels.
If you add up the tax benefits without subtracting meaningful bankruptcy costs, you might end up incorrectly suggesting that the optimal debt ratio is 100% debt, a clear red flag. Right, and that's why in practice, the cost of capital approach is often preferred for valuing ongoing firms with stable operating cash flows, where it's easier to pin down debt ratios rather than fix dollar amounts of debt.
Yeah, it's often more feasible to work with a percentage than try to nail down specific debt dollar values. What I also found intriguing was how different scenarios were illustrated. Look at the case studies. They included companies like Telesp, Target, Amgen, and even emerging market examples like Gerdau. Each demonstrates that while the methodologies share common principles, the inputs and adjustments can vary so widely.
Yeah, it's like tailoring a suit. Each firm requires its own measurements. Totally. And speaking of tailoring, think about how valuation changes when you adjust for things like R&D expenditures. Amgen's case was particularly telling. When R&D was capitalized, its reinvestment rate and even its growth rate looked markedly different, resulting in a much higher value per share.
Because companies that successfully invest in R&D can reap future earnings. So treating that expense as capital makes the investment more tangible. Exactly. And that ties back to the key idea that the entire firm is worth more when you properly account for all the pieces. Whether it's operating leases or R&D, getting those adjustments right is crucial to not mischaracterizing the company's cash flows and risk.
Even a slight misstep in the reinvestment assumption or the tax shield can change the whole estimation. Now, let's not forget the discussion around optimal leverage. Both the cost of capital and APV approaches help us understand that there's an optimal mix of debt and equity that maximizes the firm's value. The idea is that initially, adding debt reduces the WACC thanks to tax benefits. But beyond a point, the costs, like bankruptcy risks and higher interest rates, increase the WACC.
Yeah, I've always found that trade-off fascinating. It's almost like walking a financial tightrope, right? And the Disney examples really illustrate that balance well. They show how small changes in the debt ratio, say moving from 30% to 40%, can have a measurable impact on the WACC and consequently on the firm's value.
Exactly. And it's important to note that these models assume operating income is unaffected by changes in leverage, which might not always hold true in reality. Yes, that's a good point. In reality, increasing leverage can sometimes cause indirect bankruptcy costs by affecting operating income. For instance, if customers or suppliers downgrading their confidence because of increased financial risk, revenues might drop.
Right, that's a fair challenge to the assumption that operating income remains stable regardless of leverage. Firms can be sensitive to perceived credit risk. And this is where the models get a bit more complicated. Ideally, we'd adjust operating income for changes in risk, but it usually comes down to cautiously interpreting the results and understanding the inherent limitations of each approach.
Exactly. We have these models that are elegant in theory, but real-world data can be messy. It's like the difference between an engineering blueprint and actual construction on site. Totally. And then there's the issue of using either net versus gross debt. The literature points out that valuing the firm with gross debt is often preferred because net debt can lead to circular reasoning, especially if the firm's cash holdings exceed its debt.
Yeah, because if you end up with negative net debt, it really complicates the valuation, for sure. Also, when you net debt, you're effectively assuming that the cash is riskless, leading to a lower cost of debt, which can overstate equity value if you don't adjust the discount rates accordingly.
Exactly. It's like assuming all your savings are earning the risk-free rate, but then mixing them with operating assets that carry risk. And in the end, whether we use the cost of capital or APV approach, both should, if everything is done consistently, yield the same value for equity. The challenge is getting the assumptions right.
Absolutely. And sometimes even a slight inconsistency in estimating tax shields or default probabilities can lead to diverging results. I found it fascinating how the APV method breaks the process into its component parts. First, valuing the unlevered firm, then adding tax benefits, and finally subtracting expected bankruptcy costs. It offers a clear picture of the incremental effects of adding debt.
Yeah, and that clarity helps in deal-making, especially in leveraged buyouts, where financing levels are a major concern. Right. Take the J.Crew leveraged acquisition example. They used APV to show that the tax benefits and bankruptcy costs almost cancel out. And if you push the leverage too high, you risk paying too much, unless operating income can be boosted significantly.
Exactly, which makes it a powerful tool for highlighting whether a deal is over-leveraged or not. And then there's the discussion on optimal capital structure itself. By examining how the WACC varies with different debt ratios, as shown in the Disney example, we see that there is a sweet spot where the cost of capital is minimized and firm value is maximized.
Absolutely. It's almost like finding the optimal gear in a sports car. You want enough torque from debt, but not so much that you lose control. I really like that analogy. And just to add, the analysis doesn't stop at just minimizing WACC. There's also that careful exploration of how a change in capital structure might affect operating income due to signaling or bankruptcy risk effects, which means the optimal debt ratio might be defined by maximum firm value rather than minimal WACC.
Strategic judgment. Investors need to assess industry comparables, control issues, and even regulatory concerns. Also, the piecewise valuation concept is interesting. While most models value the firm as a single entity, sometimes it makes sense to break the firm down into its operating segments. That way, you can apply different discount rates and growth assumptions for each division.
But the challenge there is data availability. Many firms don't release segmented details in a consistent way. Exactly, but when you do have the detailed data, like for GE or Coca-Cola operating in different countries, it can lead to a more accurate composite value.
Yeah, it's like a mosaic. Each piece shines differently, and together they form the full picture of the firm's worth. One more point I'd like to touch on is the treatment of tax benefits of debt. In the cost of capital approach, those benefits are embedded in the lower after-tax cost of debt. In contrast, the APV approach models them as a separate cash flow component.
That's a key difference, and it can lead to different policy conclusions about optimal leverage if one ignores potential bankruptcy costs. Exactly. If you fail to consider bankruptcy costs in the APV method, as sometimes happens, the theory might misleadingly suggest that more debt is always better. But in practice, increasing debt too much can lead to indirect losses in operating income.
Yeah, I think that counterpoint really drives home the fact that theory must be tempered with practical considerations. It's a good reminder to always question the assumptions. Right, and that's why our discussion also includes questions and problems at the end of the chapter. They push you to apply these models to real-life firms like Union Pacific, Lockheed, and even Eastman Kodak or Bethlehem Steel.
Yes, those problems force you to really get under the hood and understand how every component interacts, like the bond ratings, interest coverage ratios, and even default spreads. And it's worth noting that while our discussion might sound abstract, these models have real implications on decisions like capital budgeting, buyouts, and strategic restructuring.
Absolutely. These valuation techniques can influence multi-billion-dollar decisions in the market. Before we wrap up, I want to challenge one point. You mentioned that, with consistent assumptions, the FCFF approach should yield the same equity value as the FCFE approach. But isn't it true that in practice, especially with volatile leverage, getting them to converge perfectly is extremely tricky?
Yeah, that's a fair challenge. In real-world scenarios, differences in cash flow timings, non-operating items, and even estimation errors can indeed lead to discrepancies, which is why analysts often use multiple models to get a range of values. Exactly. You can think of it as using multiple lenses to view the same object. The more perspectives, the better you understand the true value.
Right, and that multi-model approach is a hedge against model risk, so to speak. In summary, whether you choose the cost of capital approach or the APV framework, both serve as powerful tools to assess a firm's value as a function of its capital structure. And while each has its own nuances, the key takeaway is that managing leverage isn't just about lowering taxes. It's about balancing risk with the financial benefits.
Absolutely, it's a complex dance between growth, risk, and reward. I think we've covered a lot of ground today, from the mechanics of FCFF and the role of operating leases and R&D adjustments, to the layered approach of APV and the search for optimal leverage.
It's been a thorough ride through firm valuation. And it really shows that while the math and assumptions can be challenging, the intellectual framework we build helps us approach even the most complex financing decisions with clarity.
Absolutely, and that clarity is what drives strategic decisions in the boardroom and on Wall Street. Well, that wraps up our discussion. Thanks for listening as we broke down the intricate world of firm valuation.
Thanks indeed. It's been a great discussion, full of insights and practical takeaways. Catch you next time as we explore more financial intricacies. And remember, every number tells a story. It's up to us to interpret it wisely.
Welcome to our discussion on estimating equity value per share. Today we're diving into how analysts value operating assets and then move on to non-operating ones like cash and securities, and then factor in the complications from management and employee options.
Yeah, it's a pretty extensive topic. How do you want to break it down?
Let's start with the basics. The core idea is that you first value the operating assets of the firm. That's your EBIT, reinvestment needs. And then you add the non-operating assets like cash, near-cash investments, marketable securities, and sometimes even holdings in other companies. That sets the stage for getting to firm value, which you then adjust for debt to derive equity value, and finally, divide by the number of shares.
Right, but it seems like even the simple step of dividing equity by shares can be pretty messy because of things like employee options, isn't it?
Exactly, yeah. Even though the division feels like standard arithmetic, issues arise when management or employees have options that might be exercised. Options can dilute the share value over time. And not only that, but there's also the issue of options that haven't vested yet, or those that are out of the money.
Yeah, I get that.
Let's talk a bit about non-operating assets first. The key parts include cash and near-cash investments. Essentially, cash used for operating needs should be separated from excess cash that generates returns, typically lower risk or riskless returns. When you include these in your valuation, you either lump them together with operating assets or value them separately.
And what's the advantage of valuing them separately?
Well, by valuing them separately, you prevent mispricing. For example, if you treat a cash balance earning a riskless rate as part of risky operating cash flows, you risk discounting it at an inappropriate rate. There's an illuminating illustration where $1 billion in cash gets misvalued. It's discounted too steeply if the risk premium is applied incorrectly.
Right, that makes a big difference.
Exactly. Now, moving on to marketable securities. Firms often hold investments in risky securities like corporate bonds and stocks of other companies. In theory, if those investments are earning a fair market return, they're value neutral. But then you have scenario-based adjustments, like if the firm invests cash at below market rates, that can drag down the overall firm value.
So basically, if a firm's cash isn't earning enough, you might have to discount the cash asset because it's like, well, not working as hard for the investors.
Right. It's like if you leave money in a savings account that earns a measly return while the market is booming, you lose value compared to what you could get elsewhere. And then there's the strategic aspect, where companies like Microsoft made equity investments for strategic purposes, which sometimes might not add much value after all.
That's interesting. I remember the Microsoft illustration. They had massive cash and securities on their books. But sometimes it wasn't a value add because of the underlying management decisions.
Yep, and that segues nicely into another big area, holdings in other firms, which are often cross-holdings. These can be categorized as minority passive, minority active, or majority active investments. The accounting treatment really matters here. For minority passive investments, you have to consider if they're held to maturity, available for sale, or trading, and each has its own valuation nuance. And with majority active investments, you essentially consolidate the financials, which can then lead to double counting if you're not careful. It's like trying to add up all the flavors in a complex smoothie without over-blending.
That's a neat analogy, like too many ingredients can muddy the valuation.
Exactly. Plus, transparency again becomes key. Firms in some regions, like certain Asian or European companies, might not fully disclose the value of these holdings, which drives a wedge between book value and market value.
And isn't that one of the reasons why analysts sometimes prefer to subtract a discount for opaque or non-transparent holdings?
Yes, spot on. Companies with complicated cross-holding structures might be undervalued simply because investors can't see the full picture, which creates a hidden value potential if they simplify their holding structures.
Yeah, that's definitely a challenge.
Moving on to another complex twist, management and employee options, which create what is known as an option overhang. Options reduce existing equity value because if exercised, they either lead to additional shares or require repurchasing shares using operational cash flows.
Right, and we have several methods to adjust for that. I remember there's the fully diluted approach, treasury stock approach, and even using an option pricing model.
Exactly right. The fully diluted approach is simple but overly conservative because it assumes every option is exercised immediately, even those out of the money. Then, the treasury stock approach adds in the cash proceeds from exercise, which improves the estimate a bit, but still doesn't incorporate the option's time value.
It seems like a balancing act.
The recommended method is valuing the options via an option pricing model. For instance, take the Cisco Systems illustration. Using the Black-Scholes-based approach, they estimated about $2.96 per option, which then adjusts the overall equity value when subtracted, giving a per-share value that sits between the fully diluted and treasury stock approaches.
That approach creates a circular problem sometimes, though, because you might need the current stock price to value the options, which in turn affects the stock price, right?
Exactly, and that's why the process becomes iterative. You might start with a treasury stock-based per-share value, then recalculate the option value, and iterate until you converge on a stable value per share.
I see, like refining a sculpture bit by bit.
Precisely. And then, on top of that, there's the additional dilution from future option grants. Firms expect to grant new options going forward, which reduces the portion of cash flows accruing to current shareholders. Analysts might estimate that expense as a percentage of revenues or earnings, integrating it into future projections.
So, not only are existing options a headache, but future grants add another layer of dilution that needs to be forecasted.
Absolutely. And that's why you see a lot of caution and sensitivity analysis in these models. Even small changes in assumptions about option grants or exercise behavior can mean a notable change in the estimated per-share value.
Where it really reminds us that valuation isn't an exact science.
And then there's the twist with voting rights. Some companies have dual classes of shares, voting versus non-voting, and that adds yet another adjustment. Valuation here uses a control premium for voting shares based on the potential for management changes or better decision-making.
Yeah, typically, empirical studies like those by Lease or McConnell suggest that voting shares can trade at a premium of 5 to 10% over non-voting ones.
Right, for example, if you have a firm with equal numbers of voting and non-voting shares, you'd adjust the per-share value by computing a weighted average and then adding a premium with some assumed probability of management change. An illustration in the input showed how a price difference might be computed. Non-voting shares get a base price, and voting shares receive a boost.
Exactly, it's all about giving shareholders a say in governance.
Now, let me challenge one point here, if I may. Some might argue that using market values directly to value cross-holdings or non-operating assets can be risky because markets sometimes misprice these holdings, especially in emerging markets. What do you think about that?
I see where you're coming from, but I'd say the alternative, using book value multiples, is far from perfect either. In markets with weak transparency, book values can be just as misleading. It really depends on gathering as much external information as possible to refine the estimates.
Exactly. The key is to be aware of each method's limitations. Right. And that's why the input spends so much time on different illustrative cases, from a straightforward treatment of cash to the layered complexity of cross-holdings and then management options. The material really drives home that each component, whether it's undervalued real estate or even overfunded pension plans, needs to be adjusted for when determining equity value per share.
And let's not forget the adjustments for other claims, like expected liabilities from lawsuits, deferred tax liabilities, or unfunded pension obligations. Each of these detracts from the firm value before you get to the equity.
Exactly. So when you're working through a valuation, you're essentially starting with operating assets, then adjusting for non-operating assets like cash, securities, cross-holdings, unutilized assets, subtracting claims like debt and other obligations, and finally accounting for dilutive factors such as options and variable voting rights.
It's like piecing together a very intricate puzzle.
And to cap it all off, there's a question section with a series of problems that test these techniques, from valuing a firm with cash and options outstanding to adjusting for cross-holdings and uncertainty around future option grants. This really emphasizes that valuation isn't just theoretical, it's directly applicable, albeit challenging, in real-world scenarios.
Totally. And it shows why a deep understanding of each assumption, each discount rate, and every adjustment is critical for analysts.
Exactly. And after we sum up all these factors, we get a value per share that might be quite different from the market price. For instance, the Cisco example showed a per-share value of about $20 compared to a trading price of $16.26, indicating potential undervaluation if you account correctly for options.
Yeah, very compelling. It drives home how much nuance there is in such analytics.
In summary, whether you're valuing non-operating assets like cash and securities, cross-holdings in other firms, or factoring in the drag from management options and the premium for voting rights, precision is key. And due to complexities, iterative adjustments often become necessary.
Absolutely, and it reminds us that in practice, every valuation exercise is a blend of rigorous modeling and informed judgment. Thanks for walking through this. There's so much to consider, but it really illuminates the interconnected nature of these valuation components.
Welcome to the podcast. Today we're diving deep into relative valuation, its principles, its methods, and all the nuances that make it both powerful and challenging in practice.
Absolutely, it's such an intricate subject. I'm excited to unpack elements like standardizing prices into multiples and, finding those truly comparable firms.
Right? Exactly. So, to kick things off, relative valuation essentially relies on comparing how similar assets are priced in the market, instead of solely focusing on value generated from future cash flows, as in discounted cash flow analysis.
Yeah.
It's like benchmarking the asset against its peers.
And that benchmarking usually starts by, converting those prices into multiples, like price to earnings, price to book value, and even revenue multiples.
Yep, and that standardization is crucial because stock prices by themselves are meaningless if you don't account for differences like shares outstanding or growth.
Right.
It basically gives analysts a common ground for comparison.
And speaking of comparison, one of the trickiest parts is finding comparable firms. No two firms are exactly alike, right? Even within the same industry, differences in risk, growth potential, or cash flow generation exist.
Exactly, yes. It's like, imagine comparing different types of cars. They might all be sedans, but their performance, features, and fuel efficiency can vary. In our context, that means you have to carefully adjust for those differences to get an accurate relative valuation.
That's a great analogy. Now, one thing that stands out is that relative valuation is super popular among analysts, especially in equity research reports and acquisition valuations. Would you say that's mainly because it's faster and simpler than a full discounted cash flow valuation?
Exactly. It's all about speed and simplicity. Relative valuation requires fewer explicit assumptions. It's more about the here and now market mood. But of course, that simplicity is a double-edged sword because those same factors can lead to misuse if we're not careful.
For instance, the ease in plugging in multiples can sometimes mask underlying differences in risk or growth, correct?
Precisely. And that's why many tests have been developed to ensure multiples are being defined consistently and used uniformly. Take the price-to-earnings ratio. You might see variants like trailing, current, or forward PE, each calculated differently. It's really important to know which one you're looking at when making comparisons.
And that leads us nicely into the definitional tests. It's about making sure the numerator and denominator of these multiples match. So if you're using an equity value numerator, you need an equity-based earnings denominator, not a firm value denominator.
Exactly, yeah. The integrity of the multiple really hinges on that uniformity. For example, the price-to-EBITDA ratio can be misused if it mixes equity and firm metrics. So even if you calculate it the same way for all companies, differences in debt levels could skew things dramatically.
I recall the discussion mentioned that in some cases firms might even appear cheaper simply because of their capital structures. And that's a key pitfall, right?
Right on. Also, When we look at multiples like PE ratios, their distribution across firms is typically skewed.
Exactly.
That means you might have a few outliers with extremely high values, so averages can become misleading. Medians often give a better picture in those scenarios.
Absolutely, because the median is less sensitive to those extreme cases compared to the mean, which can be dragged upward by, say, companies with negligible earnings.
Yes, and that ties directly into the importance of understanding the underlying fundamentals: risk, expected growth, and cash flow potential, since these drive the multiples you see. Treating a low PE value as automatically attractive can be a trap if the firm's growth rate is also low or if there's higher risk involved.
So that's where the concept of companion variables comes in, right? They help explain how changes in the fundamentals lead to changes in the multiples.
Exactly. In the case of the PE ratio, for instance, growth often acts as the companion variable, but you've also got risk baked in. And some modified multiples, like the PEG ratio, try to directly incorporate growth to better compare firms.
Absolutely. It's interesting. Someone might argue that the PEG ratio assumes a linear relationship between growth and PE, which isn't always perfectly true in reality, especially for high-growth sectors.
True, and I sort of respectfully challenge that a little. While the PEG ratio is a handy shortcut, the market can behave non-linearly. You might see firms with similar growth expectations but significantly different PEs due to other risks or market sentiments.
Yeah,
so it's
definitely.
crucial not to rely solely on one modified multiple without deeper analysis.
That makes sense. Also, one of the approaches to handle these differences across firms is through subjective adjustments, modified multiples, and even sector or market regressions. Each method has its trade-offs.
Right, let's break that down. With subjective adjustments, you essentially say, okay, this firm has a higher growth rate or risk profile, so its multiple should logically differ. It's almost an art as much as a science, but because it's subjective, it can introduce bias.
And then there's the modified multiples method where, for example, you adjust PE by dividing by expected growth to get the PEG ratio. That approach, while systematic, assumes a linear relationship that might not hold universally.
Yep. And then we have sector regressions, which are a bit more robust because they use actual market data to regress multiples against variables like standard deviation and growth rates. This can actually produce a predicted multiple that reflects the observed relationships across the sector.
I really like the idea of market regressions because they allow for a comparison that sort of leverages the entire market rather than a small set of comparable firms within one narrow sector.
Exactly. It gives you a broader data set, which is particularly useful if you're analyzing a firm that doesn't fit neatly into one category. However, it's also more statistical and can be sensitive to outliers.
Yeah, agreed. And speaking of outliers, the text emphasized the importance of understanding distributional characteristics. The fact that multiples often have skewed distributions means that averages might not be that representative on their own.
Right, you can't just look at the average PE ratio, for instance, because a couple of extreme values might inflate that average. It's better to look at medians and even sometimes percentiles.
Absolutely. Now moving on to a related but slightly different topic. How do these relative valuation methods reconcile with discounted cash flow valuations? They seem to stem from very different market assumptions.
Spot on. Discounted cash flow valuation assumes that markets sometimes make mistakes that eventually get corrected, whereas relative valuation assumes that while individual stocks might be off, the market is generally correct on average.
Yeah, that's a key distinction.
If an entire sector is overpriced, the relative valuation might indicate that a stock is fairly valued, even if the DCF suggests otherwise.
That's a really interesting point. So, essentially, the relative approach is almost like saying, the market is right on average, whereas DCF puts more faith in the intrinsic value derived from future cash flows.
Exactly, and that's why analysts might see a stock as overvalued on a DCF basis, but undervalued when compared to its peers, or vice versa. It's all about the market's mood and inefficiencies.
Right, indeed. And that brings us to another practical aspect, the questions and problems that often appear at the end of the chapter, like computing different types of PE ratios or understanding the implications of skewed distributions.
Correct. For instance, think about using current, trailing, or forward earnings in the PE ratio, each tells a slightly different story. Generally, forward earnings might yield the highest PE because they often reflect anticipated growth, making the stock appear more expensive relative to its projected earnings. It's a subtle but important point for investors.
And then there's the issue with firms that have negative earnings, where PE ratios might not even be computable, which can skew industry averages. Analysts have to be really mindful of sample selection bias in those cases.
Absolutely. Not including those firms means the averages derived can be misleading, because you're effectively filtering out the underperformers. And similar challenges exist with ratios that might mix different value components. Not a consistently estimated multiple if they compare apples to oranges.
That's a great point. It really underscores that while relative valuation is quick and intuitive, it demands a rigorous discipline to ensure consistency and to control for differences across firms.
Exactly. You've got to define your multiples unambiguously, understand the distribution, analyze the underlying variables, and then make sure that your set of comparable firms is truly comparable.
Truly a balancing act. It's like figuring out the perfect recipe. Too much of one ingredient and the valuation could end up completely off.
Absolutely. It's like cooking. If you don't adjust for the unique flavors of each firm, you risk an over or underestimation that could mislead investment decisions.
And I guess that's what keeps this field so vibrant and challenging, right? The nuance required forces analysts to combine art with science.
Yep, exactly. It's a blend. A sophisticated dance between statistical methods, economic intuition, and sometimes a bit of gut feeling too.
Yeah, absolutely. Overall, the insights from this discussion remind us that while relative valuation offers simplicity and speed, you really have to dig deep into the details to avoid potential pitfalls.
For sure. And even within relative valuation, whether you're looking at earnings multiples, book value multiples, or even revenue multiples, recognizing the influence of growth, risk, and cash flow is paramount.
Totally. Plus, the sector-specific adjustments remind us that context matters. A web-based metric, like market value per customer hit, might work in one context, but not another.
Absolutely. It's all about ensuring you're comparing and that any deviations are properly justified based on fundamentals.
Right, exactly. So in closing, would it be fair to say that relative valuation is a powerful tool when used conscientiously, but it requires as much attention to detail as the more complex discounted cash flow models?
Perfectly said. Relative valuation reflects market sentiment and helps quickly identify whether a stock is cheap or expensive relative to its peers. But without careful application of those 4 basic steps, definitional consistency, understanding distribution, linking fundamentals, and proper comparability, its conclusions can be misleading.
Thanks for this in-depth exploration. It's been really enlightening to unpack both the strengths and the pitfalls of relative valuation.
Thank you too. Always a pleasure to dive deep into these topics with such insightful questions. Until next time. Today, we're diving into the nuts and bolts of earnings multiples, starting with the classic price-earnings ratio, the PE ratio, which remains one of the most commonly used measures of relative value. It's fascinating how something so simple gets so many twists.
Absolutely. The PE ratio's simplicity makes it attractive, but it also opens the door for misinterpretations, right? Like it's highly sensitive to which earnings figure you choose, current, trailing, forward, and that can really skew things.
Right, exactly. Yeah, especially for high growth firms where earnings can really swing wildly. For instance, if you think about the variations in earnings per share used in computing the PE ratio, it can differ dramatically just because of volatility and employee options.
And then there's the matter of comparing across firms. Firms may grow through acquisitions, which then affects earnings in very subjective ways. It's not like there's a one-size-fits-all approach, is it?
No, definitely not. Exactly. It's all about fundamentals, growth, risk, and payout ratios, and how these interact. For instance, if we look at the discounted cash flow model, it suggests that the PE ratio is an increasing function of the payout ratio and growth, but decreases with higher cost of equity due to risk.
That's spot on. Right. And the examples discussed, like the high-growth firm in illustration 18.1, clearly illustrate that interplay. A firm with a 25% growth rate versus one with only 8% stable growth will have markedly different estimated PE ratios.
Absolutely. And that example shows us that expected extraordinary growth directly impacts the PE ratio. As growth declines, say from 25% to 5%, the multiple can fall significantly, from over 28 to just above 10.
Yeah, that's quite a swing.
And not only growth, risk plays a big role. If you bump up the beta, for example, the cost of equity increases, leading the PE ratio to drop. I mean, our illustrations even showed that with beta moving from 1.0 to 1.5, the estimated PE can shrink from around 28.75 to about 14.87.
Indeed. I was wondering, though, when analysts control for these differences, some even use regressions to capture the cross-sectional distribution of these multiples. But don't you think that methodology can run into issues?
Yes, definitely. Right. Because the regressions can suffer from multicollinearity. Growth, beta, and payout ratios are often correlated, making the coefficients somewhat unreliable and even sometimes counterintuitive.
Yeah, like finding a positive coefficient on beta when fundamentals suggest a negative relationship. Exactly. And then there's the systematic comparison across time and markets. For example, comparing PE ratios over time requires adjusting for changing fundamentals, like interest rates, risk premiums, and inflation expectations.
True, and the discussion even noted that while it's tempting to compare a market's current PE to its historical average, you really need to look at the predicted PE based on the fundamentals of that period. Otherwise, you might mistakenly conclude a market is overvalued just because of a shift in interest rates.
Absolutely.
Speaking of adjustments, the chapter also delved into the PEG ratio, which tries to incorporate growth directly by dividing the PE ratio by the expected growth rate.
Yeah, that's a popular tool among analysts, especially for technology firms. Right. In its simplest form, a firm with a PE of 20 and a growth rate of 10% has a PEG ratio of 2. But the chapter warns us that if you're using forward earnings in calculating this, there's a risk of double counting growth.
Exactly. You need to be very consistent. There were clear illustrations showing that using current earnings with a 5-year expected growth rate versus using forward earnings can lead to very different PEG ratios. It's a caution about keeping a uniform approach.
Consistency is key. And interestingly, the chapter notes that PEG ratios, contrary to popular belief, don't completely neutralize the growth effect. In fact, growth gets even more entangled in the multiple. So, comparing PEG ratios across firms without controlling for differences in risk or payout can be misleading.
That's absolutely true. Now, on the topic of comparability, relative PE ratios come into play as well. These just divide a firm's PE by the market's average PE, and while the average is typically 1, it reflects all the underlying fundamentals.
Yep, but then even relative PEs need to be interpreted in light of growth, risk, and payout differences between countries or industries. I found the part on cross-market comparisons particularly interesting. For instance, country differences in interest rates and growth expectations can explain why markets like Japan might have PE ratios significantly higher than those in countries with high real interest rates like country 1 in the example.
That's a good point. And then there's the discussion on using price-to-future earnings for firms with negative current earnings. It's not perfect, but it allows analysts to still use a familiar metric when current earnings don't tell the full story, especially in biotech or tech sectors.
Yes, exactly. Like the Amylin Pharmaceuticals example, where they looked at expected earnings in 2016 to derive a forward PE.
But then you have to be cautious, because comparing a forward PE from a future period with current PE ratios of other companies can lead to inconsistencies unless you adjust everybody to the same forecast horizon.
That's a crucial issue indeed. Switching gears a bit, let's not forget the enterprise value to EBITDA multiple, which is a favorite for capital-intensive industries.
Oh yes, because EBITDA is less affected by differences in capital structure and depreciation methods compared to net income. Absolutely. EV/EBITDA offers a measure that's useful when comparing companies with different financing structures, but even then, corrections are needed for things like cross-holdings. The chapter gave a detailed illustration about Segovia, showing 3 different correction methods.
Right, and each method yields very different multiples, so it's critical to understand the underlying assumptions. And the beauty of EV/EBITDA is that it's less vulnerable to negative earnings, which allows it to be applied to firms that might be in a loss situation when using traditional earnings multiples. Exactly. But keep in mind that you must subtract cash correctly because cash generates interest in a different way, so you don't want to overstate your numerator. Perfect point.
Right. Also, when you break down the determinants of EV/EBITDA, you're looking at factors like tax rate, depreciation, reinvestment requirements, cost of capital, and expected growth. For example, lower taxes tend to yield higher multiples.
And similarly, higher reinvestment needs drag down the multiple because more cash is being used to fuel the growth, leaving less free for valuation. In one of the illustrations, Castillo Cable, the calculation showed that an enterprise value to EBITDA of about 5.24 emerged when accounting for capital expenditures and depreciation, right?
Yes, and it highlights how sensitive these multiples are to assumptions like tax rates or even reinvestment rate. Now, one point I want to challenge a bit is the reliance on these linear regression models to explain PE ratios. The text notes that R-squared values can swing a lot, from, say, 0.93 to 0.32 in different years. That seems to question the stability of these models. Wouldn't you agree?
I do, and I think it's a fair criticism. These regressions capture noise as much as signal, especially when external economic conditions shift rapidly. Yes, and it's interesting how even the market's price for growth and risk, as captured by the coefficients, can vary over time. For example, during the dot-com boom versus post-crisis periods, the numbers are entirely different. Absolutely. And that variance is why many analysts use these multiples as one tool among many, not as a definitive measure. Exactly. Diversification of valuation methods is key.
And then, beyond the regression and pure multiples approach, the chapter emphasizes the inherent limitation. You can compare multiples across firms only if you control for the fundamental differences like risk, growth, and payout ratios, either subjectively or via controlled models.
Because otherwise, a firm might look undervalued simply because it's, say, a higher risk firm trading at a lower multiple naturally, not because it's mispriced. Exactly. And that's where analysts sometimes fall into the trap, thinking a low PEG or PE automatically signals cheapness without adjusting for those varying fundamentals.
Precisely, and that's why an in-depth analysis is necessary before drawing any conclusions. To wrap up our discussion on earnings multiples, whether it's using the traditional PE ratio, the PAG ratio, relative PE adjustments, or EV/EBITDA multiples, the consistent theme is that the underlying fundamentals, growth, risk, and reinvestment needs, drive these multiples.
Yep, and understanding these relationships deeply makes all the difference when evaluating or comparing firms. Also, it's crucial to remember that while these ratios provide a snapshot, they are affected by accounting choices and market conditions, which can vary wildly across time and countries. Yes, and that's why context matters so much. It's all about understanding the assumptions behind each metric, absolutely.
And with that, our discussion has spanned from the technical definitions and computations of key ratios to their practical, sometimes messy, applications in valuation. It's both a quantitative and qualitative challenge.
It's like piecing together a puzzle where every piece is dynamic. I think one of the big takeaways is that while earnings multiples are powerful tools, they require careful, contextual analysis to avoid erroneous conclusions, especially when comparing across diverse firms or economic environments.
Definitely, and always question whether observed differences are truly mispricing or just reflections of fundamental differences. Yeah, and as a final note, whether you're looking at PE ratios, PEG ratios, or EV/EBITDA multiples, always, delve into the assumptions underlying the numbers. If you don't, you might be making an error that could lead to a completely different valuation insight.
Absolutely, that's the art and science of valuation in a nutshell. This has been a deep dive into earnings multiples, touching on everything from their definitions to their practical pitfalls and the importance of controlling for fundamental differences. It's both instructional and cautionary sound advice for anyone working in valuation.
Right, and it's a reminder that while numbers can guide us, context is key. For sure. Thanks for the engaging discussion. Always a pleasure to unravel financial metrics together with all their nuances and challenges.
Yeah, it's like each ratio tells a story, but you need to read between the lines. I appreciate that respectful challenge earlier. You know, pushing back on the regression assumptions really sharpened our focus on the limitations of these models.
I'm glad we could hash that out. Questioning models is essential to understanding their robustness. So, whether you're a portfolio manager, an analyst, or just a finance enthusiast, remember that the elegance of a ratio is only as good as its underlying fundamentals and context.
Yep, and always be ready for adjustments when the environment shifts. That's a wrap on our session today. Thanks for lending an ear and diving into these valuations with such energy and detail.
Thank you as well for the keen perspective and thoughtful questions. It really enriched our discussion today. Until next time, keep questioning, keep analyzing, and keep those financial fundamentals in focus. Welcome everyone to our discussion on book value multiples. It's like a deep dive into how market prices relate to the underlying book value of a firm.
Absolutely, it's fascinating how investors use these ratios. So let's start with the basics. The price-to-book value ratio is computed by dividing a firm's market price per share by its book value of equity per share,
Yep,
right?
exactly. And what's interesting is that while it seems like a simple measure, there are lots of complications. For instance, if a firm has multiple classes of shares, then splitting the book value consistently becomes challenging.
Right, and if you throw in items like preferred stock or even adjustments for buybacks and acquisitions, it can get tricky, can it?
Yes, yep. When a firm engages in large share buybacks, the book value drops. So even if the market price falls too, the ratio may actually rise. Like that example where a firm, say valued initially at $2.00, increased to $3.00 after a buyback. It's
True
almost
indeed.
counterintuitive.
And acquisitions add another layer, especially with the treatment of goodwill. It's all about how much discretion management has over the accounting.
Exactly. And speaking of accounting, book value is largely based on historical cost minus depreciation. So if an asset appreciates or if the earning power changes significantly, the book value might deviate wildly from the current market value.
Right. So in practical terms, why do we still pay attention to price-to-book ratios even with all these limitations?
That's a great question. One key reason is that book value provides a relatively stable benchmark for investors who are a bit skeptical of discounted cash flow models. It's also easier to compare across similar firms, especially when a firm even has negative earnings, something you can't really do with PE ratios.
Yep. Although I must say, sometimes comparing across different countries might be problematic because accounting standards differ.
Absolutely. In fact, it's one of the most fundamental criticisms. If depreciation methods vary, then obviously the book values won't tell the same story across firms or regions. Now, let's get into the derivation side. You can actually relate the PBV ratio to a firm's return on equity, ROE, payout ratio, cost of equity, and expected growth. It's like its formulaic backbone.
Right, because using the dividend discount model, you say the present value per share is DPS divided by cost of equity minus growth, and then substituting using earnings and payout, you eventually get that PBV equals ROE times the payout ratio over the difference between the cost of equity and growth.
Exactly. And interestingly, if you rearrange things by expressing growth in terms of retention and ROE, you get a neat equation. PBV equals ROE minus the stable growth rate, divided by cost of equity minus the stable growth rate. It's quite elegant, isn't it?
Yeah, very elegant. So if a firm's ROE exceeds its cost of equity, then naturally the price-to-book ratio is above 1, meaning the market values the firm above its book value. True, though I might challenge that a bit. Just because a firm has a low PBV doesn't always mean it's undervalued. Sometimes the low ratio reflects higher risk.
That's a very fair point. Investors have also debated whether low PBV stocks essentially pay a premium for risk. It's that risk-return trade-off.
Exactly. Maybe the low ratio is a signal that the firm is exposed to more operational or financial risk that the market rightly demands a discount for.
Moving on, there's an extension to the concept, the value-to-book ratio, which shifts the focus from equity to firm value by considering both debt and equity relative to invested capital.
Yeah, it basically becomes a value multiple rather than strictly an equity multiple. Especially for high-leverage firms, this measure can yield a more accurate picture of how the market values the firm's total capital.
Right, and it can be more stable, particularly when the book equity might be negative, don't you think? Absolutely. By including debt, we smooth out some of those distortions. And then there's also Tobin's Q, which looks at the market value of assets relative to their replacement cost.
Tobin's Q is interesting because, unlike the book value that's based on historical costs, replacement cost reflects current technological and inflationary changes. But it's also hard to measure accurately, right?
Yep, obtaining the exact replacement cost for assets can be a real challenge. And that's why, in practical applications, many analysts take shortcuts and sometimes use proxies, which can muddy the waters.
True enough, yes. Now for our audience, one neat application is using regression analysis on PBV ratios. Many studies, like those by Fama and French, show a strong positive link between PBV ratios and ROE. So if a firm has a high PBV but low ROE, it might be overvalued, while a low PBV with high ROE suggests undervaluation.
Right, and that's where the matrix approach can be really powerful. By plotting PBV ratios against excess returns, that is ROE minus cost of equity, you can visually identify such mismatches.
It's almost like a diagnostic tool for comparability.
And then there are sector regressions, comparing a firm's multiples to its peers, controlling for different risks, payout, and growth expectations. But one has to be cautious because definitions of similar firms can be pretty subjective.
Absolutely. For instance, when, say, comparing across integrated oil companies, even within the same sector, you can see a tremendous range in PBV ratios. Sometimes the differences can be hundreds of % off due to fundamental differences in ROE or risk profiles.
Exactly. And that brings us to an interesting point. Tracking how a firm's PBV ratio changes over time is really insightful. Take IBM, for example. Its PBV ratio moved dramatically as its ROE fell and then recovered later with strategic improvements.
Yes. IBM's story illustrates perfectly how operational improvements and strategic turnarounds can shift the position on the PBV ROE matrix over time. The move from the undervalued low ROE quadrant to the high PBV, high ROE quadrant is really telling.
And then there are practical investment strategies based on these multiples. Value investors, harking back to Graham, have often used a low PBV as a screening tool, provided that the low ratio is combined with strong fundamentals, like robust ROE.
Yep, it's that combination, a low price relative to book and a high return on equity, which signals a potential mispricing. But remember, sometimes low PBV ratios persist because the market deems the company insecure or a bit risky.
That's a good transition into discussing an important nuance. While we often think low PBV is good, it really needs to be contextualized with growth prospects and risk measurements. For example, in some cases, firms with low PBV might be trading low because they have deteriorating future return prospects.
Exactly. And investors face a crucial question. Is the PBV ratio merely reflecting risk, or is it an indicator of undervaluation?
Right, the literature is divided on that. Fama and French argued that low PBV stocks tend to deliver higher returns, but it's hard to pinpoint if that's simply a risk premium or market inefficiency.
I agree, though sometimes it's, a bit too simplistic to say low PBV equals high future returns without considering the industry context.
Speaking of industry contexts, look at the integrated oil companies example. Their PBV and ROE regressions can differ widely based on the cyclical nature of the industry and how risk is priced.
Exactly. And then the regression models even factor in variables like beta, expected earnings growth, and payout ratios.
And when we transition from PBV to value-to-book ratios, the thinking remains similar, but adjusted for debt and overall capital structure. It's like, by using invested capital instead of just equity, we get a fuller picture of the enterprise's value relative to its asset
especially
base.
for companies that rely heavily on leverage. Now, When considering Tobin's Q, it really ties in the market's perspective on efficiency. If a firm is truly outperforming, its market value can exceed its asset replacement cost by a significant margin, indicating excellent management efficiency.
Right, though practical issues in measuring replacement costs mean that many analysts end up using proxies. To sum up, the interplay between book value multiples, return measures like ROE and ROC, and other determinants like payout ratios or expected growth rates is at the core of many valuation models. It's a blend of theoretical elegance and practical challenge.
Yep, and it really shows why a holistic approach is needed rather than relying on a single multiple. And these models, whether it's for stable firms like Nestle or high-growth cases like certain tech companies, ultimately help us identify when the market is mispricing a stock's fundamentals relative to its book value.
Absolutely. It's about matching numbers with context, understanding that a low PBV can be very attractive if supported by a high ROE, and similarly, that adjustments for buybacks, acquisitions, or industry-specific risks are crucial. In the end, these multiples serve as invaluable tools, though they must be applied with a clear understanding of their limitations and the underlying assumptions.
A balanced approach is key.
Welcome to the discussion. Today we're diving deep into revenue multiples and sector-specific multiples as tools for valuation. You know, it's fascinating how analysts now rely on revenue multiples when firms have negative earnings, especially for young, fast-growing companies. They're really switching the focus from earnings to raw sales figures.
Right, and that's especially true because revenue numbers can't go negative like earnings, so they provide a reliable baseline even when companies are still scaling. It's almost like the foundation for comparing firms at different stages of growth.
Exactly. And the two primary revenue multiples we look at are the price to sales ratio, or PS ratio, and the EV to sales ratio. The PS ratio measures equity value relative to revenues, while the EV to sales ratio does a more balanced job by netting cash and debt out. This means that highly leveraged firms might show misleading PS ratios.
So the EV to sales ratio tends to be more robust, right? Because it factors in the operating value of the business rather than just the equity. That's why, in valuation, analysts often pick the EVS measure to avoid comparing apples to oranges between leveraged and unleveraged companies.
Absolutely. And one of the really neat things is how revenue multiples avoid the volatility of earnings multiples. Earnings are very sensitive to accounting choices like depreciation and R&D expenses, whereas revenues are more straightforward, even if they're not perfect.
Right. Now here's a question though. If these multiples are less volatile, why can they sometimes overstate a firm's value? Is it because they ignore costs?
That's a great point. See, revenue multiples can lead you astray if you focus solely on top-line growth without considering profit margins. For example, a firm with skyrocketing revenues but dismal margins might look fantastic if you only check its PS ratio. It's why the chapter emphasizes that profit margins are key determinants. A higher net margin should lead to a higher PS, assuming all else is equal.
So it's not just about the sales figures themselves. It's about how effectively those sales are turned into profits. In fact, the companion variables in the regression analyses are built around these ideas. For earnings multiples, we check whether growth in EPS or return on equity is driving the pricing. And here, with revenue multiples, the net margin, or operating margin in the case of EVS, is the star.
Precisely. And the chapter goes into a lot of detail on this. It even describes a neat derivation, showing that the PS ratio is an increasing function of the net profit margin, payout ratio, and growth rate, while decreasing with higher cost of equity. That creates a nice intuitive link between fundamentals and valuation multiples.
I found the illustrations particularly insightful, like the one with Whole Foods and Coca-Cola. Whole Foods was analyzed with an intrinsic PS ratio calculation and then compared to its market trading at 1.11 times revenues. The adjustments based on pricing strategy led to a major difference in overall equity value.
Right. That Whole Foods example really shows how tweaking the numbers, like cutting prices to capture market share, can adjust both margins and turnover ratios, ultimately impacting the revenue multiples. It's like a chain reaction where a 10% price drop might only slightly affect the PS ratio, but can boost the equity value significantly by enhancing sales volumes.
Exactly. And then there's the regression approach section, which brings in additional variables like beta, payout, and growth rates to predict the PS or EVS ratios more accurately. Although sometimes the explanatory power can be low, as seen with internet stocks where current net margins don't correlate well with PS ratios.
Yes, internet companies often have negative net margins because they're investing heavily upfront. The market values them by future potential, not current profitability. That's why the regression for internet stocks came out almost flat, and even negative in some cases.
Right on. And speaking of sector-specific multiples, it was really interesting to see how different industries use unique denominators, like value per barrel for oil companies, or value per subscriber for media and online services. It highlights that a one-size-fits-all approach just doesn't work across sectors.
Totally. With sector-specific multiples, you scale value with metrics that are more representative of the firm's operational output. For instance, for subscription companies, you can calculate enterprise value per subscriber. But you have to be cautious. If you ignore differences in operating efficiency among firms, you can easily misjudge relative value.
Not to mention the danger of tunnel vision. Analysts might focus on the subscriber count without factoring in, say, customer acquisition costs or revenue per subscriber. That could lead, eventually, to widespread over- or undervaluation across an entire sector.
Right. And the chapter warns that sector-specific multiples can, at times, mask underlying issues. For example, Facebook or Twitter might look expensive on an EV sales basis, but when you analyze value per member, the picture can change dramatically. It brings up the debate on whether to add a brand name premium separately or acknowledge that pricing power is already embedded in the operating margins.
Speaking of brand names, the discussion about valuing a brand, whether through pricing power alone or by also considering sales turnover, is really nuanced. It's almost like if you double count the brand value, you just end up overestimating
Exactly.
things.
Right. They even laid out 3 options for assessing brand name value in the Coca-Cola case. Under one approach, treating brand as only enhancing pricing power can drop the EV sales ratio dramatically if you remove it. Under another approach, brand impacts both margin and turnover. And finally, there's the approach where all excess returns over the cost of capital are attributed solely to the brand. It's a delicate balancing act.
And while the numbers can be staggering, like brand values estimated in billions of dollars, the key takeaway is that improvements in margins drive the multiples up. But that's why it's essential to compare companion variables. A low revenue multiple paired with high margins might signal an undervalued stock, provided you adjust for risk and growth expectations.
Absolutely. The companion variable approach really streamlines things. For the PS ratio, you divide net income by sales to get net margin. For EV/EBITDA, it might be the reinvestment rate. Without controlling for these, you're just comparing numbers that don't tell the whole story.
Exactly. Let's not forget, though, the chapter also mentions future revenue multiples. For high-growth firms, like Tesla back in the day, using future projected revenues multiplied by an industry average EV sales ratio can offer a more realistic valuation, especially if current revenues are negligible. It's a forward-looking approach compared to the current snapshot.
Right, because with companies that are just starting out, it's almost impossible to compare current revenues meaningfully. Instead, you forecast future revenues and then apply the multiples from more mature companies with stable growth. It's like comparing a sapling to a fully grown tree by considering where the sapling will be after a few years.
That's a great analogy. And then there's the discussion about pitfalls, like comparing firms across sectors without adjusting for elasticity in product pricing. A retailer might cut prices with little change in turnover if demand is inelastic, yielding a higher firm value as opposed to competitors with elastic demand.
Yeah, and that ties back to the overall investment analysis. The chapter even gives some problems and questions to help analysts check whether their multiples are running in line with fundamentals. It's not just theoretical. These are practical tools for spotting overvalued or undervalued stocks.
I also appreciated the part on market regressions. Running a regression of PS ratios on variables like payout ratios, growth rates, beta, and margins gives a statistical benchmark. It tells you, for instance, if a stock like Whole Foods is trading at a PS ratio that's in line with its fundamentals, or if it's an outlier that might be mispriced.
True. Although I do have a slight reservation, statistical regressions can be very noisy, especially in volatile sectors like the internet, where fundamentals may be in flux. The explanatory power is sometimes limited, but it still provides a useful starting point for deeper analysis.
It all circles back to the idea that no single metric can give you the complete valuation picture. Revenue multiples are incredibly useful, but they need to be contextualized with margin analysis, risk adjustments, and growth expectations. Otherwise, you might end up making misguided investment choices.
Exactly. And the final takeaway is that every firm's valuation is a mix of structure. Its sales figures, cost efficiency, growth prospects, and the intangibles like its brand name. The chapter does a great job showing how too much emphasis on, say, revenue multiples without looking at profit margins or turnover rates can lead you astray.
So, if I were an analyst or investor, I'd use revenue multiples as a strong tool in my arsenal, but only after adjusting for these companion variables: profit margin for PS ratios and operating margin for EVS ratios. That way, I'm not just comparing raw numbers, but the quality behind those numbers.
Right on. It's about painting the whole picture. And indeed, even the sector-specific multiples remind us that sometimes the right metric is something like dollars per subscriber or per barrel. In other words, you need to match the metric to the industry's realities.
And what's really striking is the depth of analysis in the examples. The way the examples range from retail chains to tech companies, and even to commodity firms. It really shows that while the basic models are similar, the details matter enormously.
Exactly. And one must always be cautious with outliers. For instance, there are firms trading at multiples exceeding 100, but on average, the medians are much lower. That skew can really distort your perspective if not handled properly.
And then, in the context of investment analysis, if you see a company with high margins but low revenue multiples, that could indicate an undervalued opportunity, provided the future growth and risk metrics line up. Conversely, low margins but high multiples might signal overvaluation.
Right. It's almost like using these multiples as a screening tool. Once you flag a company, you then dive into why the mismatch exists. Is it because of market dynamics, competitive pressures, or maybe even some accounting shenanigans? It forces you to really question your assumptions.
I think the clear message is that while revenue multiples are a quick metric, they should never be used in isolation. Always control for risk, growth, and efficiency. And you've got to adjust for sector-specific characteristics if you're comparing across industries.
Definitely. The chapter outlines a comprehensive framework to do just that, and even poses problems that force analysts to think through these adjustments systematically. It's like a complete toolbox for valuation professionals.
Yeah, and with the additional questions and problems, ranging from analyzing a pharmacy chain like Long's drugstores to figuring out the impact of pricing strategies on companies like Gillette, it really underscores the practical application of these theories.
Absolutely. And one of the more challenging concepts is how brand name value interacts with these multiples. The idea that you shouldn't just tack on a premium for a brand name because its effects are already embedded in the operating margins is a subtle but crucial insight.
Yes, I almost questioned that at first. If a company has a famous brand, shouldn't you add extra for that? But if you adjust the margins and turnover correctly, you already see that premium reflected. It's a caution against double counting.
Exactly. Double counting is a big risk. And when you look at the regression models comparing EV sales across global markets, it just emphasizes that despite regional differences, operating margins consistently play a dominant role. That universal aspect makes this framework robust.
I think we've covered the essentials, from the basic definitions to complex real-world applications and even potential pitfalls. It's been a great deep dive into how revenue multiples and sector-specific multiples are not just numbers, but stories about a company's operational strength and strategic choices.
Absolutely. It's been a fascinating discussion, and I hope listeners take away the importance of examining both the numerator and the denominator in these ratios. Always ask, what's really driving the multiple? Thanks for the insightful conversation.
Yeah, thanks. And until next time, keep questioning the numbers and digging into the fundamentals.
Welcome back. Today we're diving into the complex world of valuing financial service firms. And how analysts cope with their unique challenges. One key factor is that these firms, like banks and insurance companies, have messy cash flows because traditional definitions of debt and reinvestment just don't cut it.
Right, the inherent difficulty is that, unlike manufacturing companies, they treat debt almost like a raw material, similar to how steel is treated in an automobile company.
Yep, exactly. And because their reinvestment is primarily into regulatory capital and intangible assets like human capital, our usual discounted cash flow models need adapting.
Oh, for sure.
Making it a very unique valuation exercise.
Speaking of adaptations, they outline 3 primary DCF approaches: the dividend discount model, the cash flow to equity model, and the excess return model.
Yeah, indeed. Let's start with the dividend discount models. The idea here is pretty straightforward. Value is the present value of expected dividends. But note, for many financial service firms, especially mature banks, dividends are high because they have lower capital expenditure needs, and historically, they've developed a reputation for being reliable dividend payers.
I also found it interesting that they incorporate both stable and high growth phases, like in the illustrations for HSBC and State Bank of India. It's fascinating how a small change in the assumed growth rate or payout ratio can greatly influence the value per share.
That's right. Absolutely. For instance, in HSBC's stable growth example, they assumed a 3.5% growth rate and a cost of equity of 9.5%, arriving at a value pretty close to the market price. But if HSBC could boost its return on equity, the dividend and overall valuation could be significantly higher.
I remember that. And with the State Bank of India example, during the high growth phase, the bank's payout ratio was really low, only around 6.41%, fueling super high growth.
Right, which is reflective of their strategy to reinvest most earnings. Now, moving on, what's truly challenging is when firms aren't even paying dividends, especially among high-growth financial firms. But here, the analysts argue that even if dividends are zero now, they eventually convert into dividends when growth stabilizes.
True, even if current net income is negative, we're still looking forward to a bounce-back phase. It's all about future potential. Indeed, and then there's the cash flow to equity models. These models try to capture that reinvestment into regulatory capital, human capital. It's like trying to measure investments that appear in operating expenses rather than in clear capital expenditures.
Exactly. Right, and one creative approach mentioned is to capitalize employee development expenses, which is a bit like capitalizing R&D for tech firms. It involves estimating how long the benefit lasts and then determining current amortization.
Yep, but it does seem challenging to nail down due to the dispersed nature of those expenses. It really does. And then when we get to excess return models, they shift focus to the difference between actual return on equity and the cost of equity. The value of a firm is then its current book value plus the present value of these excess returns.
Yes, it's a neat approach because if the firm is only earning its cost of equity, the market value should converge with book value. And take the Goldman Sachs illustration, for example. Here, they computed excess returns over a high growth period and then assumed that eventually the returns would simply match the cost of equity, meaning zero excess return.
Right, which in theory should stabilize the firm's value. Now, one point I want to challenge a bit is the assumption that debt is so difficult to measure that we almost always simply value the equity directly. While it's true that deposits, for instance, blur the lines between debt and equity, isn't it too simplistic to always ignore debt when considering costs like regulatory
That's a good question. I'd say that in financial service firms, since their debt acts more like a substrate to create earnings, it's often more intuitive to just focus on the equity and blink over debt complications. However, I admit it may oversimplify some nuances. Exactly. And this is why many analysts prefer equity multiples, like price to earnings and price to book ratios, when comparing financial service firms.
Sure, because value multiples like EV/EBITDA don't really work well when operating income is so distorted. Yeah, and on the topic of multiples, the text discusses using regression analysis to predict PE or PBV ratios based on inputs like ROE, payout ratios, and beta. For example, you saw that lower ROE or conservative provisions can drive a lower PE ratio.
It's almost like the dividend discount and excess return models lay the groundwork for understanding these multiples. Plus, there's a whole section on issues like provisions for losses. Banks often set aside provisions for bad loans. If these are set too high or too low relative to actual losses over time, it skews the value.
Yes, and they even mention that consistent over-provisioning can lead to an understated net income, which depresses ROE and the estimated value. So, you could say that improper management of provisions feeds right into the valuation estimates, making careful adjustments necessary.
Absolutely. In practice, you'd want to adjust the net income by reconciling the historical provision levels with actual loss experiences. Another area is deposit insurance. Many governments insure deposits, effectively giving banks a put option on their liabilities.
Yeah, banks with risky portfolios can become more valuable because of the implicit put option advantage. Right, but on the flip side, banks with safer portfolios might be penalized if they are overcharged for deposit insurance fees. And if the insurance is subsidized, it indirectly boosts value.
Exactly. It's a two-edged sword that can, depending on the circumstances, either skew the risk premium or artificially enhance bank values. And of course, regulation overall really hangs over all these models. Regulations affect everything: growth assumptions, dividend policies, even risk assessments for discount rates.
Yes, regulatory constraints tie directly into the reinvestment needs, as banks need to keep a precise equity capital ratio to expand their lending. That's right. So analysts must decide whether to integrate regulatory risk directly into the discount rate if it's deemed non-diversifiable, or adjust cash flow projections accordingly.
Exactly, and it all ties back to how we model the future earnings and the reinvestments required to sustain them. Then there's asset-based valuation, which is mostly relevant for mature banks that aren't expected to grow significantly.
Yeah, and that method involves valuing assets like loan portfolios based on expected cash flows from them, subtracting liabilities, and arriving at an equity value. For instance, in one example, the bank's loan portfolio with favorable interest income was valued higher than its book value, highlighting that asset quality really matters.
Right, it's a direct valuation method that sometimes provides a check against more forward-looking DCF methods. Lastly, let's not forget relative valuation. In comparing financial service firms, equity multiples like price to earnings and price to book ratios tend to be more reliable than enterprise value multiples.
Absolutely, because the traditional EV/EBITDA isn't meaningful when EBITDA itself is distorted by financial firms' unique cost structures. And as we saw in the illustrations, even regression equations can help shed light on whether a bank like Alpha Bank, trading at a very low price to book value, is truly a bargain, or just reflecting low ROE and expected negative growth.
Precisely. So context is critical. High or low multiples need to be interpreted by comparing fundamentals like ROE, payout ratios, and risk metrics such as beta. So to summarize, valuing financial service firms is not just about plugging numbers into a formula. It requires understanding the interplay of regulatory constraints, the role of debt versus equity, reinvestment through non-traditional metrics, and market perceptions on risk and return.
Yeah, it's a holistic view, not just the numbers on the balance sheet. And given the complexity, do you think that one method stands out as best overall?
Well, I'd argue there isn't a one-size-fits-all. Rather, it's about using multiple approaches. The dividend discount model can be very powerful for mature firms, while excess return models and even relative valuation bring further nuance when evaluating growth or distressed banks. Right, and the selection often depends on the firm's stage in the growth cycle, regulatory environment, and the nature of its assets. For example, startups or high-growth banks might best be captured with excess return models, whereas more mature insurers might lend themselves to straightforward dividend discount models.
Exactly, context is everything. I appreciate the flexibility these methods demand, but sometimes I worry that too many assumptions can undermine the robustness of the valuation.
That's a valid critique. assumptions about growth, risk, regulatory stability. Any change can have an outsized effect on the valuation. It's a balancing act, and sensitivity analysis is really crucial. Absolutely. Sensitivity analysis and scenario modeling can help investors grasp how different regulatory or market conditions might shift value.
It's like having a financial weather forecast that you can tweak depending on the storm. That's a great analogy. And one more thing. The discussion on estimating cash flows reminds us that earnings are not the same as cash flows, especially when reinvestment in regulatory capital is lumped with operating expenses.
That's why many suggest focusing on dividend-based measures or adjusted cash flows when it comes to banks. This detailed chapter really underscores that traditional valuation metrics have to be rethought for financial service firms. The methods we use must capture the nuances of how these firms operate, be it through regulatory capital, deposit insurance, or the intricacies of human capital investments.
Right, it's a tailored approach, not the cookie-cutter method you might apply to a manufacturing firm. And despite all this complexity, the core idea remains that value ultimately comes from the firm's ability to generate and reinvest earnings in a sustainable manner.
Exactly, and if they can command excess returns over their cost of equity, then that's where the extra value is created. It's definitely a fascinating area because, in many ways, financial firms operate in a world of their own, where conventional wisdom sometimes doesn't apply directly.
True, they really do require a blend of art and science in valuation. So to wrap up, whether it's through dividend discount, cash flow to equity, excess return, or relative valuation, each method has its own merits and pitfalls when applied to financial service firms, and a comprehensive analysis must consider regulation, debt definitions, and reinvestment.
Absolutely, and combining these approaches can offer a more complete picture of value. In the end, understanding these intricacies not only aids in better valuation, but also helps in deciphering market signals like dividend policies, capital adequacy ratios, and even the pricing of deposit insurance.
Yeah, it turns valuation into an investigative process, not just number crunching. Thanks for this deep dive. It's clear that for financial service firms, every little detail matters a lot more.
It certainly does. And it's always exciting to see how theory meets practice in such a critical industry. Agreed. That's our exploration for today. A robust look at how to value financial service firms by examining everything from cash flows to regulatory overlays and even the subtleties of asset-based approaches.
Indeed, a lot to chew over, but very enlightening. Looking forward to our next session where we tackle another nuanced topic in valuation.
Definitely. Thanks for joining in, and we'll catch you next time. Welcome, everyone. Today we're diving into valuing firms with negative or abnormal earnings. And it's quite a ride, right?
Absolutely. It's a fascinating area, from temporary issues like strikes or recalls to long-term strategic missteps.
Right. So, one key idea is that firms can show negative earnings for different reasons. For instance, temporary issues like a product recall are pretty straightforward. You typically strip out those one-off expenses, and then you can apply normalized earnings to get a better picture.
I see. And then there are cyclical or commodity firms, where earnings dip during recessions or commodity price slumps, making it tricky to estimate growth rates properly, correct?
Exactly, yeah. With cyclical companies, using current negative earnings just extrapolates a wrong story. So analysts often use normalized earnings, taking historical averages over a full economic cycle, say 5 to 10 years, to smooth out those drastic fluctuations.
Right, got that. But what about the firms with long-term strategic or operating problems? How do we adjust valuations then?
Well, that's trickier. For firms suffering from, outdated plants or a legacy of poor decisions, you can't simply normalize back to prior performance. Instead, you have to think about whether the firm can actually restructure itself. Essentially, you need to build in assumptions about if and when the issues will be overcome, and that can really complicate valuation.
That makes sense. And then there's the whole issue of firms with negative earnings because of too much debt. How do we approach that?
For over-leveraged firms, it's about separating the operating performance from the capital structure. So one way is to value the firm with a discounted cash flow method, explicitly adjusting your cost of capital as the debt ratio changes over time. or even using the adjusted present value method that patches in the tax benefits of debt, along with the bankruptcy risks.
Yeah, interesting.
Right. And speaking of risks, when a firm has such negative earnings, the probability of bankruptcy looms, and you might even see situations where your calculated firm value is less than the outstanding debt, effectively implying negative equity value. But you know, equity might still hold some value as a call option on the firm's assets if things turn around.
That's a subtle but crucial point. I'm curious, when using multiples like price to earnings, doesn't not adjusting for these negative earnings risk overvaluing or undervaluing the company relative to its peers?
Spot on. When you look at, for example, a steel company hit by a strike, if you simply compute a PE ratio with depressed earnings, the ratio looks absurdly high. But if you normalize the earnings using historical averages, you're in effect assuming that the issues are behind and the company will converge towards its normal margins.
Right, exactly.
And this approach isn't just limited to multiples. Even in DCF, failing to normalize earnings can lead to huge valuation swings, which is why many illustrations, like the Daimler-Benz 1995 case, show adjusting out the temporary write-offs to get at the underlying operating performance.
Absolutely, it's like peeling off the temporary layers to see the true core. Speaking of examples, the Toyota Motor Corporation illustration from 2009 was a great case in point, wasn't it? Their normalized margin was computed using historical margins applied to current revenues, showing how even industry leaders can appear undervalued during a downturn.
Yes, indeed. Toyota's example really highlights how different normalization techniques, like averaging historical income versus applying historical margins, can yield different estimates. And it reminds us that choosing the right approach depends on the firm's specific context and industry dynamics.
Yeah, exactly. Now, one thing that caught my attention was the discussion on commodity firms. Since their earnings are so tied to economic cycles and commodity price swings, what's the best strategy there?
Great question. For commodity and natural resource firms, you often have to deal with extreme volatility. One common approach is to use a normalized commodity price. You average it over a full cycle, or even to value the operational output at current prices and add on the option value for production flexibility. For example, Aracruz Cellulose's valuation adjusts operating income by restating revenues according to the average paper price over a decade.
That's a neat trick. And then there's the macroeconomic aspect in valuation. It seems like one can choose either to adjust cash flows with explicit forecasts of future commodity prices or recessions, or simply bake in a higher discount rate to capture that risk. Does that capture it?
Precisely. It's a balance between trying to forecast, which can be very error-prone, and using a more conservative discount rate to factor in additional risk. When you incorporate cyclical risk, you might end up with higher unlevered betas that in turn push up the cost of capital.
Exactly, I get that. Now, I do have a critique here. Sometimes relying on average historical margins might be problematic if the company's scale has changed significantly over time. Isn't there a risk of underestimating normalized earnings in such cases?
That's a very valid point. It really is a delicate trade-off. Simply averaging dollar earnings may understate normalized performance if the firm grew markedly. In those cases, analysts might prefer using average margins applied to current revenues instead, which better reflects the firm's existing scale. Exactly. And then moving further, when you have strategic problems like poor market choices, companies like IBM or Xerox, you have to decide if the missteps are permanent or temporary. For permanent setbacks, you must revise down your long-term growth assumptions and thus the expected margins, which then reflects in lower valuations.
And that's why qualitative judgment is so important in these cases. Speaking of qualitative judgments, the concept of golden shares in privatized firms is also an intriguing twist. Governments maintaining a golden share to retain control effectively reduces the incentive for management changes, and that could depress market valuations.
Yeah, absolutely. A golden share essentially limits the ability of investors to expect radical changes even after privatization, So the market value reflects that lack of expected operational improvement.
Right, it's a nuanced issue that can really shift the valuation perspective.
And then we move to distressed firms where DCF might overstate value if the probability of bankruptcy is high. In that scenario, you can either lean on a liquidation value approach or adjust the DCF valuation by weighting in the chance of default. Like in the MGM Resorts example from 2011, the analysts used a distress-adjusted DCF approach that combined going concern and liquidation outcomes.
Yes, that combination really highlights the uncertainty in stressed environments. It's interesting how they calculate the probability of default from both bond prices and historical rating data. This multi-method approach provides a more balanced view, don't you think?
Exactly, and that helps in reconciling what the market is indicating with what the fundamentals suggest. For instance, using a regression-based approach for ExxonMobil to connect oil prices to earnings is another clever technique.
The R-squared value was over 90%, which is super telling.
Right. And then you have life cycle earnings problems as well. For startups or companies with major infrastructure spending upfront, like telecom companies, the path to profitability is prolonged. You can't just normalize earnings immediately, but you must model the firm's journey through different phases. Initial losses, turnaround, and finally
Absolutely,
stable
and that
growth.
requires a lot of forward-looking assumptions. And it's that heavy use of assumptions which lends itself to circular reasoning, doesn't it? Especially when estimating key variables like reinvestment rates and return on capital.
Yes, exactly. There's a persistent risk of circularity when you're using current earnings to estimate growth or ROIC, then using growth to adjust earnings. Analysts need to be very disciplined to avoid that trap.
Discipline and a healthy dose of skepticism are key.
So, when summing it all up, the valuation of firms with negative or abnormally low earnings requires a spectrum of adjustments, from normalizing temporary distortions to assessing long-term strategic and operating issues, and even handling financial leverage in a nuanced way.
Yes, it's definitely not a one-size-fits-all approach. I also noticed that in practice, a lot of this analysis feeds into relative valuation methods. Adjusting earnings means you're implicitly comparing underlying performance among peers. So, if a company with negative earnings claims these are transitory, you have to check that against industry patterns and macroeconomic trends.
Exactly. Even when using multiples like PE or PS ratios for comparative analysis, normalizing the earnings ensures you're not penalizing a firm for one-off or cyclical events that the company or industry as a whole is expected to recover from.
That clarity really helps investors make more accurate comparisons.
And lastly, let's not forget the series of questions and short problems at the end. These exercises are really about applying all these concepts in practice, whether it's estimating normalized free cash flow per share or adjusting for the probability of default. They really drive home just how many moving parts there are in these valuations.
Using real numbers from Intermet Corporation to GM, or even Tenet Telecommunications, puts everything into perspective. I find it interesting how these problems force analysts into a multidimensional analysis, blending historical data, economic forecasting, and qualitative judgment. It really shows the art of valuation, doesn't it?
Absolutely. It's like trying to piece together a jigsaw puzzle where every piece is influenced by macroeconomic conditions, management effectiveness, and industry trends. You have to be patient and, well, methodical.
Right on. And that's why experienced analysts are so highly valued. Now, if we're to pull back a bit, would you agree that the take-home message is to be cautious when faced with negative earnings? Use adjustments, be critical about the optimism, and always check the underlying assumptions?
Yes, that's the crux of it. You need to dig deep. Question whether negative earnings are due to temporary turbulence or fundamental issues, and then adjust growth rates, margins, and even discount rates accordingly. It's this nuance that separates a robust valuation from a cursory one.
Totally agree. And it's fascinating how these valuation challenges also open up debates about how reliable our models are when facing unpredictable events like recessions or commodity price swings.
Precisely, and that's why sensitivity analysis and scenario testing are so vital. They help ensure that when you say a firm is undervalued or overvalued, you're accounting for a range of possible outcomes.
Exactly. You want to know how your valuation shifts under different assumptions.
So, in conclusion, valuing firms with negative or abnormal earnings is a complex, multi-layered process that involves sorting out temporary issues, normalizing for cyclical effects, and carefully integrating the impact of long-term strategic and financial problems. It's a perfect blend of art and science.
Absolutely, it's a fascinating, albeit challenging, world of valuation. Thank you for this deep dive. It's been really illuminating to break down these concepts in such detail.
My pleasure. Thanks for the questions and insights. Till next time, keep questioning those numbers and stay curious. Welcome to the podcast, everyone. Let's dive into the intricacies of valuing young or startup firms. When we talk about valuing these firms, it's not that the fundamentals change. The idea is still to capture the present value of expected future cash flows, but the twists come from limited history and less tangible assets.
Yeah, it's fascinating how there's so little historical data, and yet analysts try to project cash flows and margin improvements. It's like trying to predict the weather with only a couple of days' data sometimes.
Absolutely. And the way they set it up is by drawing on three key sources of information. First is the current financial statements, which give insight into how profitable those investments have been. Then there's the little past history. And lastly, comparisons with peers can help compensate when one of these areas is lacking.
Right.
But in startup firms, these sources are all a bit thin, especially if that peer group is also small or not really comparable.
True. And I think the discussion on life cycle perspectives really makes it clear that young firms, or startup or idea companies as they put it, are valued almost entirely on future growth potential rather than current operations.
Definitely. The chapter breaks the life cycle into stages: startup, expansion, high growth, mature growth, and even decline if it comes to that. In the startup stage, the entire value is in future growth because you simply have no operating history. For example, think of Tesla in its early years: huge losses, but astronomical growth rates.
Yeah.
They made a point that even if earnings are negative initially, if you can convincingly estimate how the margins will improve once the scale kicks in, you can legitimize the valuation.
So then it's not like we need to toss the traditional discounted cash flow model out the window, right? Rather, we have to adapt the inputs, because revenue growth rates, margin improvements, and required reinvestment can be quite different from more established companies.
Exactly. It's like adapting old principles to new paradigms. For Tesla, they illustrated an interesting example where revenues started from around $117 million and ramped up to over $5 billion in the terminal year in their model. They intentionally worked backwards, defining the terminal revenue target and then deriving annual growth rates that logically taper off. You see, early high growth eventually gives way to a slower growth rate as the firm matures.
What's really interesting is that the operating margins in these models start off as huge negatives, then gradually improve and eventually become positive. I mean, initially Tesla had an operating margin of around 69%, and it improved until it reached a target of, say, 10% in mature growth. It's an elegant way of capturing the transformation.
Yep, and it goes even further. Once you have the revenue and margin projections, the next big piece is estimating reinvestment needs. Young firms reinvest heavily to fuel that rapid growth. They use something like a sales to capital ratio to decide how much extra capital is needed for additional revenues. For example, in Tesla's illustration, they assume that for every $2 in additional revenue, you invest $1 in new capital.
And then that reinvestment ties back to the free cash flows. The early years are typically negative, not just because of losses, but also because of the heavy reinvestment. So most of the value is actually loaded into the terminal value, which makes the assumptions on growth and margins so critical.
Exactly. And speaking of assumptions, let's talk risk parameters. Given that these young firms often lack a long history, estimating beta becomes a challenge. The chapter suggests using the bottom-up beta approach, comparing with peers in similar industries. In Tesla's case, they blended an automotive beta with something closer to a tech beta to get around 150 for the early years. That adjustment, along with setting a higher cost of equity due to higher risk, feeds into the cost of capital calculation,
Yeah, and it's interesting how the model anticipates a gradual shift, starting with a beta of 1.50 and a lower debt ratio initially, then transitioning towards lower beta and a higher debt ratio, basically mimicking the transformation from a high-risk startup to a more stable, mature firm over time.
Right. And the venture capital method is another side of this coin. Venture capitalists often use exit values from future earnings multiplied by earnings multiples, discounted back at target rates that are just off the charts, sometimes around 30% or higher. They factor in the extreme risk of failure, which in turn justifies taking a larger equity stake. But it does seem like sometimes the negotiations between founders and VCs really tip this target rate into a negotiation tool more than anything else.
That's a good point. I wonder though, don't you think that using such high target returns might sometimes overstate the risk, especially when compared to more systematic approaches? It almost feels like they're baking too much uncertainty into the discount rate.
You raise an interesting challenge there, and I agree that it's a balancing act. On one hand, high target returns reflect the inherent risks of early-stage companies. On the other, overinflating them could undervalue firms that actually have sound fundamentals. It's all about the appropriate calibration of risk with expected growth. So it's a delicate negotiation between optimism and caution.
Moving on, another huge hurdle is estimating the survival probability. You know, historical data shows that a significant percentage of young firms simply don't make it beyond a few years. The chapter presented survival rates across sectors, and you saw how, for instance, only about 25% in the information sector survived 7 years. That uncertainty adds another layer of complexity.
Absolutely. Survival risk is a fundamental issue. There are two ways to address it. Either you adjust your growth rates and projections by the probability of survival, or you calculate a clean DCF for just the going concern scenarios and then weigh it by the chance the firm actually thrives. It's like betting on both the company and the process. And that also plays a major role in the eventual equity value per share, especially after adjusting for any dilution from options.
Yes, about dilution. I found it really striking that for Tesla, after adjusting for options using methods like the treasury stock or even option pricing models, the share value could swing substantially. Even though the firm's overall enterprise value was high, the per share value could be dragged down if you factor in all that potential dilution.
Exactly, and that's why investors need to be mindful of non-operating assets like cash balances or other investments that might not be directly linked to operations. Young firms can burn through cash quickly, so you have to really examine both the value drivers and the dilution risks to get the full picture.
And then there's the whole issue of estimation noise. The chapter really emphasized that the large degree of uncertainty isn't necessarily a flaw in the model. It's just a reflection of how hard it is to predict the future of a startup. Even with all of these detailed steps, assessing current standing, estimating revenue growth, sustainable margins, reinvestment, risk parameters, the numbers are still going to have a wide error range.
Yeah, you know, it's like trying to nail jelly to a wall. The inherent noise in estimating future performance means that while the model offers guidance on what conditions would justify a given valuation, there will always be surprises. Yet for the long-term investor, this range can be informative. They can see, for example, what compounded growth rates or operating margins would be necessary to support a particular market price. It's all part of understanding the risk versus reward trade-off.
Speaking of which, the expectations game is another intriguing aspect the chapter touched on. Stock prices don't only reflect real-time earnings, they mirror how investors' expectations shift. A tech firm that barely misses its growth rate forecast might see a dramatic drop, even if the underlying fundamentals haven't really changed.
Exactly, and that's a huge lesson for investors. It's not just what the firm does, but how it performs relative to expectations. If you're expecting a firm to grow revenue by, say, 50%, and it only hits 40%, that gap, even if not huge in absolute terms, can trigger a significant revaluation. And that's why managers need to be especially cautious when communicating their performance forecasts.
I also love that part about how even when earnings seem to be improving, you need to dig deeper. Is that improvement a result of dropping reinvestment, which could kill future growth? or because of underlying margin improvements driven by scale and pricing power. It's a reminder to look beyond surface-level earnings numbers.
Yep, you got it. It's a strategic game for both investors and managers. Investors need to focus on sustainable margins and realistic survival probabilities rather than just headline earnings. Managers, on the other hand, need to manage expectations carefully. They shouldn't oversell potential, because then even a minor misstep can lead to a disproportionate drop in stock price. It's a tightrope walk between ambition and pragmatism.
And you know, diversification is key. Given the high amount of noise and uncertainty, a diversified portfolio can help average out those estimation errors. Investing in a basket of startups means that even if one's estimation was way off, the overall portfolio may still perform well if the others are closer to their targets. There's a lesson in risk management here that applies across the board.
Absolutely. Diversification is kind of like insurance against the quirks of individual company forecasts. Even though individual valuations could be wildly off due to estimation noise, across a diversified portfolio, the errors tend to cancel each other out. That's why many investors prefer building a portfolio rather than putting all their eggs in one basket, especially in sectors characterized by high growth and high volatility.
Before we wrap up, I just want to highlight one more thing: the role of assumptions about additional financing. For young firms, raising new capital may dilute existing holdings. So when valuing equity per share, you really have to adjust for potential options or new share issuance. That dilution can, in some cases, make a stock look overvalued, even if the operating business has promising fundamentals.
Yes, indeed. When you see that example with Tesla, where the base valuation might suggest one thing, but then adjusting for options brings the per share value down, it really underscores the need to capture every nuance, from non-operating assets to future capital raise expectations.
Right.
It's a thorough exercise that forces you to look at every potential value driver.
To sum it up, even though valuing young firms is far more challenging than valuing established companies, the process is still built on key principles: cash flows, growth estimates, reinvestment needs, and risk evaluation. It's all about understanding both the quantitative side and the narrative of a firm's potential.
Exactly. And whether you're an investor trying to determine if the market price is justified, or a manager trying to articulate your firm's growth story, these valuation frameworks provide a structured way to think about what really matters, like sustainable margins, realistic growth expectations, and of course, the inherent uncertainty that comes with operating in uncharted territory. Thanks for that insight.
Thanks for the deep dive today. I think listeners will definitely feel more equipped to tackle the challenges of valuing startups and high-growth firms after hearing this discussion.
Absolutely. Remember, while the numbers might be noisy, having a disciplined framework lets you ask the right questions about what a firm needs to do to justify its valuation. It's all about knowing the levers, whether it's revenue growth or margin improvement, and how they interplay with risk and capital structure. That's the key takeaway.
Yep. And before we sign off, one final thought. Sometimes small pieces of information, like slight changes in revenue growth or cost structure, can make a big difference. It reinforces the need for ongoing monitoring and updated valuations.
Very true. It's a dynamic and sometimes unpredictable process, but a fascinating one nonetheless. Thanks for joining in this deep exploration of startup valuation. We'll catch you next time on the podcast, where we take on more topics that challenge the status quo in finance. Goodbye, everyone, and keep questioning those assumptions. Welcome to our podcast on the intricacies of valuing private firms. Today, we're diving into how the valuation process shifts when you're not working with standardized public information.
I'm excited to get into this. It's fascinating how private firms require so many extra adjustments.
Absolutely. When you value private businesses, you quickly learn that they lack the transparency of publicly traded companies. Public firms adhere to rigid accounting standards, which helps when comparing earnings. Private firms, on the other hand, often have less historical data and looser reporting rules. It's like piecing together a puzzle with missing parts.
Right. And that missing information definitely complicates things, especially when trying to estimate risk measures like beta. How do we tackle that?
There are several methods: accounting betas, fundamental betas, and bottom-up betas. With accounting betas, you rely on the changes in earnings, but the downside is that earnings can be smoothed by management and aren't as reliable. The bottom-up
Yep.
beta is particularly useful. It uses the unlevered betas from public comparables and then adjusts for differences in debt ratios and, sometimes, operating leverage.
That makes sense. Using public comparables gives you a base. For example, for a restaurant like Chez Pierre, you'd start with an unlevered beta of around 1.21 from similar publicly traded restaurants and then adjust it, right?
Exactly. In Chez Pierre's case, you'd further convert that to a total unlevered beta by adjusting for the correlation with the market. Say, if the correlation is about 48.41%, you might end up with something like 250. Then you smooth it out by incorporating the tax rate and the industry's debt-to-equity ratio to ultimately get the levered beta. It's like you're taking a microscope to each variable.
And it's crucial because the beta influences the cost of equity. With private firms, sometimes the buyer is undiversified, so you need to use a total beta, which can be much higher compared to the market beta used for an IPO or public firm sale.
Right, you see? If the investor is a private individual, one with most of their wealth tied up in one firm, they don't have that diversification benefit. So you adjust the beta upward to reflect total risk. In contrast, if you're valuing the firm for an IPO or sale to a publicly traded entity, the standard market beta is sufficient because the investors are diversified.
Exactly. Moving on from risk, the cash flow estimates are also different, aren't they? Private firms often mask owner behavior, especially around things like salaries.
Absolutely. Many private business owners, often the managers too, don't charge themselves a market-based salary. Ideally, you want to add back an imputed salary to reflect what it would cost to hire someone. Take Chez Pierre again. If the owner chef isn't paying a realistic salary, analysts adjust the wage line upward, which in turn reduces operating income.
Yep, that adjustment is key. And this is compounded by the blending of personal and business expenses. It requires making careful, sometimes messy, adjustments to net income so that you're truly capturing the operating performance.
Exactly. If you think about it, the intermingling of personal expenses with business expenses leads to overestimated profits if not properly corrected. And then you have lease commitments that might appear as operating expenses. By converting those lease commitments into imputed interest expenses using an appropriate cost of debt, you get a more realistic picture.
Speaking of cost of debt, the methods for private firms are pretty interesting too. Since private firms don't have readily available bond prices, the synthetic rating approach using the interest coverage ratio is common.
Precisely. For instance, Chez Pierre's interest coverage might come out to around 3.33, which, based on a reference table, gives a rating of BB. Adding a default spread, say around 4 to 5%, to the risk-free rate then leads you to a pre-tax cost of debt of about 7.5%, which after tax might be around 4.5%.
That's a practical example. And here, it's crucial to remember that sometimes private banks charge a bit higher for these loans compared to public firms. So you need an extra spread to compensate for that risk.
Exactly, and that's a point I'd like to highlight. While the synthetic rating method is useful, it can underestimate cost if additional risks aren't taken into account. It depends on the specifics of the transaction and the prevailing lending
that's
environment.
An important nuance. Now, what about adjusting for illiquidity? I've seen a couple of approaches there, like the restricted stock method and the bid-ask spread method.
Yes, that's one of the most fascinating parts. The restricted stock approach draws on studies like Silber's regression, which can suggest a base discount, often around 25% for a firm with, say, $10 million in revenues. But then you adjust for the revenue size. A smaller firm like Chez Pierre, with revenues of about $1.2 million, might end up with a discount that's 3.75% higher, leading to something around 28.75%.
On the other hand, the bid-ask spread approach uses trading metrics from public stocks, scaling them for a private firm. For example, you might observe that a non-trading stock has a bid-ask spread equivalent to a discount of around 12.94%, when adjusted for factors like revenue, profitability, and cash as a percent of firm value.
Exactly. And these two methods can yield quite different numbers. Which one you choose might depend on the availability of data and how much you trust the assumptions behind each method.
And that's a respectful challenge in itself. Choosing between these approaches is more art than science sometimes. You have to balance empirical evidence with judgment.
True. Another dimension is the motive behind valuation. If you're valuing a private firm for sale to another private entity, you incorporate factors like non-diversification into the discount rate and include a robust illiquidity discount. But if you're heading toward an IPO or sale to a public firm, you typically use the market beta, and you can often skip the high illiquidity discounts.
Exactly right. Let's touch upon growth assumptions. In public companies, you might look at analyst forecasts and quarterly data. In private firms, however, you often rely on limited historical data and fundamentals like reinvestment rates and return on capital.
Exactly. For private firms, expected growth is usually taken as the product of the reinvestment rate and return on capital. In our case studies, like for Infosoft, you might see high growth in the initial phase, for example, 18% growth, before settling into a stable phase where growth might drop to 3% or even lower.
That transition is critical. And then there's the matter of terminal value. For private firms, because of the issues with continuity and the difficulty of changing ownership, you might assume a finite life or even use a liquidation value, which is typically lower than the perpetual value assumed for many public firms.
Right. So for something like Chez Pierre, you might project cash flows for 12 years and then apply a liquidation value, say, for instance, a book value of $500,000 at closure. This contrasts starkly with a public firm that's assumed to have perpetual life.
Absolutely. And that clearly impacts the present value of cash flows. The discounting must include not only the cost of capital derived from the adjusted betas and debt costs, but also these terminal considerations.
Yes, and speaking of cost of capital, the final weighted average cost for a private firm like Chez Pierre might be, say, around 15.27%, while Infosoft, when prepped for an IPO, might have a cost closer to 11.50%. These differences reflect diverse risk profiles and financing structures.
Right. And then there's the relative valuation approach, which some analysts resort to. For instance, using transaction multiples from private businesses or adjusted multiples from public companies requires careful scaling to account for differences in accounting standards and liquidity.
Exactly. With public multiples, you often focus on revenues because earnings can be distorted. But then again, you need to adjust those multiples for survival risk, non-diversification, and of course, illiquidity. It's a multifaceted challenge.
Yeah, so nuanced. One aspect that's particularly interesting is the pre-cash versus post-cash valuation. When a firm is expecting a cash injection, say, from venture capital, its value can be calculated both before and after that cash is received.
Right? In a scenario where a firm has a pre-cash valuation of, say, $30 million and then receives a $10 million investment, the post-cash valuation becomes $60 million. Consequently, the investor's share is measured differently depending on which valuation you use. For instance, a minimum of 16.66% ownership might be demanded based on post-cash, while the maximum could be as high as 25% if argued on a pre-cash basis.
And that notion extends even to how venture capital and private equity stakes get valued. These investors occupy a middle ground. They're more diversified than a typical private owner, but not as much as public investors. So adjustments to the beta are made accordingly, sometimes shifting it gradually from a total beta to a market beta as the firm matures.
Yes, it's like a journey. Initially, the firm might have a perceived beta of 4, implying a cost of equity of around 24%, which could then drop to 14% at the VC stage, and ultimately to 9% upon going public. Each stage reflects the investor's degree of diversification.
That progression is crucial. Now, control issues are another area where private firm valuation diverges from public firm assessments. When a controlling interest is at stake, say, moving from 49% to 51%, that extra 2% can command a significant premium because control fundamentally affects future cash flows.
Absolutely. If you have, for instance, a status quo value of $100 million for a poorly run firm, and the optimal value under new management might be $150 million, the controlling interest might be worth disproportionately more. It's not a linear progression at all.
Definitely not. In our discussion, we have also seen how tax treatments play into these valuations. Private firms can be structured as sole proprietorships, partnerships, or subchapter S corporations, which can change whether you use a pre-tax or after-tax discount rate.
Exactly. For instance, if the firm's cash flows are calculated on an after-tax basis, the discount rate must also reflect the investor's personal tax burden. It's an additional layer that can't be overlooked, especially when the tax rate on dividends or capital gains differs considerably from the corporate tax rate.
Right on. It's clear then that the motive behind the valuation, whether for an IPO, a private sale, or a venture capital investment, dictates how you adjust inputs like beta, cost of debt, cash flows, and liquidity discounts.
Exactly. For valuations aimed at public offerings, the adjustments are more conventional: market betas, corporate tax rates, and no significant illiquidity discounts. Conversely, for private transactions, you incorporate a total beta, an illiquidity discount, and sometimes even a control premium or discount.
That's the crux of it. And all these elaborate methodologies make private firm valuation one of the most challenging, yet intellectually stimulating areas of financial analysis.
For sure. Ultimately, whether you're evaluating intrinsic value using discounted cash flows or applying relative valuation techniques, it all comes down to detailed assumptions. Sensitivity analyses and clear documentation of assumptions are key to ensuring that the final valuation is both credible and defensible.
Absolutely. I'll add that every valuation case, from estimating cost of capital with synthetic ratings to adjusting betas for non-diversified investors, requires a tailored approach because no two private firms are exactly alike.
Exactly, and that's why the art of valuation is as much about judgment as it is about science. I hope our discussion today sheds light on the myriad adjustments and considerations needed when valuing private companies.
Right. That was a deep dive into private firm valuation, covering everything from risk assessments to control issues and liquidity discounts. Thank you for the enlightening conversation.
Likewise. Thanks for tuning in, and remember, whether you're preparing for an IPO or negotiating a private sale, every detail counts.
See you next time as we explore more facets of valuation techniques.
Welcome, everyone. Today, we're diving into the fascinating world of acquisitions and takeovers, a realm where strategic moves, control premiums, synergies, and even managerial ego collide to create some truly complex transactions.
Absolutely, it's really a dynamic world. There's so much going on, from the conglomerate building in the 60s and 70s with firms like Gulf and Western, to the hostile takeovers of the 80s where, management buyouts and leveraged buyouts became a big deal.
Right. And what's truly captivating is that the rationale behind these moves can vary so much. Firms may acquire targets because they're undervalued, to diversify, to harness operating or financial synergies, or simply because the current management is seen as underperforming.
Exactly. And then there's the very structured process. First, you define a motive or a strategic objective, then you identify a target and actually determine its value, and finally you structure, pay for, and integrate the deal. It's almost like a 4-act play, where each act builds on the previous one.
Yeah, it's like a layered approach, where the initial valuation, what some call the status quo valuation, is used as a baseline. From that, you add control premiums, which essentially reflect the potential gains from better management, and you build on synergy value. The idea here is that the value of a well-run firm might be significantly higher than one with entrenched, less efficient management.
Right on. Speaking of synergy, the promise of cost savings, improved pricing power, or even greater debt capacity, it's touted as a key benefit in many mergers. But if I may challenge this a bit, isn't it true that a lot of empirical evidence suggests that synergy is often more of an optimistic projection than a reality?
That's a fair point, and it really brings out the tension. Synergy is, in theory, a potent driver of increased value when two firms merge. But studies from McKinsey and KPMG have shown that in many cases, the expected synergy fails to materialize, or only a fraction of it does. In fact, in some hostile takeovers, the bidding firm's stock even suffers, sometimes delivering negative excess returns.
I've seen that data. So then, managers sometimes, perhaps a little too confidently, pay premiums driven by synergy expectations, even if those premiums might not be justified when you look at actual post-deal performance.
Exactly. And adding to that, there's the whole issue of managerial self-interest. Sometimes a big part of the deal is driven not by the desire to create value for shareholders, but by the manager's own aspirations. Empire building and even ego plays a significant role. It's fascinating, really, how overconfidence can skew acquisition decisions.
Absolutely, that hubris factor is notorious in these deals. Now, switching gears a bit, the classification of acquisitions is also crucial. We've got mergers, where two boards agree to join forces, tender offers aimed at bypassing management, often used in hostile takeovers, asset purchases, and even management buyouts. Each type has different implications for valuation and risk.
Right, and each transaction type has unique structural characteristics. For instance, in a merger, the target firm may be fully absorbed, while in a consolidation, a new entity is created and shareholders of both companies end up with stock in the consolidated firm. Then you have tender offers, where the acquiring firm essentially makes an offer directly to the target firm's shareholders.
Yep, and that exchange sometimes involves clever negotiations on the exchange ratio too. Speaking of exchange ratios, that part is so nuanced. Setting up the right share swap based on the intrinsic values of each firm can be highly subjective. A misstep in that process might easily result in an overpayment from one side, transferring value away from its shareholders.
Exactly. Take the Compact Digital example. If the exchange ratio is set too high, digital stockholders capture most of the synergy gains at the expense of Compact stockholders. It really shows how important accurate and unbiased valuation is.
It's practically a tightrope walk, and that unbiased valuation itself is a challenge. You might have to choose the right multiples, price to earnings, price to book, etc. And ensuring that you're matching your cash flows with the correct discount rate is critical. Otherwise, you might end up using, say, the bidder's cost of capital to discount the target's cash flows, which could overstate the value.
Totally. It's essential to ensure consistency. Free cash flows to the firm should be discounted at the weighted average cost of capital, while cash flows to equity belong with the cost of equity. Using the wrong rate can lead to serious valuation errors. Imagine under or overvaluing a company by millions because the risk profiles weren't matched properly.
Yeah, that mismatch can be disastrous. Now let's not forget the role of debt in all of this. Acquisitions often involve financing decisions that affect the target's cost structure. If you add more debt, you get the benefit of the tax shield, but you also increase financial risk. Finding that optimal debt ratio is like solving a complex puzzle.
Right. And in a leveraged buyout, for instance, the cash flows and risk profile change over time. Initially, the firm might be loaded with debt, increasing the cost of equity. But as the debt is repaid, the risk shifts again. Projecting these changes accurately is critical to determining whether the buyout ultimately creates value.
Absolutely. And integration risk is a beast on its own. Even if the acquisition is sound on paper, integrating the target with the acquirer can raise unforeseen challenges. Many acquisitions fail because the synergy, or the improved operating performance, never fully materializes, leading to divestitures in the following years.
Exactly. In some studies, nearly 50% of acquisitions are divested within a decade, which is a stark reminder of integration challenges. It's like you're trying to fit two puzzle pieces that almost look alike, but just don't click perfectly.
Definitely, that puzzle analogy is spot on. The structuring phase also brings in important decisions about payment methods, cash versus stock, and whether to finance through debt. These choices affect the eventual transfer of value between the target and the acquirer's shareholders. For instance, if a company over-leverages itself on an acquisition, then even if synergies emerge, the poor financing decision might cancel out the gains.
Right. And it's interesting how the debate between using cash or stock often reflects confidence in one's own stock price. Firms with overvalued stock might issue shares to fund an acquisition, whereas a firm with solid cash reserves might pay cash to avoid diluting earnings.
It's a strategic choice that speaks volumes about management's confidence. And then there's the role of accounting. The post-deal adjustments, like asset revaluations and the subsequent treatment of goodwill, have significant implications. Even if goodwill does not affect cash flows directly, impairment charges can hit earnings hard. It's like an accounting shadow that can distort perceived performance.
Exactly. The accounting treatment can create a lot of noise. For example, while GAAP and IFRS are converging on fair value accounting, the way goodwill is reported and periodically reassessed still can lead to big swings in reported profits, causing investors to react strongly, even if the underlying cash flows remain robust.
That's a valid concern. Earnings management and investor perception are crucial factors. And buyouts bring their own set of challenges. With buyouts, especially when managers are the acquirers, you get the dual role of owner-operator. This shift in incentives can be very beneficial if it leads management to adopt a more disciplined approach to capital allocation, but it also means liquidity becomes a major issue, and the firm is taken private, which changes the valuation dynamics.
Right. With leveraged buyouts, the cost of equity becomes very dynamic. It changes as the debt level drops over time. One detailed case is Congoleum Inc., where projections had to consider multiple debt tranches, repayment schedules, and the corresponding shifts in risk. The whole exercise becomes almost iterative, as you need to adjust discount rates year over year based on capital structure changes.
Definitely, it's a real juggling act. And this iterative approach reflects the broader theme. Acquisitions, takeovers, and buyouts are all about balancing potential upside with substantial complexity. Even if the strategic rationale is clear, the execution, be it valuation, financing, or integration, must be handled with extreme precision.
Exactly. And let's not forget, even if a deal looks great on paper with superb synergy and premium control estimates, biases can creep in. Both the bidder and target sides might choose comparables or multiples that tilt the valuation in their favor. It's almost like they're trying to create a narrative that justifies the price.
And that subjective element can really turn a fair deal into an overpaid one. So, the takeaway for any acquirer is to approach these deals with a healthy dose of skepticism and rigorous, unbiased analysis. One must ensure that each component, from the status quo valuation, the control premium, the synergy calculations, to the financing decisions, is aligned with reality and not just managerial optimism.
Absolutely. In the end, while acquisitions might seem like a shortcut to achieving strategic objectives, they rarely are. They require a deep dive into every facet of valuation and a constant check on managerial biases. The devil truly is in the details.
Couldn't have said it better myself. And that's what makes this topic so endlessly fascinating. From the theory behind capital structure tweaks and tax benefits to the practical challenges of integration and accounting treatment. It's a microcosm of the broader challenges in modern corporate finance.
Right. While there are many success stories, the research reminds us that, statistically, many acquisitions fail to deliver value to the acquirer's shareholders, sometimes even destroying wealth. It's a cautionary tale about the risks of overpaying in a bid to capture synergy or control premiums, especially when driven by managerial self-interest or misvalued expectations.
Definitely a lesson in thorough due diligence. So, wrapping it all up, acquisitions and takeovers are exciting yet high-stakes maneuvers. They offer the promise of immediate strategic gains, but come with layers of complexity, from valuation challenges and financing decisions to integration risk and potential accounting pitfalls. Success in this arena demands an unwavering commitment to detailed, unbiased analysis.
Exactly. And whether it's a merger of equals or a bold leveraged buyout, the underlying principles remain. Understand the true drivers of value, match cash flows to appropriate discount rates, and be cautious of biases. If you get those elements right, then despite the risks, you can pinpoint opportunities that create lasting shareholder value.
Absolutely. Thanks for joining us today as we untangled the complexities of acquisitions and takeovers. It's a deep dive into a world where strategy meets finance and where every decision can impact millions.
Thank you as well. We hope this discussion sheds some light on the intricate dance behind corporate takeovers, highlighting both the promise and the pitfalls. Until next time, keep questioning and keep analyzing. Welcome to the podcast. Today we're diving deep into the world of real estate valuation, and it's pretty fascinating how the same valuation principles that define stocks can be adapted to real estate.
Absolutely. It's interesting how even though real estate is often seen as a unique asset class, much of the same logic applies: cash flows, growth, and risk.
Exactly. The core idea is, whether you're valuing a stock or a building, you're looking at the present value of future cash flows and considering risk factors. But there are unique challenges in real estate, like the infrequency of transactions and the reliance on appraisals.
Right, and then you throw in issues like the differences in liquidity and the sometimes non-diversified nature of real estate investments.
Yes, that's a big one. The chapter argues that while the intrinsic valuation principles are, generally applicable, the cash flow approach, discounting, and all that, there are specific estimation issues. For instance, property values versus stock prices. Stocks trade continuously, real estate doesn't.
And the typical models that use historical price data for stocks can't just be copied over for individual properties due to the low volume of transactions.
Exactly, and that's why they often use indices or analogous properties instead to estimate risk parameters like beta. It's like saying, for real estate, you sometimes have to use rate data or create price indices rather than relying on individual property prices.
Right. And speaking of risk, I find it fascinating how real estate risk is comparable, yet distinctly different from financial asset risk. The shared characteristics really boil down to cash flows and growth, but then you have the finite life of a building compared to the infinite life of a stock.
Yes, that's a crucial point. The terminal value calculation really reflects that difference. Stocks typically assume perpetual growth, while a building's terminal value might be, diminished because of depreciation, even though the land itself can be perpetual.
And then there's inflation. The text makes an interesting case. Unanticipated inflation tends to hurt bonds and stocks, but it might actually benefit residential real estate.
Right, because in real estate, you often get a built-in hedge from, say, lease escalations, or the fact that the property's rent and values generally move with inflation. It's like the asset can adjust itself more directly to rising prices.
That interplay really shows why diversification strategies must be rethought when you consider adding real estate to a portfolio. The risk isn't just about volatility, it's about the timing of cash flows and the differences in reaction to macroeconomic variables.
Exactly, and then the valuation models themselves. Discounted cash flow valuation is applied to both public and real assets, but with important modifications. For example, one must estimate a discount rate that reflects the right risk factors.
Yep, and here's where the discussion gets interesting: estimating discount rates through models like CAPM. The chapter highlights that even if you use CAPM, you might need to adjust for the fact that many real estate investors aren't well diversified.
One neat adjustment discussed is the total beta calculation, where you essentially scale the market beta by the correlation of the investor's portfolio with the market. So for example, if the market beta is 0.40 and the correlation is 0.50, the adjusted beta becomes 0.80.
That makes sense. I totally get that, but I do wonder, don't you think sometimes this approach oversimplifies the distinct risks in any local real estate market? I mean, isn't there an argument that local knowledge and connections can actually overcome diversification disadvantages?
That's a valid challenge. While the models try to adjust for non-diversification by increasing the beta, many argue that local expertise can sometimes compensate for that risk. However, the trend has been toward more institutional involvement in real estate, which in turn tends to bring that diversified approach.
And then there's the liquidity issue. Real estate is notoriously illiquid compared to financial assets. So traditional models might underestimate risk if they don't incorporate an illiquidity discount.
Right. And the chapter suggests one practical solution: Value the asset as if it were liquid. Then apply an illiquidity discount based on current market conditions and the investor's horizon. It's that extra layer of risk adjustment that's unique to real estate.
Speaking of adjustments, the cash flow estimates themselves need careful consideration. Real estate cash flows aren't just rent. They include elements like garage income, reimbursements, vacancy rates, and even the terms of existing leases.
Yes, exactly. In the illustration of valuing an office building, we see detailed adjustments for occupancy increases, rent escalations, credit losses. It all feeds into both operating income and ultimately terminal values.
Absolutely right. And then you have to incorporate tax effects too: depreciation, interest tax shields, and capital maintenance adjustments. That's really something that distinguishes the real estate DCF.
Exactly. These tax benefits can make a significant difference. The chapter points out that using pre-tax cash flows versus after-tax cash flows can easily lead to a wide disparity in valuation, sometimes as much as a third difference in the estimated property value.
Now let's talk about comparable valuation, which many practitioners use as well. What struck me was how methods like price per square foot or gross income multipliers are analogous to PE or PB ratios in equity analysis, except that you have to account for differences in location, condition, and even occupancy rates.
Right, and that introduces subjectivity. For instance, comparing comparable properties, one has a slightly lower operating income per square foot, or maybe a poorer location, gets tricky. It's not just numbers, it's qualitative as well.
And the regression approach they outlined is an attempt to systematically capture these differences. Even though sample sizes are often small, it provides, tentative estimates of value based on observed correlations with occupancy and other variables.
True, but as you mentioned earlier, the limited data can weaken the regression's power. That said, in more liquid markets or with more available data, regression might become very robust.
Then, of course, there's the issue of valuation for real estate businesses themselves, not just the underlying property.
Exactly. When you look at a REIT versus a real estate development firm, you have to account for not only the quality of the underlying assets, but also the organization's structure, tax treatment, control of dividend policy, and so on.
And in the case of REITs or MLPs, you're dealing with single taxation effects. This means the cash flows to the investors are already adjusted for that benefit, which can be a huge differentiator.
Yes. Plus, the dividend payout requirements for REITs constrain growth, but provide steady income. So, while the intrinsic value can be estimated using discounted cash flows, what you ultimately see in the market price is influenced by restrictions on financing and the nature of investor expectations.
It really seems like real estate valuation is a balancing act between systematic quantitative models and a lot of qualitative judgment, considering everything from regulatory environments and rent control to local market nuances.
Exactly, and that's why many of the problems posed at the end of the chapter challenge us to think critically about the applicability of these methods. For instance, using a beta of 0.20 from appraised data might seriously understate risk because of smoothing effects inherent in appraisal-based returns.
I would agree with that. And then comparing that to using REIT data, which might yield a more volatile beta due to actual trading, brings up the whole debate of which approach is more reliable.
Definitely. It's a trade-off between representativeness and statistical robustness. Some argue that REIT betas might better capture market risk, while others say they're biased by the liquidity and diversification characteristics of institutional investors.
This is where understanding the underlying investor base is crucial. If you're dealing with individual local investors, then the total beta adjustment might be more appropriate. Institutional investors, on the other hand, might align more with the CAPM assumption of a well-diversified portfolio.
Precisely, and that leads us to the final part, the practical application. When valuing an office building or even comparing it to sales of similar properties, you have to strip out factors like local market differences and lease structures. Even the capitalization rate, sometimes computed as RG, adjusted for growth, is sensitive to nuances in operating income.
Right, absolutely. In the end, whether you're using discounted cash flow, comparable approaches, or even regression, it all comes down to making reasonable assumptions and understanding that every method has its strengths and limitations.
Exactly. And while the models provide a framework, you need to overlay market conditions, investor behavior, and the inherent uncertainties of real estate markets. That's what makes this field both challenging and exciting.
It really is. So, to wrap it up, it's clear that even though real estate differs substantially from financial assets in some respects, applying refined and adjusted valuation techniques from finance can, with careful handling, provide robust estimates of property values and investment returns.
Absolutely, and it's that blend of quantitative rigor and qualitative insight that keeps the field so dynamic. Thanks for the great discussion today.
Thank you. It was an enlightening dive into the nuances of real estate valuation.
Welcome to the podcast, everyone. Today we're diving into the complexities of valuing various assets, ranging from cash flow generating businesses to collectibles and even gold. It's a wild landscape, right?
Absolutely. It's like a whole universe of valuation methods. What really stands out to you in this discussion?
Well, the core idea is that even though these assets are vastly different, like a franchise, a cab medallion, a dental practice, or a piece of fine art, they can largely be split into three categories. First, we have ones that produce cash flows. Second, those that don't produce cash flows but have value because they're scarce or provide utility. And third, assets with option-like qualities.
And each category requires a different approach. For the cash flow producers, it's pretty standard. Discounted cash flow analysis, where you project future cash flows and then discount them back, right?
Exactly. Think of assets like franchises or even New York City cab medallions. The valuations here depend on things like expected cash flows over time and, importantly, the risks associated with those cash flows. You'd estimate, for instance, revenues, operating costs, depreciation, and then choose a discount rate based on risk, like cost of equity or capital.
Yeah, and it's interesting how they adjust for everything from local economic conditions to regulations, as in the cab medallion example, considering things like fare structures and exclusivity of medallion rights, right?
Absolutely. It's like, imagine you're operating a taxi in this dense economy where every little shift in financial services has an impact. The cab medallion's worth, for example, was affected by factors such as the cab's operating costs, downtime, and even the frailties in the city's economy.
That makes sense, but what about franchises? They seem to offer a whole other set of nuances, especially with factors like brand name value and exclusivity.
Right. Valuing a franchise can be mixed because while you get the benefit of a strong brand, like McDonald's, which translates into higher prices and more customers, there are challenges too. For example, the potential spillover of the franchisor's issues onto the franchisee, or even the risk that the franchisor might change agreement terms unilaterally. It's sort of like having a trusted teacher look over your shoulder, but sometimes dictating exactly how you should do things.
I see. And there's also the personal component factor, how the skill or reputation of the franchise operator affects overall value.
Yes, exactly. In many cases, a key person, like a star chef in a restaurant or a renowned dentist, can drive a lot of value. If that person leaves, cash flows can drop dramatically. This was really explored with the dental practice example, where the difference in value with and without the key person was used to estimate the key person's value.
So, in a sense, you're saying that some parts of the valuation are qualitative, right? It's not just numbers. It's also about reputation, efficiency, and even customer perception.
Right, and that segues us into the second category, assets that don't produce steady cash flows, but are valuable because of scarcity or perceived utility. Think collectibles like rare coins, antique paintings, or even baseball cards. Their valuation almost entirely depends on relative valuation methods.
Now that's tricky because, unlike with cash flows, there's no intrinsic value inherent to them. Their worth is all about what the market says, correct?
Spot on. For non-cash flow producing assets, you rely on comparables. Like if you want to value a Picasso, you'd compare it to recent sales of similar Picassos. But then you run into challenges like market liquidity and the fact that no two art pieces are exactly alike.
You know, I sometimes wonder how reliable that is. Isn't it a bit of a gamble to base value entirely on market mood and scarce transactions?
That's a fair point. It definitely introduces volatility. This is why experts often say, buy art because you love it. Because while the diversification might help your portfolio, the financial returns are often suboptimal compared to, say, blue chip stocks.
Makes sense. And then we have the third category, right? The assets with option characteristics.
Yeah. These are assets whose value partly comes from their potential. Take copyrights on a book. While the steady cash flows might be modest initially, the asset could be worth a lot more if, say, the author hits a billion-seller status. Similarly, think about off-Broadway shows. Low cash flows, but a possibility of a breakout hit can drive premium bids.
It's like buying a lottery ticket, but in an investment sense. You're paying just in case that big windfall happens.
Exactly. That's the option component. And this method is really important when valuing assets that might have a transformative event in the future. It's like an emergency option built into the asset's valuation.
Interesting. And let's not forget the discussion on trademarks and copyrights. Their value is often traced back to the exclusive rights they provide. These are already well known, right?
Yes, trademarks and copyrights let you, well, control a product or service for a limited period. Valuation here usually is done on a DCF basis if the asset produces cash flows, or on a comparative basis if it's more about perception. The example with John Wiley & Sons shows how you can separate stable and volatile segments of cash flows, discount each appropriately, and combine them for a total value.
Right. I really like how these models, even though they are built on the same fundamental principles, adapt to cover such a range of assets. But don't you think that sometimes the estimation of cash flows for, say, a franchise or a key person business can be overly optimistic?
I do get that concern. There's always a risk of overestimation, especially factoring in elements like brand spillovers or estimating how many extra bucks a star chef brings in. The models assume you can quantify everything, yet in practice, there's a fair bit of judgment involved. It's like you might have to adjust the discount rate to account for uncertainties that are hard to measure precisely.
Right, and that's where sensitivity analysis comes in handy. It helps you see how small changes in assumptions could have big impacts on the value.
Exactly, and even though the basic formulas remain the same, whether it's a DCF model or a multiple valuation, the messy part is getting accurate inputs. For instance, our New York City cab medallion example uses assumptions about cab operating days, driver costs, and even local regulations. Each variable can add noise.
Yeah, I can see that. And then there's gold. Now, gold is a special case since it doesn't generate any cash flows at all.
Right. Gold is valued on relative terms. Its value is built on scarcity and historical trust. It's like, it's not an investment because of its income. It's more of a store of value. When central bank trust wavers, gold prices go up and vice versa.
So you end up with a kind of mood-based valuation, where investor sentiment drives the price rather than fundamental cash flows.
Exactly. This is why understanding what the intrinsic versus relative value means is key. Intrinsic value works when there are measurable cash flows. For gold, since there are no cash flows involved, its value is entirely relative and driven by demand-supply dynamics and investor psychology.
Now, what about the practical applications? The chapter went into some detailed examples. The cab medallion, the dental practice, even that famous restaurant Lutece.
Yes, those illustrations are super helpful. Each one details how to break down revenue streams, operating costs, depreciation, taxes, basically step-by-step approaches. The cab medallion example nicely illustrates how various operating days, fees, and even financing choices affect the overall valuation. And the restaurant example highlights how growth rates and discount rates are determined using public benchmarks.
It seems like regardless of the asset, the valuation is really all about assessing risk versus future potential. And whether the asset's value is largely intrinsic, perceptual, or optional, The basic models tie back to the principles of cash flow, scarcity, and comparative analysis.
Absolutely. And the chapter also stresses that while inputs might be noisy or hard to quantify at times, you shouldn't abandon these models. Instead, refine your assumptions and use multiple approaches if you have to. It's a delicate dance of art and science, very similar to investing in art itself, where passion sometimes outweighs the hard numbers.
Yeah. Speaking of art, I found the discussion on art indexes and how art's low correlation with stocks makes it an interesting portfolio diversifier really intriguing. But given its low returns historically, would you really recommend it in a portfolio, strictly from an investment standpoint?
That's a good challenge. I think it's a balance. Despite lower returns, its diversification benefits, due to a low correlation with traditional assets, might make it a worthy inclusion, if you're passionate about it. But it's important to remember that, as the chapter emphasizes, art should be bought mostly for the joy and the aesthetic value, not solely for its potential returns.
And then we also get those practical problems and questions at the end, like figuring out how much to bid for a baseball card on eBay, or valuing an actual operating business like Cool Cafe with all its complexities.
Yeah, those questions really cement how these ideas translate into real-world scenarios. They push you to think about the costs, the potential drop-offs if a key person leaves, and even the tax implications and financing mix. It's a comprehensive framework which, despite its complexities, remains remarkably structured.
All in all, it seems that no matter how you slice it, whether it's a franchise, a collectible, or even gold, the core is to understand where the value comes from and then apply the right model. That's a powerful takeaway.
Exactly. Understanding the underlying principles helps avoid overpaying and ensures that, even with messy assumptions, you can at least get a reasonable estimate on where the value lies. And that's what makes it all so fascinating, doesn't it?
Absolutely. It's the balance of quantitative analysis and qualitative judgment that makes asset valuation such an art and science in itself.
Well said. Thanks for this dynamic discussion. It's been quite the deep dive into valuing other assets.
Yeah, thanks for breaking it down. Until next time, keep questioning and crunching those numbers.
Welcome to the podcast. Today, we're diving into the fascinating world of delaying investments and how these options are valued beyond the traditional net present value analysis.
Absolutely. It's intriguing how a project that might look like a dud right now due to a negative NPV can actually hold hidden value if you wait for more favorable conditions.
Right. Essentially, we're arguing that many investments come bundled with an option to wait, which is kind of a call option on a project. When the cash flows are volatile or the environment is uncertain, waiting could actually generate a positive payoff. It's like holding off until the storm passes, you know?
Yeah, and it's almost counterintuitive. In a static analysis, you dismiss a project because NPV is negative today, but if there's high variance, the future cash flows could swing into positive territory.
Exactly. And the interesting part is that this option behaves much like a traditional call option found in financial markets. You have the underlying asset. Here, that asset is the project itself, with its present value of expected cash flows, and the strike price is basically the upfront investment required.
Right. So, the rule becomes pretty straightforward. If the present value V of the cash flows exceeds the cost X, then you invest now. But if V is less than X, you might want to wait, right?
Yep, that's the decision framework. But let's delve a bit deeper. Not only do you compare V and X, but you also need to factor in the volatility of V. The higher the variance, the more valuable your option to delay becomes, because there's a greater chance the project's future value could improve.
And there's an interesting trade-off too. Waiting increases the potential upside, but it also means you might forgo some cash flows that could have been captured if you invested immediately.
Right. This is sometimes expressed as the cost of delay. It's fascinating because the cost can be measured as something like 1 divided by the number of years of exclusive rights you're holding, or even more generally as the next period's cash flow relative to the current present value.
Yeah, and while that sounds simple in theory, when you actually crunch the numbers, it gets really nuanced. For instance, estimating the variance is no small feat. It may come from historical projects, scenario analysis, or even the variance in similar firms' cash flows.
Absolutely. If you're looking at patents, like for instance with pharmaceutical products such as Avonex, or even with undeveloped natural resources, variance plays a critical role. In fact, even if a patent has a negative NPV today, its option value might be substantial because the underlying cash flows are highly uncertain.
And that's where the idea of using option pricing models comes in. Using models like Black-Scholes or the more flexible binomial model can help us assign a value to that option, even though the underlying asset isn't traded.
Exactly. And what's really neat is how these models require similar inputs. The current value of V, the strike price X, the variance, the time until your option expires, which might be defined by a patent life or a lease period, and even a sort of dividend yield, which stands in for the cash flows you'd lose by delaying.
Speaking of which, I sometimes wonder if using the riskless rate is always the best reflection of the discounting needed in these models. After all, with non-tradable assets, the absence of arbitrage might be more theoretical than practical.
That's a valid point. Some argue for adjusting the riskless rate upward to account for illiquidity and execution difficulties. But others suggest, as in our discussion, that the replicating portfolio can be constructed on paper, even if you can't trade it practically, so it gives you a lower bound at least.
And what about the application to natural resources, like oil or mining reserves? The process is quite similar. A reserve can be treated as an option where the underlying asset is the resource's estimated value, and your exercise price is the cost of development.
Yep, like in that oil reserve illustration where they use the Black-Scholes model. You discount the reserve's value over the development lag and then compute the call option's value, capturing the potential upside if commodity prices rise.
Yeah, but here's where it gets even trickier. If you introduce uncertainty in the quantity of the resource, not just the price, you now have to decide whether to merge the uncertainties or treat it as a more complex rainbow option, where you're looking at multiple sources of variance.
Exactly. That rainbow option concept is quite a mouthful, but it really drives home how multidimensional uncertainty can affect value. It's like, if you're baking a cake, and not only doesn't your oven heat evenly, but you're also not sure how much flour you have. Both add extra layers of complexity.
Haha, true indeed. Now shifting gears to patents and intellectual property. Here the option to delay is crucial as well, because a firm might knowingly delay the commercialization of a patent like Avonex to wait for further improvements in technology or market expansion.
Right. They can capture a time premium if the improved technology enhances the cash flow potential. And the analysis even shows that the patent might be worth more if you wait until uncertainty resolves, provided the cost of delaying isn't too high.
That reminds me, the discussion even brought up, respectfully, that sometimes even projects with a positive NPV might be delayed. It's counterintuitive for some traditional investors who think, if it's in the money, why wait? But the option element suggests that if volatility is substantial, you might actually be better off waiting.
Exactly. And that highlights the importance of viewing investment decisions in light of their optionality, rather than just straight-line discounted cash flows. Plus, this framework even extends into valuing whole firms, like Biogen, with patents and with anticipated future R&D benefits.
Yep. In the Biogen example, you see a three-part decomposition of firm value: the cash flows from already commercialized products, the value of patents that haven't been exploited yet, and the value of future patents from ongoing R&D. Each part reflects this option-like behavior in different ways.
Exactly. And as soon as you realize that elements like future R&D can create additional call-like options on future projects, you get a more comprehensive picture. In traditional DCF, you might end up underestimating the value because these extra components aren't captured.
Absolutely. I do wonder, though, how robust are these option pricing models when the assumptions, like log normal price paths or constant variance, don't hold true in practice?
That's a fair critique. In real life, sudden technological shifts or market disruptions can really mess with the diffusion process assumed in these models. And while the binomial model offers a bit more flexibility by allowing for early exercise, it comes at the cost of greater computational complexity.
Yeah, I agree. And this is why some practitioners stick to traditional DCF methods for established firms with lots of patents and reserves, while the option pricing framework might work better for small firms where a few options drive most of the value.
Exactly. It's about context. For companies with heavy, diverse assets, the option approach might be over-engineering the analysis, whereas for startups or tech companies with a few key innovations, valuing each patent as an option can reveal hidden premiums that DCF would just ignore.
Yep. And you know what's really insightful? The discussion even extends to other fields, like real estate, treating vacant land as an option to invest in commercial development, or copyrights and licenses as options too. It's a very unified way of thinking about future potential.
Absolutely. And that's the beauty of applying financial options theory to real investments. It lets us quantify that flexibility. And if you think about it, increasing uncertainty can sometimes make what looks like a poor investment at first glance really valuable.
Indeed. That's a great takeaway. It reminds me, though, that while the theory is elegant, the practical application can be challenging, especially when proprietary information is required to determine variance or the expected cost of delay.
Exactly. The models are only as good as the inputs you feed them. And in many cases, these inputs are hard to nail down precisely. But they do provide a framework that forces you to think about all these dimensions, like exclusivity periods, variance, and competitive pressures.
And speaking of competitive pressures, it's interesting how the potential entry of competitors can effectively shorten the option's life. For example, if a competitor is close to developing a similar product, your window to exercise the option shrinks, reducing its value.
Exactly. It emphasizes that value is not just a function of the asset's volatility, but also the environment, like regulatory protection in patents or barriers to entry in natural resources. Those elements are critical in adjusting the model.
Yeah, absolutely. So, in summary, while traditional NPV analysis is straightforward, incorporating the option to delay really adds another layer of insight by capturing the value of waiting under uncertainty.
That's right. The real lesson is that in volatile and rapidly changing industries, considering optionality can lead to significantly different and often higher valuations than a static DCF approach. It's like finding hidden bonus features in your investment.
And that's why we see so many fascinating examples in tech, pharmaceuticals, and even in natural resources, where treating undeveloped reserves as options has led to a revelation of hidden value.
Exactly. Whether it's an oil reserve waiting for a price uptick or a patent that could deliver a breakthrough product in the future, the option to delay is a reminder that timing can be everything in investment.
Right on. Thanks for this deep dive. It really highlights that flexibility under uncertainty is not just a strategic play, but a quantifiable asset too.
Absolutely. And it shows us that strict cutoffs based on NPV sometimes miss the potential embedded in our ability to wait. Until next time, keep rethinking those investment decisions. Sometimes it's best to wait for the right moment. Welcome to our discussion. Today, we're diving deep into the dynamics of investment options, focusing on the option to expand and the option to abandon. It's a fascinating exploration of how traditional discounted cash flow methods can miss out on strategic value.
Yeah, absolutely. I mean, with these options, firms can essentially turn a seemingly negative NPV project into a potentially valuable proposition, right?
Exactly. It's like you're not just investing in a project, you're also, buying a ticket to future opportunities, whether that's expansion into new markets or even abandoning the project if it doesn't pan out.
It's crazy how a simple choice like delaying or expanding an investment can greatly change a firm's valuation.
Right. Take the expansion option, for instance. Firms may invest in projects even when the immediate NPV looks poor, because, well, they acquire the option to invest further, like launching additional products or entering new markets if conditions turn out to be favorable.
Yeah, totally.
This essentially makes the underlying asset, that potential future project, much more valuable.
And that value, of course, is captured by option pricing models using inputs like the present value of expected future cash flows, the cost of expansion, which is akin to the strike price, and of course the volatility of those cash flows.
And the methodology really borrows from the traditional Black-Scholes and binomial trees. For example, in that Ambev and Guarana case, the initial investment had a negative NPV, but the option to expand, estimated at over 200 million, more than offset it.
That's a perfect illustration. It shows that by investing in a smaller, perhaps negative NPV project, the firm actually positions itself for a lucrative opportunity later. But, just to play devil's advocate, do you think it's always that clear-cut? Sometimes wouldn't the uncertainty muddle these estimates?
That's a great question. While the theory is elegant, in practice there are challenges. For one, estimating the variance, or the volatility, in these cash flows is tricky. Firms often rely on Monte Carlo simulations or use data from similar publicly traded companies to estimate that.
Exactly, that's why it's more art than exact science sometimes. Definitely. And then there's the issue of determining the life of the option itself. Unlike patents with a fixed legal life, expansion options can be open-ended or subject to arbitrary internal constraints.
Yes, exactly. For instance, a firm might impose an internal rule that if expansion doesn't occur within, say, 5 years, they'll pull out. But that 5-year period is, in many cases, more of an arbitrary decision than a market force.
Right, and it can drastically affect the option's value. The shorter the window, the less time for favorable market conditions to emerge, and hence a lower option value.
Now, shifting gears a bit, the option to abandon. This is sort of like having a built-in safety net. If a project starts to lose steam, the firm can cut its losses. It's essentially the inverse of the expansion option, resembling a put option.
Yeah, it's like your downside protection. Precisely. In the Airbus and Lear example, even though Airbus was facing an unattractive NPV on paper, Lear's proposal to buy them out later for a fixed price effectively gave Airbus an abandonment option, protecting against severe losses.
Yes. And when you plug those numbers into the Black-Scholes framework, you can actually quantify that protection. Even though it's unusual to see a project with a negative NPV become viable because of such an embedded option, it highlights the managerial flexibility companies need.
And that flexibility itself carries tangible value, which often gets ignored in traditional discounted cash flow valuations.
Exactly. And speaking of flexibility, we should also touch on financial flexibility in general. It's not just about operational decisions. It's also about maintaining cash reserves or excess debt capacity to seize sudden opportunities.
Yes, and the analysis of Home Depot's flexibility is a great case in point. They estimated the value of flexibility at around 1.64% of the firm's value annually, which is significant compared to the slight cost savings from simply lowering the cost of capital via increased debt.
Absolutely. This, in turn, shows that financial flexibility is more than just keeping cash on hand. It's a strategic tool to allow companies to make unanticipated, high-return investments when the time is right.
Right. And there are determinants for that value: higher excess returns, volatility and reinvestment needs, and even a firm's ability, or lack thereof, to access external capital.
Exactly. Think of it like having an umbrella during a storm. You invest in that flexibility because you never know when you'll need it, especially if external financing might be hard to come by, or if earnings are unpredictable.
Yep, no one wants to be caught unprepared. I'm also intrigued by the concept of sequential or compound options, where you have options on options. It really complicates the valuation, but also really reflects the step-by-step nature of some investments.
Right. And it's like those multi-stage projects where, at each stage, you have to make a go, no-go decision based on the outcomes of the previous stage. This sequential approach can sometimes convert an otherwise unattractive project into a valuable one.
Exactly. But don't you think that, in real life, it could lead to managers overestimating their flexibility by cherry-picking the best-case scenarios without properly accounting for the costs or risks associated with each stage?
That's a valid concern. There's always the risk of double counting the option value. For instance, if you use a higher growth rate in your cash flow estimates because of the expansion potential, and then also add an option premium, you might be counting the same potential twice.
Exactly, it's a delicate balance. And then there are also numerous practical issues. Like with the abandonment option, for instance, the salvage or liquidation value might be uncertain, and there could even be costs, such as severance or shutdown expenses that affect its value.
Yes, exactly. Abandonment isn't always free money. Sometimes it's a costly procedure. It all points back to the need for rigorous quantitative estimation, using Monte Carlo simulations to estimate variances, for example, and not just qualitative judgments.
Speaking of simulations, that whole process of drawing from probability distributions to estimate the variance in cash flow and project values makes me think of the challenges analysts face. It's not only about technical skill, but also about the reliability of those estimates.
Indeed. And if those inputs are off, then even the best models won't yield valuable insights. It's like trying to navigate using a map that might be outdated.
Right, a small error in the input can magnify in the final valuation. So, in your view, how should managers use these valuations practically? It seems like a double-edged sword that could justify otherwise poor investments.
That's a crucial point. Managers need to be very cautious. While these real options provide a sophisticated way to account for flexibility, they should never be used as a catch-all excuse for projects with negative cash flows on paper. Instead, they should be rigorously quantified with a disciplined, quantitative approach and, ideally, validated against market data.
And I suppose that's why there's an emphasis on reconciling DCF valuations with real option approaches. In traditional DCF, you use a constant discount rate, but if the risk exposure shifts over time, you might be undervaluing or overvaluing these embedded options.
Exactly, because with the real options approach, you have a dynamic perspective. Rather than just relying on a single discount rate, you're capturing how market risk evolves with future cash flows or potential investments, making the valuation more responsive to actual conditions.
And these insights really have profound implications for strategic acquisitions, R&D, even multi-stage investments. Basically anywhere there's an element of uncertainty and managerial flexibility.
It's transformational in understanding the true value of flexible strategies. Whether it's a tech firm like Secure Mail, looking to leverage its technology for future products, or large retailers maintaining financial flexibility, these concepts are game changers.
Yeah, totally. What really strikes me too is how these options can lead to fundamentally different corporate strategies. For instance, a firm might deliberately choose an initial investment with a negative NPV if it acquires a high-value option to expand later.
And that's the beauty and the complexity of real options. They allow companies to hedge against uncertainty while capitalizing on potential upsides. It's like paying a small upfront cost for a really valuable life insurance policy against market volatility.
Right on. So, if we sum this up, the key takeaway is that discounting cash flows in a static manner may miss hidden strategic value. Incorporating options to expand and abandon gives a more comprehensive picture of a firm's potential.
Precisely. And for advisors and managers alike, the challenge is to estimate these option values correctly without overstating them, using simulation methods, market comparisons, and being aware of the limitations.
And while it's not a perfect science, it's definitely a step forward in making investment decisions more aligned with real-world uncertainty and managerial flexibility.
Right? So whether we're talking about securing an advantageous exit via an abandonment option or leveraging a negative NPV project into a booming expansion, the art of option pricing brings rigorous insight into decision-making.
Yeah, that's the crux of it. And just to loop back, these analyses remind us that every investment is layered with risk, opportunity, and flexibility. Concepts that, when properly valued, can lead to better strategic choices.
Absolutely. And while the calculations, like using black skulls, estimating variances from Monte Carlo simulations, and constructing replicating portfolios, might seem daunting, they're essential for aligning numerical analysis with strategic vision.
No doubt about that. Well, this conversation has really unpacked the complexity and the strategic nuance behind these real options. There's so much that goes on behind the scenes of those investment decisions, beyond the cash flow forecasts.
Precisely. And hopefully our discussion can shed light on how crucial it is to look beyond the surface when evaluating investments. It's not just about immediate numbers, but also about future flexibility and managing uncertainty.
Yeah, it's been a great dive into these concepts. I know there's certainly more to explore, especially with sequential and compound options, but I think we've covered a solid ground today.
Indeed. Thanks for the chat, and let's keep this conversation going as these dynamic approaches to valuation continue to evolve in practice.
Absolutely. Thanks for the insightful discussion.
Welcome to the podcast. Today we're diving into equity valuation in distressed firms, focusing on the idea that equity can be seen as a call option, largely due to limited liability and the choice to liquidate.
Yep, that's a really interesting framework. It turns the typical discounted cash flow approach on its head, right?
Exactly. It's like instead of letting go of traditional cash flow models, we embrace an option pricing framework. Here, even when a firm has negative earnings and massive debt, equity might still retain value.
True. So, the key point is that equity holders in heavily distressed, highly levered firms have what essentially amounts to a call option on the firm's assets after debt is paid, which is possible thanks to limited liability, yeah?
Right on, yes. The equity payoff on liquidation can be modeled as max V, D, 0, where V is the liquidation value and D is the outstanding debt. This resembles a classic call option, with the strike price being the debt.
Yep, I follow. And this is particularly relevant when the firm has substantial debt. Traditional DCF models just don't cut it because they assume that eventually margins turn positive. But here, if the firm defaults, the equity holders are only exposed to the upside.
Exactly. In distressed firms, you can have a situation where the firm's asset value might be lower than D, but because the equity holders have the choice to liquidate, they preserve their limited liability. They get the upside if assets improve, even if the firm as a whole isn't doing well.
That's the crux of it indeed. I'm curious, how does the Black-Scholes framework come into play here?
Well, the Black-Scholes model is used to assign a value to that call option. By plugging in the firm value as the underlying asset, setting the debt as the exercise price, basically the life of the option matches the maturity of the debt. And we use the variance of firm value as our measure of volatility. So for instance, if we have a firm valued at, say, $100 million with debt of $80 million, and an asset volatility of 40%, we can estimate equity value.
Yeah, makes sense. So then, even if the firm's asset value falls below the debt level, the equity isn't completely worthless because of the time premium. That possibility of turning things around before the debt matures, right?
Exactly. Think of it like a deep out-of-the-money option, which still holds value because there's a chance that the asset value will surpass the strike price before expiration. Even at very low asset valuations, equity retains this latent, option-like value.
Right, that's what makes it so counterintuitive but fascinating. And this ties directly into the idea that risk can actually be beneficial for equity holders in these firms. Higher volatility increases the value of the option, which in this context is the equity, correct?
Exactly. While traditionally risk is seen as bad for firm value, in the case of distressed firms, the upside effect of volatility for equity is significant. It means that equity holders have little downside due to limited liability, but they can really benefit if the firm's situation improves dramatically.
It's ironic, isn't it? More risk sometimes means more opportunity for upside. But wouldn't that encourage equity holders to sometimes even take on projects with negative net present values just to boost variance?
That's a great point. And yes, the literature suggests exactly that. Equity investors might pursue riskier projects, even those with a negative NPV, because the option value increases with volatility. This can, however, lead to a conflict with bondholders, whose value deteriorates as volatility increases.
Which is an interesting agency problem. I remember an illustration where a firm with $100 million assets and $80 million debt saw its equity value rise from around $75 million to nearly $78 million, despite a $2 million hit to firm value, just because the risk increased. But it costs a lot for the bondholders.
Yes, well remembered. It's a clear illustration of stockholders benefiting at the expense of bondholders, thereby shifting the wealth distribution within the firm. Equity as a call option, in this case, is essentially a zero-sum game once you account for the increase in default risk.
That indeed challenges a lot of traditional thinking. And speaking of challenges, isn't it also the case that for high-growth firms, with lots of potential yet little asset backing, using this option pricing method underestimates equity value?
Right, that's an important nuance. For firms that derive value primarily from future growth rather than existing assets, liquidating value, and hence the call option model, will often understate the going concern value. So, the method applies best when the firm's value is more tied to its assets in place and heavy debt, as in distressed or mature, asset-heavy firms.
Exactly. Let's also consider the Eurotunnel example mentioned. Even though Eurotunnel was in massive distress, with negative earnings and enormous debt, the call option framework helped estimate its equity value, which turned out to be somewhat close to the market value.
Yes, the Eurotunnel case is a neat practical application. In that case, detailed assumptions on projected cash flows, asset value, debt profiles, and the standard deviation of firm value were used to compute D1 and D2 for the option pricing formula. Even with deep financial trouble, the option value of the equity remained significant.
It's an impressive analysis. And they even adjusted for the debt's maturity by calculating the weighted average duration, which gave a more refined measure of the life of the option. That level of precision is impressive.
True, and it brings in the conversation about debt structure. When a firm has multiple debt issues, each with their own coupons and maturities, you need to consolidate them into one equivalent zero-coupon debt measure to apply the option pricing methodology effectively.
Absolutely, that's a key step that many might overlook if they're not careful. So, I'm thinking the equity's call option value heavily relies on both the debt duration and the variance in the firm's asset value. Do you have any thoughts on how management should interpret these factors?
Yeah. Management should realize that actions that inadvertently decrease the debt duration, say by restructuring or refinancing for longer terms, can actually boost equity value. Similarly, increasing operational volatility, though risky, may be beneficial for the equity holders.
But it's a double-edged sword, isn't it? Right, and that's where I have to challenge this perspective a bit. Isn't intentionally courting higher volatility dangerous in terms of the firm's overall risk profile, even if it temporarily boosts equity value?
Fair point. It is dangerous. But in distressed settings, equity holders are already at the mercy of downside risks, since their downside is capped. So, while higher volatility increases the probability of a large payoff under good circumstances, the downside is limited by the personal liability shield. But of course, this strategy does harm bondholders.
That's a delicate balance then. With bondholders, the increased volatility leads to a higher default probability and wider default spreads, so their expected returns take a hit.
Exactly, and we see that clearly in the calculated default spreads. As the standard deviation in firm value rises, the risk-neutral probability of default, computed as 1 minus n d2, also increases, meaning bond interest rates have to adjust upward to compensate.
Correct. It's really interesting how this model can also be used to assess vulture investing strategies, where investors buy deep out-of-the-money equity in troubled firms.
Yes, vulture investing, in a way, is about buying these options, expecting that even if most will expire worthless, a few will pay off massively. This portfolio approach to investing in distressed firms is completely in line with option pricing theory.
That's a fascinating, albeit risky strategy.
And another implication of the model is in mergers and acquisitions, especially conglomerate mergers. When two companies merge, if their earnings are not perfectly correlated, the variance in the combined firm's earnings decreases. Because equity value as a call option benefits from higher volatility, the merger could actually reduce equity value, shifting wealth to bondholders.
So essentially, if a merger stabilizes earnings, it might hurt equity holders if their value is tied to volatility. Yeah, that's a critical insight for both managers and investors.
Exactly, and that's where the conflict between stockholders and bondholders comes into play. Stockholders might be incentivized to merge or take on risky projects that benefit them at the expense of bondholders.
Right. This clearly highlights an agency problem. Stockholders can act in their own interest since they have an asymmetric risk exposure, while bondholders bear most of the downside risk.
Yeah, and it's also an important point for regulators and investors to consider when evaluating distressed firms. The structure of debt and the nature of investments can result in unintended transfers of wealth from creditors to shareholders.
Which is why transparency in these transactions is so crucial. Now, besides the theoretical models, practical spreadsheets like equity.xls can help estimate these values using real market data. These tools allow practitioners to incorporate market values of both debt and equity, compute variances, and even factor in aspects like coupon debt.
Absolutely, and they underline the importance of using real data, like the trading values for bonds and stocks, to refine our estimates for variables like firm value variance. This grounded approach can really make the difference in accurate valuation.
Yes, data-driven analysis is key here. To sum up, the equity as a call option framework offers significant insights into how distressed firms can still carry equity value, how risk and volatility operate differently under limited liability, and how the debt structure can dynamically contend with equity value.
Right. And while the approach has its limitations, such as not applying straightforwardly to high-growth firms, it still provides a robust way to analyze distressed or asset-heavy, highly levered companies. It's like flipping traditional valuation on its head by using option theory.
Absolutely fascinating. And that's it for our discussion today. Thanks for joining in on this deep dive into distressed firm equity valuation. It's been an engaging and thought-provoking session.
Welcome to the podcast. Today, we're diving into the intricacies of value enhancement using a discounted cash flow valuation framework. Essentially, it's about how strategic actions, changes in operations, growth, and financing can affect firm value.
Yep, absolutely. And it's fascinating how the chapter shifts from a passive investor's view to that of an investor who has the power to actually change the way a company is run. It's like stepping behind the curtain to see which levers move value.
Right, exactly. The discussion breaks down actions into two broad categories: value creating versus value neutral. For instance, actions like stock splits or name changes might have price effects, but they don't really affect cash flows or the real intrinsic value.
Yeah, that's key. They really emphasize that value creation hinges on increasing cash flows from assets in place, boosting the reinvestment rate provided that the return on capital exceeds the cost of capital, lengthening the high growth period, or lowering the overall cost of capital. It's like having multiple knobs to adjust the DCF engine.
Exactly. And speaking of that, one major point is that for any action to be value enhancing, it must drive improvements in one or more of those four areas. For example, let's take divestitures. If a firm sells an asset at a price higher than the present value of its expected future cash flows, then value is created.
I love that example. And it reminds me of the Boeing illustration in the chapter, where they compared the divestiture value against the continuing value. If the divested asset fetches more than the value of continuing operations, then the firm sees an immediate net gain in value. It's like getting a premium for assets that aren't performing at the required level.
Yes, and they even break things down further by discussing how poor investments need to be evaluated on three dimensions: the continuing value, the liquidation value, and the divestiture value. Firms should continue an investment only if its continuing value is the highest among these options.
Now moving to another pillar, operating efficiency. The text shows how improving margins through cost cutting can boost free cash flows. But, as they caution, not every cost cut is beneficial, right? It has to be done without sacrificing future growth. I mean, cutting research might boost short-term margins, but hurt long-term competitiveness.
Absolutely. It's like, if you cut too many ingredients from your secret sauce recipe, you might improve today's taste, but lose the magic next time. The chapter stresses that while some cost cuts can be quick fixes with immediate benefits, others need to ensure they don't kill the growth engine.
Yep. There's also an interesting discussion around non-cash working capital. Firms that can lower their inventory and accounts receivable relative to revenue improve free cash flow immediately. But they must be careful not to stifle sales. It's a delicate balance.
Right. Reducing non-cash working capital is almost like finding that sweet spot, an immediate cash boost versus potential lost sales if you cut too deep. And then there's the reinvestment trade-off. Increasing the reinvestment rate can drive growth, but only if the marginal return on those investments exceeds the cost of capital.
Exactly, because otherwise you're just burning cash without creating additional value. I find the comparison between Boeing and Home Depot in the examples quite illustrative. Boeing, with a return on capital less than its cost of capital, would actually destroy value if it increased reinvestment further. In contrast, Home Depot, generating excess returns, sees a higher reinvestment rate as beneficial.
Absolutely. The key is that extra growth must come from investments that earn more than the cost of capital. Otherwise, scaling back might be the better strategy, a point they emphasize in the section titled "Less is More, the Value of Less Growth." Sometimes, not reinvesting in non-performing projects can raise overall firm value.
That's a bold idea because many managers are obsessed with growth at all costs, even when it's value destructive. Activist investors often target these firms, pushing for divestitures or restructuring to exit the poorly performing segments. It's like saying, hold on, sometimes stopping is better than going.
Exactly. And then there's the strategic side where long-term value is built by extending the period of high growth through competitive advantages like brand names, patents, or switching costs. The Coca-Cola example is brilliant. Enhancing brand value translates into long-lasting higher margins and, in effect, sustainable growth.
Right. Yes, and if you think about it, building a brand is very much a long-term gamble. It doesn't flip a switch overnight. But once you achieve that, like with Microsoft or Coca-Cola, the benefits compound over time.
Totally. And then there's the impact of cost of financing, which influences the discount rate in the DCF model. By optimizing the debt-equity mix and reducing financing costs, a firm can boost value. The discussion on Miller-Modigliani also comes into play here.
Right. The text points out that in a world with taxes and default risk, the traditional MM theorem doesn't completely hold, so financing decisions really matter. It's not just a textbook abstraction. Real-world trade-offs do matter.
Yes, exactly. They detail that an optimal debt ratio exists, where the benefits of cheaper debt and tax shields balance the increased risk of bankruptcy. Take SAP, for example. The analysis shows that at a 30% debt ratio, they minimize their cost of capital and thus increase value per share by about 12%.
Yeah. Now I want to play devil's advocate for a moment. Some might say that these adjustments in working capital or financing mix, while mathematically valid, could be oversimplified in the real world. What about situations where changes in margin or growth are unpredictable? Isn't it a bit more nuanced?
That's a fair critique. In reality, every move has its intrinsic uncertainties, and sometimes the market doesn't immediately recognize the incremental value. This is highlighted when they point out that price enhancements might lag behind value creation, sometimes punishing firms even when they're on the right track. It's all about management credibility and execution, and these are subjective, policy-specific challenges that numbers alone can't capture.
Totally. And while the framework is robust, implementation is never a one-size-fits-all. The value enhancement chain illustrates that actions differ in terms of control and timing, quick fixes versus long-term strategic moves. It reinforces that all departments from operations to finance play their part.
Absolutely. The alignment across departments is crucial. If the operations and marketing teams aren't on board with a cost-cutting or revenue-improving strategy, even the best financial models may fall apart. It's like a finely tuned orchestra. Every section must play their part for harmony.
Right. And the chapter doesn't just stop at theory. It even poses a series of questions and short problems at the end, which really drive home how these concepts can be applied practically. I recall problems addressing things like the impact of restructuring charges on stock price or how divestitures affect free cash flow. It's a holistic look at value creation.
Yes, and those problems really illustrate the practical challenges behind using the discounted cash flow methodology. For instance, think about a scenario where a restructuring charge lowers earnings but doesn't affect operations. The immediate drop in earnings might lead to a stock price adjustment, but the intrinsic value based on cash flows remains grounded in the fundamentals.
Exactly. And in another problem, The impact of cost cutting not only increases current operating income, but might also reduce growth if those cost cuts impact the future reinvestment needed. It demonstrates that every decision is a trade-off, balancing immediate cash flow gains against potential future growth. It's a classic push and pull scenario.
Right. The trade-off between free cash flow and reinvestment is something managers need to evaluate on a case-by-case basis. When operating efficiency is improved through lower non-cash working capital or reduced capital expenditures, there's a direct positive effect on value if done correctly. But if it stifles growth, then the strategy might backfire.
That's where the role of strategic analysis becomes so critical. The analysis emphasizes that management must diagnose specific issues for their firm rather than just following a cookbook. Value enhancement might be straightforward conceptually, but tailoring the strategy to the firm's context is everything.
Definitely. And another interesting part is the discussion on financing policy. By matching debt cash flows with asset cash flows, firms can lower default risk and thus reduce their cost of capital, creating additional value. This nuance, again, shows how interconnected the operational and financial sides really are.
Yep. I also appreciated the mention of innovative financing techniques, like using catastrophe or commodity bonds to better align debt profiles. These are creative strategies that can sometimes unlock hidden value.
Exactly, because it's not just about chopping away at costs or slashing investments. It's about creating a comprehensive strategy that touches on every aspect: operations, growth, and financing. The chapter encapsulates how each of these levers interplays to affect the overall DCF model and firm value.
Very true. Before we wrap up, I'd like to touch on the closing thoughts. The text makes it clear that value enhancement is a long, arduous process. It's not a magic pill. There's hard work, time, and yes, sometimes even a hit to morale when tough decisions like layoffs are made. The approach has to be holistic and cross-functional.
Exactly. And they emphasize that even if value-enhancing initiatives are carried out flawlessly, the market might not immediately recognize these improvements in the stock price. That can be frustrating for managers, but over the long term, the fundamental value is what matters.
Right. It really brings home the point that management actions like cost-cutting, divestitures, or even tweaking financing all have ripple effects across the firm. The value creation equation isn't solely about numbers. It's about perceptions, strategic positioning, and ultimately, execution.
Absolutely. And that balance between qualitative factors and quantitative models is what makes value enhancement such a compelling area of study. From everything we discussed, from divestiture value negotiations to managing reinvestment trade-offs to optimizing capital structure, the key takeaway is that real value creation comes from aligning all the moving parts of the business.
Yeah, I think this discussion really shines a light on the multidimensional nature of value creation. It's not just one lever to pull, it's an entire chain of decisions that need careful calibration. And even though there are challenges and nuances, the framework gives managers a robust way to identify which actions are worth pursuing.
Well said. And as our discussion shows, even if some elements like market reactions to cosmetic changes, like stock splits, appear to boost prices in the short term, genuine value enhancement always circles back to improvements in cash flows, growth prospects, and efficient financing. It's a multi-layered approach that every active investor and manager should mull over.
Absolutely. All right, that wraps up today's conversation. Thanks for exploring these deep insights on value enhancement with me. It's been a roller coaster of numbers and strategies, and hopefully our listeners have gleaned some actionable insights.
Thanks for joining in the discussion. Until next time, keep questioning the levers of value in every business decision.
Yep, see you next time.
Welcome to our podcast discussion on value enhancement measures, particularly economic value added and cash flow return on investment, or CFROI, and how they connect with discounted cash flow analysis.
I'm excited. It's such a deep topic. So let's jump right in. What's the overall idea behind these measures?
Well, the idea is, to provide a comprehensive way to assess how a firm can create value. Traditional discounted cash flow, or DCF, models consider many inputs, and as those inputs multiply, things get complex. So EVA and CFROI try to simplify things a bit by looking at excess returns. Essentially, if management earns more than the cost of capital, the firm creates value.
Got it. But I recall that DCF itself is quite thorough. How do these measures specifically differentiate themselves?
Right, so the discounted cash flow model analyzes all potential future cash flows using estimates that can get manipulated. In contrast, EVA is rooted in computing the dollar surplus of operating income above a cost of capital threshold. That is, after-tax operating income minus capital cost times capital invested. It condenses things into that excess dollar measure.
And that calculation of EVA relies on 3 critical inputs, correct?
Exactly. You need the return on capital earned, the cost of capital, and the actual capital invested, which itself can be tricky because you often have to adjust the book value. For example,
Yes, indeed.
you adjust for operating leases, R&D expenses, and one-time charges so that the capital invested mirrors the true economic scenario.
That brings up interesting complications. You mean if you mismeasure capital invested, you might artificially boost EVA?
Precisely. Managers might even be tempted to take actions that reduce the reported capital invested, like via restructuring charges or shifting to lease rather than purchase, to make EVA look better, even if in reality it might harm future growth.
Right, that seems like a clear pitfall. So, it's not just about looking at the current numbers, but also ensuring future growth opportunities are not sacrificed.
Exactly. The framework separates the firm's value into assets in place and future growth prospects. You see, if a firm earns above its cost of capital on its current assets, that value component gets boosted. But if future investments generate returns only at the cost of capital, then you only see limited additional value, because growth is good only when it's paired with excess returns.
So, let me get this straight. Even if EVA increases on an annual basis, it might not lead to growth if the reinvestments are too close to the cost of capital.
Yes, exactly. It's like having a seemingly high year-one bounce, but if you trade off future growth, you can actually destroy overall firm value. This is one of the main criticisms of tying managerial compensation purely to EVA, because it might incentivize short-sighted decisions.
I see. And that's where equity EVA also comes into play, focusing on shareholders, right?
Yes, equity EVA adapts the measure by comparing return on equity with the cost of equity, so it calculates net income versus cost of equity times equity invested. It's particularly useful in sectors like financial services, where defining debt gets messy.
Interesting. So, if I understand correctly, using these measures, managers have to be careful not to game the system by, say, reducing reported capital to artificially boost EVA.
Absolutely. And that's where the concept of the capital invested game comes in. Say, if you understate capital invested, it might increase EVA on paper, but the true firm value may actually decline.
Yeah, that really makes you think about the quality of growth, not just the number crunching. Let's shift gears a bit to CFROI. Could you walk me through that concept and how it's calculated?
Sure. CFROI, or cash flow return on investment, is essentially an internal rate of return on a firm's existing investments measured in real cash flows. You start by taking the gross investment, add back non-cash expenses like depreciation, adjust for inflation, and then compare that with the gross cash flows generated on these investments. The result is a percentage return, which you then compare to the real cost of capital.
And so, if the CFROI exceeds the cost of capital, it signals value creation, right?
In theory, yes. But there lies the catch. CFROI is a bit like a double-edged sword. Because it focuses on existing assets, it might inadvertently ignore changes in future growth. See, if managers reduce gross investment, CFROI might go up even if it sacrifices future capacity. It's a bit of a balancing act.
Right, that's an interesting risk. Also, I recall that there are different ways to measure depreciation in CFROI, like the conventional approach versus using economic depreciation. Can you elaborate?
Sure thing. The conventional approach simply calculates CFROI as the cash flow over gross investment. But then there's the economic depreciation approach, where you set aside an annuity for the expected replacement cost of the asset. Essentially, you compute an economic depreciation factor that reflects how assets need to be replaced over time. This can result in a slightly lower CFROI because it factors in the real cost of maintaining the asset base, sort of like saving up for a future purchase.
Yeah, that makes sense. It's like comparing the return on an asset with and without factoring in its eventual wear and tear.
Exactly. If you ignore economic depreciation, you might overstate your returns. And as the analysis shows, even a small difference in reinvestment assumptions can change the CFROI considerably.
What about the link to discounted cash flow models? I noticed that both EVA and CFROI can, under consistent assumptions, yield a similar firm valuation to DCF analysis.
Right, and that's a key insight. When you apply the appropriate adjustments, ensuring that the operating income for DCF equals the income used for EVA, for example, and you align terminal value assumptions, then both approaches can yield the same firm value. For example, one illustration showed a firm valued around 170.85 million through both methods.
That certainly reinforces the idea that they're just different lenses on the same underlying economic reality.
Correct. The main advantage is simplicity. EVA gives you a simple dollar measure of excess returns, and CFROI does so on a percentage basis, which sometimes is easier for comparisons. But the simplicity comes at a cost. They can mask potential problems, like the trade-off between current returns and future growth, and the possibility of managers shifting risk to improve these metrics.
Right. That's the risk-shifting game you mentioned earlier.
Yes, indeed. If managers, for instance, take on projects with higher risk, then even if numerator of EVA or CFROI increases, the cost of capital might also increase, ultimately reducing firm value. Essentially, a boost in these metrics doesn't automatically translate to a higher stock price if investors adjust their expectations upward on risk.
Exactly, that interplay is really delicate. And sometimes, these measures lead to conflicting incentives. Managers might focus solely on today's EVA improvements, even though those changes might undermine long-term growth prospects. Isn't that a valid concern?
Absolutely. In fact, if a manager enhances current EVA by reducing the capital base artificially, say by leasing assets rather than buying them, it might boost EVA numbers in the short run while decreasing true firm value over time. That's why many firms try to incorporate multi-year incentives to counterbalance the temptation for short-term gain.
Yeah, it's a tricky balance to achieve. It seems like these methods are very useful analytical tools, but their application must be handled with a lot of care.
Absolutely, and that's the bigger picture. Whether you use EVA, CFROI, or DCF analysis, no single measure tells the whole story of a firm's value. They each highlight different aspects: cash flows from existing assets, reinvestment quality, growth prospects, and risk. In practice, managers need to have a true commitment to value maximization rather than just gaming one metric.
You mentioned earlier the concept of the fade factor with CFROI. Could you explain what that entails?
Sure. The fade factor is essentially the idea that a firm's current high CFROI doesn't remain static. Over time, it naturally regresses or fades towards the average cost of capital. Practitioners use empirical data, tracking firms' CFROI values over time to estimate how quickly this decline happens. Therefore, while a high CFROI might initially be impressive, if it fades quickly, the long-term value creation might not be as significant.
Right, it's like enjoying a temporary windfall that stabilizes later. That definitely adds another layer to decision-making for strategic investments.
Exactly. And when linking these measures to firm value, one has to consider, for CFROI, not just the current return, but also the amount of gross investment and other factors like capital expenditure, depreciation, and working capital changes, all of which contribute to the discounted cash flow-based valuation.
So in the end, both EVA and CFROI help provide a structured way to gauge performance, but they also remind us that value enhancement is multidimensional.
Precisely. They serve as valuable tools in the broader toolkit of corporate finance. At the risk of sounding like a broken record, no magic bullet creates value. It's about careful balancing of operating performance, growth, and the corresponding risk.
Absolutely, and it's a great reminder that underlying strategic decisions, not just financial metrics, drive true value creation. Thanks for this in-depth exploration. It's fascinating to see how detailed and nuanced these measures really are.
Sure is. And remember, while these models have their limitations, they can enhance our insight into how firms operate and how value is truly built over time. Whether you're an investor or a manager, it's all about ensuring that today's profits don't come at the expense of tomorrow's growth.
Well said. I think our listeners will definitely walk away with a deeper understanding of these value enhancement measures.
Thanks for joining in on this discussion, and we'll see you next time as we dive into another key concept in corporate finance. Welcome back, everyone. Today we're digging into probabilistic approaches in valuation. Moving beyond a single discount rate and one expected cash flow number.
I'm excited. Yeah, it's like opening the treasure chest of risk analysis, right?
Exactly. Instead of encapsulating risk in just one number, we explore a varied landscape of outcomes. Think about scenario analysis, where you have best case, worst case, and even more detailed multiple scenarios. It really gives us a range of values rather than a single point estimate.
Right. And that approach actually ties into how you can measure the risk. For instance, the spread between best case and worst case not only indicates variability, but also shows potential hedging or downside threats.
Absolutely. Now, in best case and worst case analysis, you might set all values to their extremes. But the tricky part is ensuring that our assumptions, like the simultaneous maximization of revenue growth and margins, are even feasible, right?
Yeah, and that's why many practitioners prefer to define the feasible combinations, making the best case outcome more realistic, albeit with more work to do.
Right. And then we have multiple scenario analysis, where rather than only two extremes, you map out several credible possibilities, incorporating macroeconomic factors and asset-specific influences.
Exactly. And wouldn't you say that the key is to choose the right factors? Like for an auto firm, you might focus on the state of the economy. Or in consumer products, you might consider competitor response.
Yes, picking 2 or 3 critical factors can keep everything manageable. It's about striking a balance. Too many scenarios, and you drown in data. Too few, and you risk oversimplifying.
Moving on, let's chat about decision trees. They're really interesting because they capture sequential risks, right? Like the FDA approval process for drugs.
Exactly. It's like unfolding layers of risk, phase 1, phase 2, and so on. In a decision tree, we break it down into root nodes, event nodes, decision nodes, and finally, end nodes.
Right, and each event node has that probability attached, which then feeds into, our final expected value calculation when we fold the tree back.
Precisely. And think about, for example, a pharmaceutical company in the midst of drug tests. Each phase carries its own set of costs, probabilities of success, and eventual outcomes. It's like a series of if-then decisions that shape the overall valuation.
And the decision tree even tells you what to do at each juncture, whether to proceed or even abandon the project if it isn't looking promising.
Right. Which brings us to one of the more nuanced points, the idea of marginal cash flows. Sometimes an outcome isn't attractive on its own. For instance, developing a drug for only one condition might look negative until you compare it with the even worse alternative of abandoning the project.
Good point. I appreciate that subtle critique. It shows that sometimes the optimal decision isn't immediately obvious until you compare alternatives, which is the real strength of decision trees.
Exactly. Now let's shift gears to simulations, especially Monte Carlo simulations. They're a whole different beast when it comes to capturing continuous risk.
Right. With simulations, you generate a distribution by drawing from probability distributions for the input variables.
Yes. For example, in valuing something like ExxonMobil, where oil prices vary, you set up a distribution for oil prices, link that to operating income with regression estimates, and run thousands of simulations to capture the full spectrum of potential outcomes.
Yeah, that's a powerful way to see the spread. What I find fascinating is how simulations provide not just a point estimate, but also a standard deviation, percentiles, and a visual distribution of values. It gives you much more context, especially when you're weighing downside risk.
Right. And it bridges the gap between risk-adjusted discount models and pure point estimates, offering a clearer picture of uncertainty. And remember, the process involves understanding correlations too. For instance, oil prices often correlate with inflation, so you need to consider that, either build it into the simulation or adjust your focus.
Exactly. And there's a common trap too, the double counting of risk. If you use a risk-adjusted discount rate and then also reject an asset because its simulated value is highly variable, you're effectively penalizing it twice.
Right. That's a pitfall that analysts need to be very careful of. Some even argue that if you're choosing the asset based on the standard deviation, then you might be better off discounting at the risk-free rate. But that assumes all risk matters, which isn't always the case.
I think it comes down to understanding if the risk is diversifiable or asset-specific. For a diversified portfolio, some volatility might not matter much at all.
Exactly. And that's why investors sometimes use simulations not primarily for valuation, but to set margins of safety, especially when downswings are severe. For instance, a value investor might determine that with high uncertainty, a stock should trade considerably below the expected value before it's considered a buy.
Right. Like if Exxon's simulation gives an expected share value of around $70, but with wide variability, an investor might only buy if the price falls 20% below that threshold. It's all about managing downside risk.
Totally. And then there's the situation where you've got constraints, like regulatory capital rules or even negative book equity issues. Simulations can assess the likelihood that those constraints are breached, highlighting potential catastrophic outcomes.
And that is critical, particularly for financial institutions or companies, where non-financial risks, like loss of key contracts or nationalization risks, can have huge impacts.
Yeah, absolutely. There's even a discussion on how to model these risks in structured problems, like in a Venezuelan firm facing nationalization, or say a bank dealing with regulatory changes. Scenario analysis provides an expected range, while decision trees map sequential choices.
Right. And what's neat is that these methods can complement one another. You can start with scenario analysis to get a rough idea, then build a decision tree for sequential decision points, and finally use simulations for continuous risks and correlation adjustments.
Exactly. They're not mutually exclusive. Each approach has its strengths. Scenario analysis is great for showing a range when risks are discrete and non-sequential. Decision trees shine when you face phase-wise decisions. And simulations are ideal when we deal with continuous and correlated variables.
That's a perfect encapsulation. But I do have a question. What do you say to critics who argue that simulations, by providing an expected distribution, end up complicating the decision-making process unnecessarily?
Do you think we're overcomplicating? Well, I'd say while it does add complexity, it also adds depth. It forces us to confront uncertainty head-on. Sure, if you don't have reliable input data or a clear idea of the distributions, simulations might give a false sense of precision. But when done properly, they provide a richer basis for decisions.
Yep, that makes sense. And the key is in having good, reliable data to estimate those distributions. Otherwise, it's just garbage in, garbage out.
Exactly. And that's something always stressed. Whether it's a decision tree or a Monte Carlo simulation, the quality of your assumptions is paramount. If your inputs aren't well-founded, no method will deliver a reliable valuation.
I also like how these tools help you understand the value drivers. By tinkering with the variables, say, changing oil price assumptions for an energy company, you can see which factors have the greatest impact on valuation.
Right, and that insight is incredibly useful, helping managers prioritize risk management strategies. It's like doing a stress test before a storm arrives. You're assessing, what if conditions worsen?
Exactly, and it not only helps with individual asset valuation, but also portfolio management. Knowing how each asset's value distribution behaves can help optimize the overall risk profile.
Absolutely. In the end, these probabilistic approaches, scenario analysis, decision trees, and simulations allow us to see beyond nominal valuations. They remind us that risk isn't just a number, but a spectrum of possible outcomes, each with its own implications.
Well put. And while no model is perfect, embracing these techniques can only enhance decision-making by exposing both the upside and the downside in a far more granular way.
Right. So, whether you're an analyst, investor, or portfolio manager, it pays to look at the full picture and to be aware of the dangers of double counting risk or relying on overly simplistic assumptions.
Exactly. A balanced, disciplined approach using these methods can really transform how you assess risk. It's been a fascinating dive into the world of probabilistic valuation.
It sure has. Thanks for the great conversation, and hope everyone finds these insights as useful as we do.
Yeah, thanks for joining us. Until next time.
All right, folks. Today we're diving into the fascinating world of valuation models. You know, it's not that we lack models to value an asset. It's that there are just too many to choose from, right?
Absolutely. It's like trying to pick the best flavor at an ice cream parlor when every scoop seems appealing. Which one do you think stands out when it comes to, say, asset valuation?
Well, you've got asset-based approaches which hinge on looking at what a firm's assets are worth, either by liquidation value or replacement cost. It's like asking, what would you get if you sold all the parts today?
Yeah, right. And I imagine that works well for companies with tangible, marketable assets. But what about firms where cash flows are the core story?
That's where discounted cash flow comes in. You discount either equity cash flows or cash flows to the firm. And you can even break that down into stable growth or multi-stage models, like 2-stage and 3-stage DCF.
Yep, indeed. I see. So depending on whether a firm's earnings are normal or, temporarily skewed by events, you might adjust your approach. But doesn't that sometimes make things more complicated?
Oh, totally. For instance, if a firm's earnings are distorted by, say, a one-time charge or a cyclical downturn, you might replace those with normalized earnings, essentially using the company's history or industry averages as a guide. It's like smoothing out the bumps on a rough road to see the true direction.
Interesting. So it's really about matching the model to the firm's specific characteristics. And what about relative valuation models? They seem to offer a whole different perspective.
Right. Relative valuation uses multiples, like PE ratios, price to book, or even PS multiples, to compare a firm to its peers. You pretty much check if a company appears under or overvalued relative to similar companies in its sector.
But don't you think that can sometimes be a bit of a gamble, relying too much on market sentiment rather than fundamentals?
You're hitting on a crucial point there. While relative valuation is great for a market-neutral view, it really assumes that the broader market or sector is priced fairly. And if the entire sector is mispriced, then your judgment can be off.
Right. Which brings us to the option pricing models. They're less common, but can be a game changer when a firm has significant growth potential or hidden flexibility.
Absolutely, especially for assets that behave more like real options, think patents or undeveloped reserves. But here's the kicker. You really need exclusivity or some competitive edge for options to have true value. Otherwise, it's just overestimating possibilities.
I can see that. So if you're evaluating, say, a tech startup with innovative patents, option pricing might capture that upside, right?
Exactly. But you have to be careful not to double count. If your DCF already accounts for potential growth, you shouldn't tack on additional premium on top of that via options. And that's a pitfall many fall into.
That sounds like common sense, but, well, balancing these factors can be tricky. Now, how do analyst characteristics and beliefs weave into the choice of valuation method?
Oh, that's a deep dive. Analysts' time horizons and their reasons for valuing a firm are critical. If you're in it for a long-term investment, a DCF model that sees the company as a going concern might make sense. On the other hand, equity research might lean toward relative valuation because you're comparing firms over shorter horizons.
Right. So there's an element of subjectivity. Your own perspective and biases can sway which model feels right.
Exactly. And here's another twist. The firm's operational stability matters too. For companies with stable leverage, the firm and equity valuation approaches tend to converge. But when leverage is all over the place, the firm valuation method is generally more robust because it sidesteps the messy details of interest and principal payments.
True. Got it. And then there's the aspect of growth patterns, which seems like a central pillar in these models.
Totally. Growth momentum can really dictate what model you use. For stable growth firms, a constant growth DCF works reasonably well. For moderate to high growth firms, you might need 2-stage, 3-stage, or even multi-stage models. And the source of that growth, whether it's from a strong competitive edge or legal barriers like patents, matters a ton.
Right, because the durability of competitive advantages is so variable. A brand name might erode gradually, while a patent can offer a high but temporary boost.
Absolutely. There's a critical decision point there. It's like you want to pick the model that not only fits the numbers, but also the story behind them. And speaking of fitting the numbers, let's jump into relative valuation's conundrum. Which multiple should you use?
Yes, tell me more about that. I've seen analysts using everything from PE to price-to-book ratios. How do you decide?
Well, there are a few methods. One is the fundamentals approach. Select the multiple that has the highest correlation with a firm's value in that sector. Then there's the statistical approach where you run regressions. The multiple with the best R-squared is your best candidate. And often you just end up with the conventional multiple for that industry.
Absolutely, yeah. So it sounds like there's a mix of art and science here. But isn't it a bit risky still? I mean, if the conventional multiple doesn't reflect the firm's fundamentals, then you could be misled.
Exactly. And that's a common critique. When a sector is evolving, sticking strictly to traditional multiples might give you misleading estimates. It's important to cross-check, maybe average several multiples, but weighted by how precise each estimate is.
Right on. That makes a lot of sense. Now, what about the contrasting approaches between DCF and relative valuation, especially when they give conflicting results?
Great point. There have been instances, like with Amazon in the dot-com era, where DCF indicated one thing and relative valuation another. If DCF shows overvaluation, but relative metrics indicate undervaluation, it might signal that the overall sector's inflated. Conversely, if DCF points to undervaluation, but the relative view is overvalued, then you might be looking at a sector that's broadly depressed.
Yeah, exactly. So, ideally, an investor would seek companies undervalued on both fronts, right? That way, you cover both time-based corrections and cross-company mispricing. Precisely.
It's like shooting for a double safety net. You want to benefit from market corrections both over time and relative to peers.
Absolutely. Let's circle back a bit. What's your take on using dividend discount models versus free cash flow to equity for valuing a firm?
Good question. The dividend discount model is best when you can't accurately forecast cash flows due to constraints like uncertain reinvestment policies or when cash returns are strictly limited to dividends. But usually, free cash flow to equity gives you a fuller picture, especially when companies have flexibility in cash distribution. It's like comparing a snapshot to a panoramic view.
However, wouldn't you argue that in some sectors, like financial services, dividends might indeed be the primary cash return, making the dividend model more appropriate?
That's a fair critique. In sectors where dividends are practically the only return mechanism, such as in some financial services, the dividend model becomes not only practical, but necessary. It really goes back to matching the tool with the asset's behavior.
Absolutely. And what about unstable earnings, when current earnings are either negative or abnormal? How do you handle that?
In those cases, you lean towards normalized earnings. For cyclical firms or companies undergoing restructuring, using normalized figures can prevent you from overvaluing or undervaluing the business. But caution is key. If the negative earnings are due to long-term issues or existential threats, just normalizing might mask the real risk.
Exactly. So it's all about carefully evaluating why the numbers look the way they do, and not just applying a blanket model, right?
Spot on. It really is a craft. One must understand the firm's fundamentals, its market context, and even your own biases as an analyst. There's no one-size-fits-all, and misapplying a model can lead to huge errors.
I love that. It's both an art and a science. Before we wrap up, any final thoughts on bridging these philosophical divides between different valuation methods?
Definitely. The key is to remember that discounted cash flow and relative valuation are not mutually exclusive. You can and should borrow the best features of each. For instance, if your gut says DCF is the way to go, but you need market neutrality, incorporate comparable firm data into your DCF assumptions. Conversely, if you're working with multiples, infuse them with rigorous fundamental analysis. It's like mixing the yin and the yang for a balanced view.
I really appreciate this balanced perspective. It seems that the ultimate takeaway is know your asset, know your market, and pick the model that resonates with both.
Precisely. Valuation isn't about finding a magic formula, but about matching the model to the unique characteristics of the firm while being aware of your own assumptions and biases. That's where real insight lies.
Absolutely. Well, that was an enlightening conversation, and it just goes to show that valuation is as much about the approach as it is about the numbers. Thanks for sharing that deep dive.
You got it. Until next time, keep crunching those numbers and questioning your models. Cheers.